Kevin's a brilliant guy, and I think that we'd all be very lucky to have him.
Kevin is very talented, but I don't know if it's going to be him, but he's a very talented guy.
You're here tomorrow to ring the bell. Oh, congratulations, man. You have done so much. 1.8 million YouTube viewers. People love you. People look up to you.
13 years ago, I stood over there looking at this very door, wondering what it would be like on the inside. Now, I have my name on the New York Stock Exchange badge, and I can go inside. I took my enthusiasm for the market and money and started learning everything I could about real estate. I would be the most transparent governor that would exist, and you'd have my commentary every single day. I became a licensed financial advisor.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Always great to have you on. Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.
It is time to introduce the company. Introducing
Reinvest.
Invest at Scale with Meet Kevin.
Kevin's somebody would consider. Kevin is fantastic.
Kevin is much.
Well, that was exciting. Welcome on back to another live stream. So the market opens up in about 13 minutes, and we got another big suck coming. It's really exciting. Anthropic is now expecting to basically out SpaceX, or they're going to try for their IPO. And it's actually really exciting because it just means you're going to get not only more sucking of capital into these giant stocks, but what you're also going to get is a lot of capital that ends up getting rinsed right on back into the hardware sector. So I find this actually really interesting. The S1 for this company is going to be really revealing, and it's going to drop within the next 4 weeks, probably post J-Hole. You know, Jackson Hole is obviously a big catalyst that we'll have to get through. We'll see. You know, there's this small chance that Kevin Warsh kind of actually provides hawkish forward guidance. You know, people are still kind of like, I don't know, man. The guy says he's not going to provide forward guidance, but then he also told us we're just going to look to the left of the decimal, the 2, which was sort of like, you know, a nail in the side of his, you know, the early framing of his coffin of credibility. So we'll see, man. We'll see. It's going to be really interesting. What do we got here? Expects to match or beat the size of SpaceX's record-setting IPO, according to people familiar with the matter. So that was $85 billion. That's really interesting. $85 billion is remarkable. If they could beat this. Because remember, SpaceX came in and said, oh, we'll raise, you know, 50, and then it was, oh, we're gonna, you know, be the largest IPO since Saudi Aramco, and then JK, we're actually gonna raise 75. You know, then of course you ended up getting the, you know, what's it called? The upraise, the green shoe that pushed it to $85 billion is really just an incredible amount of capital that got sucked into the SpaceX IPO. And SpaceX is at an interesting spot. You know, it's at a place. Oh, look at that. Q's already losing 715. SpaceX is hanging out at its little 133, just above it, retracement line here. We bounce around here regularly. Really, the money that they've raised is still a fraction of what they need. I'm of the mindset that SpaceX somehow has got to come up with $300 to $400 billion in capital, and somehow that's still got to get provided by markets, probably through lending. But the Anthropic IPO will be another suckening. So we'll write down some of these notes together here. So Anthropic seeking to beat SpaceX IPO. So think about that, right? SpaceX was a big suckening and marked a top. You know, that money is just now being spent. But that was $85 billion of raise, $75 billion on IPO plus the green shoe. It's pretty remarkable. So now Anthropic's S1 is expected to drop in the next 4 weeks. The profitability for Anthropic is going to be a critical component of how much of a suckening happens, but then also how much money can get recycled into hardware. Like, are they actually going to hit their raise? They probably will. I mean, this will be the first look at the real income statement for a Frontier Lab. It's probably bigger than the SpaceX IPO. SpaceX we knew would lose money. You know, we had a lot of color. You know, we know it's a space play. We know it's a play on, you know, data center compute. Like, we kind of already knew a lot of that stuff. But Anthropic is different. It's the buyer of all that compute. So Anthropic is even more important. It's the buyer of SpaceX's compute and others, right? It's literally the cog that keeps the AI spend investment cycle going. So it's really important. And so that S1 is going to be really, really entertaining. I mean, I kind of can't wait to see it, but we'll see what kind of catalyst that's going to be. Oh, wow. Walmart, Sam's Club's going to introduce contactless payments. I don't know what it was, but yeah, and Walmart plans to introduce tap to pay at fuel stations. Why don't they just have tap to pay on everything? The fact that they don't have Apple Pay blows my mind. I hate Walmart for that. You know, you go into a Walmart when you're traveling or something and they don't have Apple Pay and it's like, come on. You guys are just so behind. Oh, well. So, yeah, that's going to be the big moment of this AI trade. And I think there's some nervousness for that S1 to drop. Plus, obviously, J-Hole. You know, Jackson Hole's a week from yesterday. And you're seeing some of that nervousness already show up in some stocks. I mean, look at AMD. AMD's really come off of its high horse over here. You know, and it's still got a fair valuation. It's not like it was overvalued. And yet here it is, 474 divided by 584 off peak. We're off 19%. It's pretty incredible. So this will be very interesting. In a big moment, that Anthropic IPO. Let's go take a peek again at that doc or what's being said about it. So they're preparing for their IPO as soon as the end of the month. As soon as the end of this month? Oh, wow. Well, then the S1 needs to drop. I mean, we don't have that many days left. We've got a week and a day? A week and 2 days if you include today? There's no way they can pull it off this month still. That's crazy. Okay. I don't buy that, but it shows that they're kind of racing. You know, originally disclosed IPO goal of September, now trying to pull it off potentially late August. I don't buy that. I think, to me, that actually signals some of the anxiety that they have to get it out. They seem anxious to get in while the market is still relatively close to a top. I mean, what are the Qs? The Qs topped out at what? 746? Let's go see here. 747. So 7, we are at 7, call it 715 now. 747.83. We're 4.5% off all-time highs. So, I mean, you can't really blame them. 4.5% off all-time high NASDAQ. And I think RSP, which is the S&P 500 equal weight, is doing just fine. Let's go look at RSP. Yeah, RSP basically hit its all-time high yesterday, and it just keeps chugging. This is another one that we've really been paying attention to a lot, and it's incredible. The RSP going to all-time highs is actually great for the broadening of the wealth effect. IMO, RSP continuing to hit all-time highs helps for wealth effect. Broadening. Let's write that little note there. Okay, there we go. Okay, so that's very interesting. I mean, then we would really need the S1 to drop like today or Monday, like ASAP. Okay, so let's see. 86 billion is actually 86.2 was the real total for SpaceX. That's more than I thought. I thought it was 85. So it's actually 86.2. So we'll update that. Discussions are ongoing. The size could change. Anthropic. I mean, this is how they kind of put the little feelers out, and then they could see what people's commentary is on their valuation. This is very, very normal for them to, like, quote unquote, leak news. This is super normal. So expect them to do this. So we do have S&P manufacturing and services data coming out soon. That'll be in about 15 minutes, a little bit more than that. Okay, so Anthropic target reflects how AI industries leaders are transforming the investment on blah, blah, blah. Okay, whatever. Anthropic saw positive adjusted operating income for the second quarter. I am very curious what they mean by adjusted, because I'm pretty sure when they say adjusted, what I've heard about adjusted is that they're adding back in some of their training costs. So I think this is kind of like, that's going to be a moment that sets up a little bit of shock and awe for the market, in my opinion, at the same time as they want to suck a bunch of money out. But I mean, think about that for a moment. If it's true, that they only saw a positive adjusted income by adding back in training costs, which is, in my opinion, critical cost of goods sold, then they're nowhere near profitable. Right? I mean, but that's sort of what we anticipate anyway. But like, adjusted operating income in the second quarter. Yeah, if we just add back in all our training costs that got us here, sure. That's going to be, and see, the S1 will reveal the bull crap. That's the cool thing about those SEC filings is, you know, they're going to be forced to make disclosure. S1 will reveal the true story. So I look forward to that a lot, and I think the market does too. Okay, let's see. Company preliminary revenue of more than 11.5 billion in the second quarter, which then there was talk about them hitting 65 billion at the end of July, because this is like 46 billion, up to 65 billion. Some people were saying the $65 billion figure could be like the last day. So that was sort of a rumor that I heard. Which would be really interesting if it's sort of, I mean, like, technically that would work, right? If you had last day subscriptions that gave you a, you know, times 360 days run rate of 65 billion, maybe. Some say 65 billion calculated as last day annualized of July. I mean, that does indicate growth from the second quarter, right? Because if Q2 ended at 46 billion, including April, May, June, then the growth to July still looks impressive. Now, is that slowing down? I don't know. I mean, they came off a really great Q2 with Claude Code. So, again, something where the S1's going to just give us a lot of color. So, kind of exciting. So, we'll see what happens. In the meantime, yeah, look at that. Right there at our test. Let's see what ends up happening there with the Qs. And let's go get ready for the bell. Everybody loves the bell.
It's the one maturity that's also making new highs, so I think that's why it's gotten the attention. You're going back, 19 years or something since we were there before. But I do think 10s are more relevant for financing purposes.
Mike's going to stick around. Let's get this bell under our belts with the big board of Penske Automotive, ringing remotely from the Freedom 250 Grand Prix in Washington, D.C. It's going to happen this weekend at the NASDAQ in Times Square. It's Defiance ETFs celebrating its AI empowerment.
Yeah. All right. Well, let's see how this puppy moves today, eh? I'm waiting for some AMD bounce, personally. I don't know, it's just like, it seems like it's been a long time coming here. Well, not really, but it's just been struggling. And so have the Qs. It's like, you can't even hold 715 right now. I mean, it's the first minute. It's like, You gotta be a little patient with the market. You gotta treat it like the little child it is. Speaking of little child, I think I was able to bring back correctly these.
By the dip.
Yeah, let me know if you hear those. You should be able to hear those.
Coupon linked below. Sell the rip to the moon. Don't sue me, bro. Reaming spree. Double reamed.
I love those. I just freaking love that stuff. Ah, man. It's kind of like, I was able to make these, and I just like slapped it together. Like I didn't even try, but I made this little like intro screen that starts with the Trump, and I just pushed this. I just love it.
What would consider shit. Kevin is fantastic.
Kevin is much more interested than most people, by the way, in the balance sheet.
I love it. I love it. It's great. It's just really exciting. But in the meantime, we got this like basically elevator down right now on the Qs. I don't know what they're going to do, or like where the money is going to come from for, unfortunately for what's it called, for Anthropic, but you know, we'll see, we'll figure it out. I have to say, really excited about Salesforce. So this is one that we've been buying since about 160-ish. And, you know, obviously we send alerts for that over at the, you know, the Meet Kevin membership if you want to join. But the fundamental analysis on Salesforce was really interesting because the timing suggested things could actually move a lot faster on this stock than some other fundamental plays. Like, there's some fundamental stocks that you buy and you're like, yeah, this probably isn't going to go anywhere until rates come down, for example, right? But Salesforce was really interesting because they were doing a lot of buybacks, like massive. They were borrowing money to buy back their own stock at an average price of 191. And I'm like, man, they've got at the time it was like 11% free cash flow yield, and I can buy below where they just spent $25 billion buying. Dang, that's awesome. So, you know, now we've seen this breakout, which is great, and we're broadly seeing this in a lot of software plays, some of them which have been really left for dead. You know, another one that has just been left for dead is like a Path. You know, it's at $16 now. It's really popped off this lower level here, the 9s, with multiple bounces over here, the 9s. But recently, you could see that software trade coming back to life, which is nice. You know, it's nice to see the software trade coming back. So, oh yeah, everybody's got to tap the debt markets. Broadcom-backed SPV tapping $70 billion. That's huge. Let me see if I can pull that story on this. Let's take a look. All right, here we go. Broadcom plans to raise, oh, here it is, $100 billion in off-balance sheet debt. Okay. Pushing credit default swap spreads to record highs. I'll get a chart really quick of CDSs. Let's see where they stand today. CDS prices for, let's go with Broadcom, SpaceX if we could get them. NVIDIA would be nice to see. Oracle's always a good one to see. CoreWeave is kind of cool to see. And yeah, we'll start with those. Okay, so we'll pull that up in just a moment. Broadcom is seeking to issue its largest SPV debt in history. Yeah, well, that's the thing is, if for everybody to keep spending money, we need the financing to keep going. AI financing window before regulatory tightening intensifies. But I don't actually think anything is tightening. I actually think things are loosening. Like, if you look at what was happening with the, right before Jensen announced the $500 billion deal, you know, intended fundraising backed by, you know, Wall Street firms like KKR, the SEC actually loosened regulation, which is crazy. But that's what's happening right now. Okay, Broadcom is in negotiations with Blackstone and Apollo to raise over $60 billion in senior debt for an SPV. Wow, man, that's crazy. Sources familiar indicated the financing plan may include $30 billion of subordinated debt tranches, bringing the total potential to as much as $100 billion, which would make it the largest SPV financing transaction to date. Yeah, I mean, you know, people thought it was crazy when NVIDIA, you know, or sorry, Meta did their $21 billion financing deal, and then you end up with this, and it's like, oh my lordy. Okay, so let's go take a peek at this. Okay, here are the credit default swaps right now for the various companies that I mentioned. Let me put an arrow on this. They're kind of remarkable because the markets are getting a little bit more nervous about them. Yeah, there we go. All right, so Broadcom is right here. NVIDIA is up here. So we're past the Leo fold highs. Leo fold. I'm just so mean. I'm just a mean person. Don't call them Leo fold. All right. So this is past July. Oops. Let's do this. Past July peak. And let's see here. JP Morgan warns of autumn sell-off. Those 2000s. Okay. I don't like JP Morgan. I've ever made that clear? We don't need to go into that. They'll probably honestly be isn't that kind of crazy to think about? Anyway, past July's peak right here. That's Broadcom. You've got credit default swaps for all of them, except SpaceX. SpaceX is actually de-risked. That's interesting. SpaceX is the only one to have de-risked. That's fascinating. That wasn't on my bingo board, that we would have seen SpaceX. I mean, it's still elevated, right? But you're the only one to de-risk from the peak. Otherwise, Oracle is higher. Broadcom's way higher, especially with this debt that's going on, and Nvidia's nominally higher. But very interesting. Okay, so which would make it the largest SPV financial transaction. The sources requested anonymity. Information remains confidential. Broadcom stock price rose. However, the reaction was starkly different. CDSs widened, hitting new highs. Broadcom will provide credit support for a portion of the senior debt issued at the SPV. So basically, they're off-balance sheet guarantees. And that stuff, that's why the credit default swaps are going up. The insurance against these companies defaulting, because people are like, wow, we can't even get visibility into how much debt there is. That's interesting. According to Bloomberg, this collaborative platform plans to finance over 20 gigawatts of compute. Well, 20 gigawatts is probably going to cost you $1 trillion. You know, you should be thinking about $50 billion per gigawatt, typically. Majority not appearing on the party's balance sheet. Yeah, so like when are all these guarantees actually going to show up? That's why you're not seeing them really show up at on Nvidia's balance sheet either, because they're providing these guarantees for things like OpenAI's Ohio plan, and that just doesn't show up as a liability. Yeah, look at this. Wow, according to the Wall Street Journal, the 9 leading technology companies, including AMD's on the list, disclosed $3 trillion of off-balance sheet commitments. Holy smokes. The figure is roughly 5x the combined capex of these companies over the past year and represents a 50% growth rate. Well, that was in just 2 months. It's even worse. 1.2 trillion of not yet commenced leases and about 1.9 trillion in purchase commitments. Wow. Let's see here. Alphabet and Amazon have recently reported negative cash flow. Yeah, we already know that. That's insane. That's a lot of debt. That's a lot. All right, let's go. Let's take a listen to Sarah here for a moment. Let's see what she's up to.
The price caps on farms.
Oh, Walmart. Sorry, I'm gonna get right back to yapping. I am not a fan of Walmart right now. They're actually at their 100% fib level, so they're trading back at their highs of like Feb of 21, I think it, or was it 5? No, it's probably 2025. I think it was 2025. Anyway, you can look at the chart and see it. To me, I think they're gonna lose it. They're gonna lose that fib line, and this puppy's gonna keep going down. I'm bearish Walmart. I'll put it that way. I'm more bullish Bitcoin right now than I'm bullish Walmart. Mostly because I think this is like the first sign of life we've seen at Bitcoin as a perfect opportunity for, you know, technical traders to come in off the sidelines while shorts cover. It's kind of exactly what you want to see. So that's exciting. Okay, let's go back over here.
Because we were making a list of drawdowns in consumer. Depot down 24, McDonald's down 20,
Yep.
Costco down 15, TJX down 18. I won't even do Nike.
Right.
I mean, that's a pretty bearish consumer case.
There are winners.
Yeah, but no, you can't really look at Nike. Nike is dog crap because they don't have pricing power anymore. Their pricing power has gone to absolute crap. And I think that's what people forget, is that these companies have to continue to prove pricing power, especially a product consumer, like a consumer business. So look at what we wrote in the course member analysis, okay? So course member analysis, October of last year, we said they had more tariff impact, were increasing their SG&A to get more sales. And when they reduced promotions in the second quarter, what a surprise, their sales tanked. This suggests low pricing power. People might be buying because it's cheap, but I think it's cheap for a reason, I wrote. Okay, so that's what I wrote in October. And there's, you know, some backing and stuff for that. Okay, balance sheet's declining. Then over here, looking at the November data, I wrote, reiterates pain this quarter as margin is worse. So, like, their margins are getting even worse. And then in December, I wrote, I really hate saying this, but when I can buy a $100 zipper pair of shorts on Amazon, on Nike, at a Nike store, or an $18 pair of zipper pants from Amazon, I'm going with Amazon, right? And so when we looked at their last financials, we're like, this is even more depressing than it was last time. And so sometimes, not always, you know, sometimes it takes time for fundamental stories to play out. But I think what's happening with sort of the pain in Nike is it's a slow bleed story. And if you look when I first, or that October analysis I made, the stock was $67. You know, the stock's down substantially from there. And this isn't that like, oh, well, in the short term, you know, the stock is fluctuating. That happens to all stocks. Like, you could buy a stock and it goes down, but you still have a great 10-year thesis on it. It doesn't matter. You buy more. The problem with Nike is you can't have a 10-year thesis on it because everybody's kicking their butt. There's so many different great shoe companies now, or apparel companies. I don't know. Not interesting to me. Okay, so where was I? Well, we were going to look at what Sarah was saying, but then I got frustrated by Walmart and Nike's talk. It's fine. Let's add a few notes over here on this debt article. So, debt article. Okay, so this debt article, this $3 trillion of off-balance sheet debt is wild. $3 trillion off-balance sheet debt, and that is made up of, if I write it down, it's easier for us to remember and look up later. That works out to $1.2 trillion in not yet started leases, and then we have $1.9 trillion in purchase commitments. So those are like, you know, SpaceX buying NVIDIA chips, this, that, or whatever, right? So that's interesting. Oh, let's listen to this for a moment.
all three, manufacturing, service, composite. In a couple weeks, they'll get fine-tuned a bit. We're expecting a number just below 54 in the headline. Comes in a bit lower than that, 53.2, a bit of a miss there, sequentially following 53.9's final read for July. So it is a bit lower, obviously, but it's still a pretty good number. It's an expansion territory.
Let's go actually look at the report. I usually care less about the little movements. S&P composite PMI. The little movements, in my opinion, between like, oh, it missed by 0.3 or beat by 0.4 or whatever, I don't think that matters so much. But you can actually get the real report. It's right here, the Global Flash PMI. So let's just download that, and let's see what we got here. So this is going to be the S&P PMI Global Flash for August 21st. Next week, we'll get some ADP weekly data, which will be nice because it'll be the first week that we get a full set of weekly data for August. We haven't had that yet. The last one, I think, ended August 1st. But, wow, the Qs just could not hold on today. Could not hold on at all. Okay, so somebody says, what happened on YouTube Live? No longer able to use picture-in-picture on Live. Make sure you have... I'm pretty sure they make you have a YouTube Premium subscription to do picture-in-picture. I'm not like trying to shill you for YouTube Premium, but I think they're tightening down on what features you get without basically paying for them at Google. It just sounds like Google's getting a little desperate. I don't know. I could be wrong about what's going on over there. All right. Chris Williamson says, U.S. business is booming. Fastest output growth in 4 years as the expansion picked up momentum. Well, talk about bullish. Do I hear bullish catalyst? Oh, man. That's one of the soundboard buttons I didn't add yet because we're on a totally different computer. So how about this one?
To the moon.
Yeah. Okay, I'll take that. I'll take that. Okay, so that's good. Survey data for the third quarter pointing at annualized growth rate approaching 3%, up solidly from the 1.5% before. That's great. Okay, that's great. Job growth has shown a welcomed revival, really, as employers are gaining confidence. I mean, in fairness, we're like outside of software dev, you know, because we have hired a bunch of folks. We're actually hiring, you know, for, you know, office, property management, contracts, you know, helping with content or videos or whatever. And so, yeah, if you're interested, just email us, staff@meetkevin.com. Send us like a 1-minute video of what it would take for you to relocate to SoCal. I know, to the commies, and salary expectations. You just ask, you know. Okay, so with employers gaining confidence as concerns rise over negative economic impacts of tariffs and the conflict in the Middle East, concerns fade. Well, and that's sort of the thing to remember is that markets are not, markets are IMO pricing in zero Iran pain, right? Like $94 a barrel oil, no one cares for now, right? So we'll see what ends up happening there. However, the latter remains a particular area of concern. Exactly, as it should. That's Iran. Supply delays were again reported to the greatest extent seen over the past 4 years. Growth momentum has shifted from manufacturing to services between the second and third quarter. Oh, well, that's great. That's higher margin, more U.S. Workers are in services than in manufacturing. Reduced safety stock for building and supply, delays, dampening, blah, 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 blah. Okay, whatever. Underscoring dependency on consumer spending. Okay, cool. So let's look at some of the data that they actually gave us. I specifically want to see a little bit of employment commentary. Price pressure is moderated. I'm actually surprised to see that. Sometimes this could be due to a lack of pricing power. So it's not entirely clear. Yeah, see, input cost inflation remained high. So suggests slightly smaller PP. Speaking of PP, I still have the, oh, I didn't put it on here? I didn't put it on here yet. Longpp.com.
Big PP.
I got big PP here. I got to do some more work on this. Okay, So then, where's the employment component? Employment. Having shown little change over the prior 8 months, employment rose sharply in August. Wow, that's incredible. Wow. The increase in payrolls signaled was the largest since Jan 25, and the second largest over the past 4 years. Holy smokes. That's very bullish. Very bullish. Okay. Especially marked, a rise in staffing was reported in the services sector. Largest rise in service. Factory jobs also picked up. Interesting. Both factory and services. That's pretty bullish. Okay. Both remained elevated at historic standards, blamed by survey contribution to high prices. That's fine. Any other notes? No. Not really. Okay, well that's great. See, that should make you want to, what's the word?
Buy the dip.
That's good. This reiterates, I'm going to write that. This reiterates buying the dip before J-hole. You know, if only we had a coupon code that was like, you know, J-hole. Oh, wait, we do. Coupon code J-hole for the Alpha membership expires August 27th. We're actually going to change the pricing quite a bit and our structure quite a bit. So you'll get some pretty gnarly benefits by joining before August 27th. In my opinion, my humble opinion. Okay, so how are we doing on the Qs? The Qs are still bleeding. Back to 7-Eleven, you're in heaven. No, that's not. That's not the rhyme, is it? 11, heaven? Yeah, I guess it works. Qs are literally about to go negative. You got SpaceX lost the 133 line. Bitcoin's still holding on 77. I think there's a shot. It's going quite a bit higher here. Moderna reversing after. Ooh, look at the momentum here on Moderna. I still think this is a $200 stock. You know, we said that at 120. And we're like, this puppy's going to go to 200. It ran to 196 on the short squeeze. You know, now it's the short squeeze is over. And you got to get some, like, you know, actual fundamental juice back into it. And that, yeah, I mean, there's going to be trading here as well today. I mean, this is, I feel like the only thing that seems to be rocketing today. A lot of bleed otherwise. Oracle's up 3%. That's cute. Oracle's NBS's, oh yeah, I missed. Oracle's CDS's are the highest out of all of them, and the highest they've been in this whole cycle. 219 now for credit default swaps on Oracle, which is remarkable. Okay, so let's go take a look here. We've got, yep, just lost the lead on the Qs. Let's go see here. What else is going on? So we looked at Bloomberg. We saw, oh yeah, here's the Barron's take on Anthropic. Let's take a look at this one. Bloomberg reported that Anthropic was planning to match or exceed SpaceX's IPO haul. SpaceX sold 555 shares. I didn't know that. That's funny. Okay, money will help data centers, blah, blah, blah. Recurring revenue. Business's current state, big number. Yep. Well, oh, here we go. AI computer. SpaceX ended with 1.4 of compute. I'm pretty sure Anthropic is somewhere between 1 and 2 billion, which means their revenue per gigawatt is between 65 billion to 32 billion. And that's really important because if their revenue per gigawatt is only 32 billion, if they have 2 billion or 2 gigawatts secured, then that's not enough to pay for Elon's costs. So that's no bueno. Capital spending will stop 1.3 trillion over the coming 5 years. Yeah, well, that's the other issue. Is how is SpaceX going to finance 1.3 trillion over the coming 5 years? Wow. That's actually a much higher estimate than I thought. That's like $1 trillion more than I thought. That's insane. Hold on, we gotta write expectation versus reality down here. And I don't think that's going to end up being reality. Call me a little jaded here. But yeah, so for SpaceX, my take on SpaceX, and let's actually pull up their financials for a moment just so we could see it more clearly. I want to say we've got like $80 billion of free cash available. But let's verify that. So it's always nice to just go look at the document. All right, here we go. So balance sheet. I've got $87 billion to work with now. Okay. So let's screen grab this from the SpaceX docs. Okay. So the SpaceX stock, this is going to be 86.9 billion of cash available now. My opinion is to get to 10 gigawatts of compute, they'll need to spend 500 billion, basically 50 billion per gigawatt is my estimate for them. Maybe they'll be able to do it more inexpensively. The current compute that SpaceX has per that journal piece is SpaceX ended the second quarter with 1.4 gigawatts of capacity. All right, so let's grab this. Oh, I hate that I highlighted that poorly. Does that bother anybody else too? Like when you highlight, you miss a letter? Oh, it's the worst. Okay. So jotting this in here, if we're at 1.4 gigawatts now equals, what do we have left to do? Well, 1.4, 10, that would be 8.6 to go. 8.6 times 50, that's 430 billion to raise. 430 billion more needed. I previously calculated 414 billion, below. So to get to 10 gigawatts. Okay, Wall Street Journal, though, is projecting 1.3 trillion in SpaceX CapEx between now and 2032. That's basically $900 billion more. $900 billion more than I expected. Like, that's a lot. And if you look over here, the current off-balance sheet commitments are $3 trillion. That's basically a third of it. A third more, potentially, right here. But I think a lot of this will end up being on-balance sheet debt. So you have to think about this as in addition to, since a lot of SpaceX's will likely show up on balance sheet as actual debt, that's another, 1.3, well, probably 1.2-ish trillion of debt on balance sheet, plus the, 3 trillion off above, and obviously whatever other debt the other companies have. That's a lot. Plus debt from others. I mean, we'll be at $10 trillion of debt for AI. Isn't that the size of what the housing bubble was? I want to say the size of 2008 housing bubble debt in trillions. Let's see what it was. Oh, dude, that's freaking scary. Look at that. During the 2008 financial crisis, total U.S. mortgage debt was $10.5 trillion. Well, 2008 peak mortgage debt. 10.5 trillion. Oh, don't worry. It's all fine. It's all gonna be okay. Oh, man. What a mess. That's actually wild. Okay. All right. So that was Barron's that reported that? Yeah, that was Barron's. Oh, that was clutch. Yeah, that's not very sustainable, frankly. That's crazy. Trump-fueled rally that won't stop. Yeah, a lot of crypto stocks are going up too. You know, Coin and others. And it all started the 19th. I still think it has a lot to do with Besant kind of doinking with the bond market. They don't want to see the government doinking with our bond market. Let's see here. Tesla's ready to launch the EV Semi. Oh, is that actually true now? Because we've heard about that for quite a while now. That we're not gonna. It's around the corner. Let's see here. Is Tesla going up right now? Let's go see what we got. Because the Qs are up 5 bips. Looks like we're trying to bottom out there. Oh yeah, Tesla's up. Look at that. That's nice. Big line right here at 347. We just broke through. That's good. Look at that. We got all the way to the 295 line there for a hot minute during the Leofold disaster. But then again, a lot of stuff really sold off on the Leofold disaster. That was pretty aggressive. So, okay. Let's go take a look at yields as well. So now, the 10-2. Do we have the 10-2 spread here? Nope. Okay, 10 years at 4.72. The 10-2's at 50, almost exactly. Both have been rising, the 2-year and the 10-year. But that's still shock level. Less ideal. Okay, we got the PMIs. Let's go. So what do we have here? Semi-truck at $300,000. 50,000 units might generate annual sales of $15 billion. Tesla Semi can cost as much as twice as a diesel truck, but Tesla estimates the fuel savings will make a significant difference in the years of operations, especially in places like California. Yeah, you need the infrastructure. Although I do think they're building out more of these semi-truck charging stops. So where's the note about them actually... Oh, here. Specs and details for Semi in Europe to be unveiled in Hanover, Germany. Ah, yes. That's cool. Oh. It's just like literally a little teaser. Yeah, well, that's no fun. Okay. Well, fine then. Although we could also see if Elon said anything about it. Let me see, because he often replies to this stuff. Elon. Starship is sci-fi. No, more Starship talk. Although he tweets a lot. And you'd have to go to replies, too, to kind of see it all. Anyway, okay. Let's listen to Bloomberg for a sec. See what they got for us.
Probably expecting more answers. We'll see if we get them. It'd be upside surprise if we do. But I think as a fundamental investor and as I work with all of our PMs, the thing that we try to stay focused on with all the craziness going on is what you can control. And I think, you know, looking at companies from a bottom-up perspective, really understanding
blah, blah, blah.
what
this
companies...
boring. All right, whatever. Okay, let's go see what else. So... This is Barron's. We just had their take on AI, which was really interesting. Their take on Micron could be interesting as well. Micron CEO was just over on CNBC yesterday. Of course, Jim Cramer was pumping it up. So, let's see here. Let's go jump into... Micron for a moment. Micron. It's been a minute since we've looked at Micron. Well, maybe not that long, but it's always nice to get a little update on what they've got. So, Micron, I'll pull up their IR page as well in just a sec, but the Q's basically flat now. Tesla's still up 3.4. Here's Micron, 972, really hitting that ceiling at about 1,019. We just hit that again here on the 17th. The low we hit was still above the 100-day moving average on the Leofold day, which was about 733. SanDisk, I think, is recently off its more recent high as well, but I think there's some recovery today. Let's go take a peek here. No, yeah. got rejected at 1836, almost exactly. That's actually pretty incredible. You can copy these fibs if you want. This is just from top to bottom on Leofold. And we exactly rejected. Well, by exactly, it's within, I mean, that's within 0.5% right there. That's pretty impressive. Okay, so let's go pull Micron. Good old Micron, the SEC filings. Let's go see what there is. It says, looks like yen carry trade is cooled down. Yeah, one thing you're noticing too is the USD. Let me pull up. You've seen, this was your intervention right here. Down to 157. We've given back, you know, a couple bucks of that as of August 18th. Though recently, because of the U.S. Treasury intervention here on our side, it actually helped bring that that yen into a more powerful position because the dollar lost value. So you get Bassett doinking with the stock market, and then all of a sudden the dollar loses value. I always like looking at U up if you ever want to track the dollar. This is the bullish dollar ETF. But it gives us a little bit of color into the longer term trend over here. So dollar had really been strengthening between 2021 and we peaked right when Donald Trump was elected, which is kind of interesting that you got a peak right there. Probably because, you know, tariffs and all the nonsense had their impact. These lines are actually pretty incredible. This divergence we're getting here, if I were to extend this, it almost looks perfect as now a ceiling for the stock. I've had these lines here forever. The lines! The lines! Okay, so yeah, Moderna keeps pushing. It's now up at 14%, $150. Moderna is also just such a small company in the pharma space. If they can really pull this off, if they get approval for their drug, it's going to be a game changer for their earnings. Because they're still I mean, Wall Street expects them to lose money between now and the end of the decade. And so how do you even run a valuation on a losing company? You just have to basically underwrite hope. Although the hope looks really well placed right now after the progress on their trials. That cancer drug is very interesting too because it's in partnership with Merck on you know, their immunotherapy products, and it'd be kind of a game changer if you could really get molecularly custom cancer drugs to specifically target the specific cancer a certain person has. All right, let's go look at Micron. So Micron 821, and you know, with the help of AI, helps sort of, I guess, justify some of this $10 trillion in debt. Oh man, it's kind of just a scary comparison to 2008. It's not housing this cycle. Now I was joking this morning in the course member live stream. I'm like, you know, there's a report now that Manhattan rents are at the highest level they've been ever, as more people are renting, fewer people are buying, and wow, there's lower supply. And, you know, the joke is that's what we said would happen if Mondani would get elected. Of course people don't want to buy, threatening more taxes. Obviously, it's going to be harder and less desirable to build. And so, wow, what a surprise, rents go up. And his whole campaign was, oh, we're going to, you know, lower rents. It never works. It's almost always the opposite of what the government tells you is going to happen, is what happens. Anywho, let's go take a peek at Micron's margins. So the explosion in revenue is just fantastic. I mean, you're basically a 10x on their gross margin, which is ridiculous. And their operating income is, you know, 33.3 divided by 41.45 equals 80% operating income. Like, this isn't like a software company that has 75 or 80% top line and then they bring 30% to the bottom line. No, these people are basically bringing 80% to the bottom. Obviously, you know, before taxes. So this is just really incredible. Let's see what's going on over here. Oh, that's nonsense. Okay. So really incredible margins. And what the big concern is, are they going to be able to get out of the cyclical nature of boom and bust for memory? You go back to 2023 and mostly 2022, these folks were losing billions of dollars. So, how much of this has now hit peak? I would say we probably pull up the earnings call, but I know SanDisk is projecting only 14 or 17% unit growth. I found that to be pretty low in the SanDisk call. Let's go grab Micron's earnings call. Markets are going to want more than that. And markets have been really propped up because pricing has just gone parabolic for storage bits and memory bits. But SanDisk forecasting volume growth of only 14 to 17%, somewhere in that range, maybe 16%. Really means in order to keep growing, you need pricing to keep going up. And I don't know if it's going to keep happening. All right. Micron earnings call. August 21st. All right, let's go see what we have in Micron. And really what I'm looking for is just the growth that they're projecting. Data center growth will be driven increasingly by AI-enabled features in smartphones, high-end PCs, blah-de-blah-de-blah-de with respect to supply, storage. We expect to see supply gradually improve in 2028. We do not have line of sight into when memory supply will be able to catch up with increasing demand. Of course they're going to say that. Imagine if they said, we'll have enough supply at the end of 2027. Everyone would dump the stock. They literally can't tell you that. Like, for self-preservation purposes. So you kind of have to read between the lines to get probably a little bit more reality. But they would self-fulfill their demise if they said that. Growth is expected to be dependent on significant greenfield, fab extensions. Those are basically from dirt up. Long lead times, blah, blah, blah. Okay, yes, we know. So let's bookmark that. Line of sight. LOS! Out of LOS! Gotta get in. Okay. I guess the growth search term isn't working. There we go. Growth. No. Okay, here we go. Technology transitions are driving slower bit growth over time. Wafer growth needs are significantly increasing clean room space and fab requirements. HBM's growth and increasing trade ratio with every new generation puts pressures on non-HBM supply. Let's see here. Long-term demand growth, structurally constrained supply growth, and memory strategic importance have caused customers to recognize product ramps, blah, blah, blah. Okay, this is marketing. Growth, 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 growth. AI is driving unprecedented growth. Oh, here we go. We now expect calendar 2026 industry server units to grow in the high teens, above our prior expectations of low double digits. Right, okay, so high teens. I don't think they mean high teens percentage above what they previously said. I think they're saying it's going to grow in the high teens instead of what we said previously, which was low double digits. Driven by mid-teens growth in traditional servers and even stronger growth in AI accelerators. Why don't they give us the percentages there? So average of high teens, basically. Okay. Average traditional and AI server growth in mid-teens, and then undisclosed AI server growth rate. It's just not useful. But this shows you how much of their growth relies on pricing. So what's the forecast right now? If I go look at their earnings per share, for example. So Micron EPS is, let's see what their forecast growth is. Okay, here we go. Micron forecast growth is 108.4, 10.7, 5.7, minus 14.3. Yeah, so we're expecting 27.6% average growth over the next 4. Average growth the next 4. And then next 3 will be even more ridiculous, because if I take out that negative, divided by 3, 41%. Next 3 years. So it shows you, suggests memory still has to do more than half of the lifting or pricing to get to these EPS estimates. So that's the challenge. And the challenge is the growth rate turning. Like Cody's asking, how is this not bullish Micron? Well, mostly because people look at the projections, right? So, I mean, here, an easy way to visualize this, I think this is an easy way to visualize it, is you pull up just a really quick spreadsheet of growth, okay? So let's just do it together really quick. Let's go back into the 2023 cycle, whatever, I'll go back to, geez, these growth rates are pretty bad early on. Let me go back to, where is it stabilized? Like 2016. Okay, so we'll go to 2016 growth rates where they're somewhat stabilized. And then what we'll do over here is we'll do, oh, never mind. Growth rate was 0 here. 0, 2017. 2018, 147.5. That's on cloud compute expansion. Negative 49. 2020, negative 55.7. 2021, 113.8. 2022, 43.7. 2023, 0. 2024, 0. Because they lost. 2025, 986. This is on EPS, right? And 2026 was 682. Actually, it's going to be more like 841 is the current estimate. 27, 108.4, 2028, 10.7. You see where I'm going with this? Like, you're at peak growth estimate. That's what pisses people off. 14.3. If I go to, now if I go to operating, well, that's net inc. Let me go to EBITDA. Adjusted EBITDA. So if I go to 2016 for that, negative 1.8, 26.7, 46.7, 28.8, 13.8. Make sure I'm in the right place. I am 22.9, 29.2, negative 34.4, 3.2, 23.3, 56.4. Estimate actually for this year is 64.2, 70.6, 68.7, 64.4, 52.5. That's their adjusted. So we can now chart this somehow. If I could figure out and remember how to do this. Aha! There you go. So basically, you're here on their growth rate. The peak is 2025. Yeah, you're here. Like right in the middle of this. So people are like, oh, why would you not be bullish Micron right now? Look at where you're buying. So for the growth rates. And then these are the forecasts. So obviously that's, with them saying, oh, we have no visibility when supply is going to come, all that kind of nonsense. But that's the current estimate. Let me save that because I do think that's interesting. Micron growth rates. And then we'll be able to, let's see here, throw a little screeny on this. Okay, yeah, there we go. Okay, so we are right here. That's where we sit with growth right now. Micron, current growth estimates. So current Micron growth estimates per Wall Street analyst projections. You know, that's probably compressing. That makes their, you know, current PE and PEG ratio look really low. I mean, if I run the PEG right now, I think their PE is trading for, let's see here. Somebody says, it almost looks like it bakes in increases in capacity as demand falls off a cliff. Well, we can see what the revenue growth is as well in just a moment. But current, we're looking at 70 EPS adjusted, $72. What's it trading for? Like $880, $900 right now? Micron. Wow, the Qs are now down 17 bips. $962 divided by 72.78 estimate. We're trading for 13 times right now. 13x PE ratio. And so the concern is, if the growth goes negative for earnings, that, you know, you have an infinite PEG ratio, basically. Now, as far as revenue, which I think is a fair question, let's go do a chart here where we put revenue in instead. Okay, so what we'll do is we're going to move EPS out, and we're just going to look at revenue for a moment. So revenue, I'll do this in billions. 20.3, 30.4, rounding just slightly in their favor. 27.7, 30.7, 15.5. Wow, that was a tank of revenue right there. 25, 37.3, 90. Nope. Oh my gosh, 129.6. Jeez. 245. Wow, look at that revenue growth expectation. Oh my gosh. No way. Dude, there's not a single dip in how much the market thinks is going to actually be supplied. So the revenue is actually expected to keep going, right? This is the big bull thesis is, oh, well, you know, how could you be bearish Micron? Like, who's analyzing this? It's the earnings. It's basically a perfect S curve if you look at it. And that's actually very interesting. The revenue doesn't project any decline. So we expect to keep going. I expect to keep selling out over and over year after year. No decline in revenue expected at all for the foreseeable future. So that's interesting because it means the market's actually very bullish on revenue. The market is very bullish. The difference between revenue and EBITDA, this gap, is probably due to pricing weakening as supply comes on. So it still indicates a sellout of everything, but it does indicate, even though revenue is expected to keep growing, earnings are not expected to grow at this level because that supply constraint will sort of fade. That's very interesting, though, to look at the revenue, which also means, you know, if revenue were to decline, like it did previously, that would be unexpected, right? So, like, let's look at previous declines on Micron for a moment. There's one right here. and then you've got another one right here, right? So these are your growth rates on revenue. In fact, I mean, we could just calculate the growth rates really quick. There we go. If I do this divided by this equals, I'll run that down. Oh, I should do -1. -1. There we go. And then turn it into a percentage with 2 decimals. Okay. There we go. So you could see here, big negative, big negative, big negative. Let's chart that. It's actually kind of interesting. So those are revenue projections. And I don't know what that's charting right now. So let me just do just these right here. Well, that's not useful. I need to have to normalize these two because one's a percentage, one's nominal. Okay, I don't want to do that right now. Oh, that's probably why it skips that. Oh, I see. It's too small. All right, whatever. But you can clearly see a negative growth rate in revenue is in the history. And look at the growth rate over here, the projection and growth. See that flatlining growth right there? Oh, you know what we could do? Is just chart this. There we go. Those are the growth rates for Micron in terms of revenue forecasts. So now, let's see here. So indicates a sellout with no pricing power. No, I don't think the estimates indicate no pricing power because the forecasts are still a doubling of earnings for next year, 10% thereafter, 5% thereafter. Pricing power isn't actually projected to wane until 2030. All right. So markets expect pricing power to wane in 2030 with first negative EPS projection, but there we go. But there's no negative revenue forecasted, I guess you could say. That's also very interesting. It's just basically, oh, it's gonna, flatline over here, right? And then we are here. So we are here. And then this is no decline forecast, which is actually odd because in history you've been red a couple times before. And this is just the recent history. So if I do this, we've clearly been below 0 before. There. That's very interesting. All right. Like, I don't think anybody could look at the Micron numbers today and find anything to complain about. It's really all about expectations. That's the only issue with Micron right now. So let's drop that onto our AI tab. Let's throw that in right here. So we've got, yeah, these are the Micron numbers. Oh, we could also throw up this is rev growth. There we go. Okay, perfect. So, I mean, there's some conclusions you can draw from this. Let's jot those down. So the first thing is markets are not pricing in revenue going negative. IMO, that's a risk factor, right? So you're not getting that sort of bearish negative cycle pricing. A big concern is always cyclicality with memory, but long-term agreements are being formed to minimize that. Analysts seem to be buying it because revenue is not forecast to go negative, which would imply cyclicality. However, EPS does flatten and growth rates do flatten by 2030. So, you know, you have some a risk in the pricing coming in by 2030, which makes sense with the supply coming online. Seems logical with supply coming online. Okay, so if we go jot that is from... See, this was the server growth rate section, and where was their visibility comment? Here. That was the visibility comment. Yeah, they don't want to piss off the analysts. My dear Lord, no. Okay. Okay, what else can we conclude from that? So, EPS, the growth rates, you know, it's actually, the market expectations are really bullish for continued selling out and increasing revenues. But with their own forecast of a high teens build out in data centers, you really have to rely on shortage pricing to see EPS keep expanding. How would buybacks shift EPS projections? Well, let me see if they've already... Let's see. I'm pretty sure that's already included, but let me look. If I look on my other computer, I should be able to find out. That's a good question. I want to say that's built into the EPS projections because obviously analysts project like, hey, we think you guys are going to have this much in earnings. How many shares do we think are going to be outstanding then? Okay. Let me see here. If I go to, that would be, let me go to the balance sheet. Balance sheet, common stock, where is it? That's going to take me a second to find. Treasury stock, where are they? Shares outstanding. Shares outstanding, oh, they don't even forecast here. Maybe not. Yeah, that would be fair. Let's see. Yeah, I don't see a forecast here. So that would be interesting. Okay, so that, I'll write that down. Unclear. How am I going to do that? It would seem logical, but it's not clear. So I'm going to write that down. Unclear if buybacks are considered in EPS forecast. If they're not, that could be more bullish, right? That's helpful. Okie dokie then. Okay, cool. All right, great. So let's see what they say about buybacks in here. No, they don't. What about repurch? Nope. All right, whatever. Let's see what's going on with the Doomers.
Still on track? Is it still possible?
Absolutely. A lot of people don't know that they listen to the Trump administration say it's a block of ice. Sure, Greenland's got a lot of ice on it, but where we are in southern Greenland, probably the lowest it gets is -5 Celsius.
Why are we
You
talking
get
about
colder in New York and Chicago and Toronto than -5. In summer, it's
whatever. Oh, we're talking about Greenland again.
Koozie has been wonderful.
Oh my gosh,
Everything was
that's fine. Okay, what's going on over here? I'm just looking at the wire tab over here. Prince Harry and others ordered to pay millions over failed lawsuit. I don't really care. NVIDIA invests in data center developer Cloverleaf Infrastructure. Oh, that's cute. Okay. Let's see here. Anything else exciting here? Well, I see very exciting things here. It's okay. I'll keep an eye on it. Sort of off to the side. By the way, you're welcome to use that Alpha Wire as well. Just download the Meet Kevin app in the Apple or Android App Store, and you'll see it there, which is pretty exciting. Qs cannot hold on today. Can't hold on. But Moderna keeps going. Look at that. The technicals keep moving up. It's a juicer. Let's see here. Okay. So what else here? What else? Oh, Google is. I want to compare this to where our boy Buffett was. So Buffett. Yeah, but I think Buffett was at about 359. So you're still actually pretty close. You're really approaching this 331 line. Really kind of stuck. You know, Amazon had been stuck for a while. And they had a nice little breakout recently, but you can see they're coming back to that 254 level. Okie dokie then. Let's go take a peek at... Let's see what we've got. Okay, so... let's go see if there's anything interesting to peek at over here. Yeah, see, look at this. Manhattan rents hit all-time high. We gotta look at that. That's hilarious. The great rate debate. California wealth tax will drive innovation and entrepreneurship out of the state. Oh, 100%. Yeah, I mean, I think people are almost just like looking at this point for a reason to leave. Anything on Iran? Let's see. I don't think so. Let's go to... Because we were supposed to get this big announcement of all of the economic pain that was coming for Iran. And we don't see it. Nope. Nope. This is the only thing I see right now. This is on Bloomberg. Iranian president calls for end of war while terrain is ahead. It will be better to end the war today when we have the power and the dignity and the whole world is acknowledging our victory. Yeah, it's kind of embarrassing. As comments come as the conflict shows no quick sign of resolution. Yeah, when are we going to get the Besant plan? That would be very interesting. Because we were supposed to get this plan this week. Well, it's Friday, and there's no plan yet. Yeah, probably at 4:05 we'll get the update. Yeah, probably. I mean, they've already done enough to the, they've already done enough poopy-doopy, if you will, to the market here with this bond intervention. Let's go take a peek also at just yields quickly. So, yields. Yeah, look at that. Up even more now. 4.736. That's remarkable. Okay. What we got over here? Listen in here.
That range. A lot's being written, David, about his credibility when it comes to his hopes, at least coming into the job, on the budget deficit, on oil production.
This just came through. Ken Griffin says Citadel unwound more than 80% of the risk tied to situational awareness portfolio. Wow. Dumped all the, basically made the quick gain and dumped it.
And the tariff sort of shakedown back and forth, and we'll see how that comes out in 26. But I think the trajectory is still there. I think the growth numbers, as the Atlanta Fed points out, look like they're pointing back up. and the trend in the deficit to GDP, particularly because the denominator more than the numerator. And let's see what they can come up with. He said there's a big push with him and the OMB director to do some serious spending cuts. Those are hard to get through, but you know, I'm optimistic. And again, look, I want to go back, Carl, and repeat what I said before. Everybody's running around with all these scare scenarios on debt and interest rates and things moving, you know, in an out of control, non-credible way. This is one of the tightest ranges in 10-year treasuries that we have seen in so far in the administration since the election. In over 20 years.
Straight up.
So it's just not really true. It's not running away from anybody.
But
I don't know if he's right about that. The tightest ranges? Dude, what are you smoking? I mean, I guess you could say the tightest top. You know, like if I draw a giant square around this, I guess I could call it the tightest range. I mean, I think what they're doing is they're basically saying, oh, well, Trump got in around 4.61. It's close to that now. Yeah, but it's still, you know, we're at basically the top 4 peaks in the past, 40 years or whatever. If you look at, 1 peak, 2 peak, 3 peak, 4 peak. So, it's a little Trump shilly, huh? say no bad about Donald Trump. That's funny. Okay, cool. All right. I'm gonna change the channel. Okay, we saw that ground brief. Let's see here. Okay, we saw that Besson. Nope, yeah. I'm watching the wires on Besson. Nothing there yet. That's all right. Let's go take a peek over here. Okay, so this notes, yields extend rise as services and composite PMIs beat forecast. Yeah, we saw that. That was honestly a bullish report. So it's like there really is no canary in the coal mine yet, so to speak. The bullishness is still coming through the data, which is good for now. Obviously, you still have J-hole and the nervousness around that, but that's really just between now and next week. But I do think it's interesting that if it's true that Ken Griffin and Citadel basically just dumped the situational awareness portfolio, because they had a lot of Micron and SanDisk, memory and AMD exposure and all that. So maybe that helps explain some of this move off of highs over here, which was probably around here. There was around liquidation. Honestly, they probably took their gains within the next couple days. Like, we don't need to hold this. Just a quick exit as other people start buying the dip. Use that as an opportunity to quick exit. Yeah, it would make sense. Let's go look at Hood. What's going on with Hood? Oh, wow. Look at Hood. Oh, you know what it is? It's crypto going up. So when crypto goes up, pretty much when Bitcoin goes up, pretty much all of the beneficiaries of crypto trading do well. So like the Coinbase, stablecoin, obviously Robinhood. That's got to be what it is. Although let's look. And I also wonder what we've got for a fair value here on Hood right now. Okay, let's see here. Okie dokie. So, I've got a fair value of about 103. I last looked at it on June. Moving average has done well. It came off 69 really nicely. At 69, it had some really nice upside, obviously. 40, 50-ish% upside. But it's gotten a little more rich here lately. Let's go see. Their balance sheet should be better than this. I'll have to check. Subscription, margin expansion. Yeah. All right. So that's Hood. I want to see their forecast, though. Let me find out. Hood. So, EPS forecast. growth expectations for Robinhood earnings, 2.13 this year. I mean, the next few years are expected to be like 25-ish%. Although for some reason, I'll just go with the 3-year. For some reason, they're showing negative 3% for 2030. But if I do divided by 2.13, current share price divided by 2.13, it's trading for 50 times earnings. Growth over a 3-year period is expected to be 28%. That would give it upside. But if I do all 4 years, and this is going to be where that comes from, divided by 4, growth is expected to be 20.8. So 50 divided by 20.8. Yeah, basically right at fair value if you incorporate that 4th year of earnings estimates. That's how we're arriving there, in part. So you need growth not to curve out at the end of the decade. That's part of what you're seeing there. Okay, interesting. Well, they're talking about Anthropic here. Let's take a listen.
Of the LP community, it was important to get somebody technical who understood what was going to happen to give these pension funds and retirement funds and so on.
I'm going to get some more coffee while we listen.
To this extraordinary wealth creation opportunity, which, by the way, is not Anthropic specific. It's a whole ecosystem. Since then, I've made multiple investments in the Frontier AI ecosystem, including OpenRouter, which we just sold to Stripe, this week. And there's extraordinary wealth creation, but I was really frustrated by 21 of those 22 institutional firms who were supposed to be stewards of capital just failed. They're just a miserable failure, right, of judgment, of professional upgrading. They weren't upgrading their skills fast enough to understand this technology. So that the punchline is we need a reset in the venture capital community. For whatever reason, the existing set of leaders are just not staying fresh enough. They're not updating their skills, and they've let down a whole generation of LPs as a result. I mean, if you look at Anthropic's cap table, and if you look at a number of other Frontier AI labs as well, the institutional venture capital representation in these cap tables is a joke.
That's really interesting. I mean, I want to ask more about it, but first I just have to ask, because I think everyone in our audience will want to know this. You're still invested in Anthropic, right? You held on to your stake, you didn't sell?
I did not sell. In fact, I think I've tripled down, quadrupled down since then. It is our single largest portfolio position at AMP. AMP has a venture capital business called AMP Foundry. It's our largest position. I can't share publicly how much we've put in, but let's just say we're a meaningful investor. I mean, this is public. If you look up Anthropic's last 2 rounds, the Series G and Series H, were mentioned there, and if anybody's selling, I'm still buying.
Wow, their IPO is going to be a good day for you. And can you talk about what this does to the ecosystem, though? You were talking about the wealth creation, what it does to the VC ecosystem, to have these mega IPOs come and to be sitting on these huge paper gains.
Well, I think the paper gains are turning into liquidity pretty fast, right? That's what I'm pretty confident that I'm actually really excited for the public markets to get some access to these equities because they are much more rational than venture capitalists. Traditional venture capitalists think that they're good judges of technology and fundamentals, whereas what I find is retail investors, public market investors understand math much better. I mean, the Anthropic business is very simple. I love simplicity. We take $1 of compute, we turn it into $10 of intelligence, and that's it. And we just rinse and repeat. It's just scaling laws. And I think the public markets are going to reward this beautifully, and I think the liquidity will then traditionally flows back into the ecosystem now to the next generation of firms, right? As startups, the cycle of...
All right. I don't know. This guy's a little boring. Go see... Let's see here what's going on. Okay. So, let's see here. Where do we stand today? Back to green a little bit. Let's go hop in over here. And let me see what's going on here. Okay. So, give this a second here. What is cooking over here? Let's see. And then we got to do a little bit of recapping on some of these things here. Okay, so let's see. Let me see if I can... I hope I don't break anything. Okay, there we go. Okay, cool. All right, great. So let's see. We have this guy was pitching his VC. That's great. That's cool. We've got we did some Micron analysis. We did a little bit of AI analysis. I think we'll have to do a little bit of summarizing in a little bit, but let's go to the information and just see if they have any extra juice for us. So sometimes they do. The information is also often where you get some good old Tesla leaks. I always think those are fun. So NVIDIA plots China come back with new chip, enterprise AI venture, buys consultancy, new robotics arm race. Who could do the craziest hype video? Well, that's another thing that you're seeing a lot of is frankly massive hype around, oh yeah, what can these robots do? And then you sort of pre-program what they can do. Some of that is a little misleading, obviously, because, you know, you're not going to have a robot that's just pre-programmed to, you know, do dances for you. It's actually got to be functional, but it does show off the technology of the actual hardware. But then also the question is, how long can that hardware last? That's the big issue. You could do a cool demo for, you know, 10 minutes, but can it run for 8 hours? You know, let alone 24 hours. NVIDIA, let's see here. Licensing and hiring deal, AI model, let's see here. We talked about Walmart. We've talked about Walmart a lot historically. Robots. Robots are in their GPT-2 era. I mean, that's actually probably a fair way to put it. AI-powered robots aren't so good yet. They struggle with a range of simple tasks from untangling cables to chopping vegetables. Nonetheless, morale is high amongst robotics who are flush with venture cap. Well, I want to see that Unitree IPO was really hot, apparently, which makes sense. Our venture capital fund has money in Aptronic. Let's see here. China... Humanoid robot leader soars in market debut. I wonder how they're trading now. Unitree Robotics. Okay, so their ticker is 68836. 68836. I wish it would just show me the stock chart, but it doesn't. Okay, we'll just pop it open. Oh, here we go. I can get it on, it looks like TradingView has it. I wonder if Webull has it. Honestly, Webull should have it. It's on the Shanghai Stock Exchange. Okay, 68836. 68836. Unitree. Oh, yeah, we got it. Okay, cool. So here it is. Here's the Unitree. Oh. Oh. This is the thing about IPOs, man. It's like, that's probably the fate for the Anthropic IPO as well. And I always hate saying that because I don't want to come across as bearish, but dang, come on, man. What the heck? So, but Unitree's got some interesting products, like quite a bit that you could actually buy. Of course, that's what they pitch, you know, whether or not people are actually functionally buying these and getting deliveries of these. I mean, this looks pretty wild. But anyway, if you go over here, look at these. You've got these dog robots, apparently, you can get. Oh, that's hilarious. Ben. And then it says bullish under it. Okay. Yeah, you got a lot of these dog robots, robotic arms. You also have the humanoid versions. Look at this. What kind of humanoid do you want? 2 humanoids or 1 humanoid? Look, then they've got this one. It's like human on the top, but robot on the bottom. I mean, it makes sense because, you know, if you're going to go lift a bunch of heavy stuff, these robots might have some serious balancing issues. Like, who needs this? I don't know. Some of it, like when I see like the Transformers boxing robot, part of me almost thinks it's like a scam. Like, that just looks ridiculous. Wow. They're trying to pitch their hands. I think they're trying to say, hey, Elon, come buy the hands. I know Elon's obviously building out his own, but that's always been a source of complaining. Ooh, I like how that, look at that. As you mouse over it, the image gets a little larger. That's kind of cool. It's like just in case you weren't interested enough. Yeah. Oh yeah. Look at that. That's ridiculous. Wow. Well, good for them. I mean, I think they raised quite a bit of capital. Let me see what they raised. So they achieved a market value of $51 billion. I wonder what, I don't know that it's going to, market cap. Here it says 271 billion. So is that in the other currency? Probably. That's, yeah, because it doesn't have the dollar symbol here. So that's probably it. Let me see. What's the, because the exchange rate is what, $7? 251 to USD. Be about 37. Yeah, that's probably what it is. See, 251 Chinese yuan translates to about 37 billion US. So, and given that it's come down off of its high of 1100, 672 divided by 1100. Oh, come on. Calculator button's getting stuck. That was down about 39%. 50 times 61. Oops. 50 times about 61 takes me about $30 billion, which is, yeah, close to what we just calculated. So that's probably what it is. Okay, got it. Wow. Unitree IPO. So market value 51 billion, now in the 30s. U.S. banned most imports of humanoid robots, citing international security threat. For its part, the Chinese government has identified embodied artificial intelligence robots that apply AI to the physical world. Right. Last year, Chinese companies shipped thousands of robots. I think China does the vast majority of robots in the world. Unitree robots are already familiar to hundreds of millions of Chinese owing to their appearances on national TV, right? The performances and stuff that they do, that's fine. Unitree IPO was the most oversubscribed ever, with nearly 9.8 million investors seeking a piece of the company, with fewer than 5,000 achieving success. Are you serious? So basically, they underpriced it, as they usually do, to gain attention. Everybody wants in on the underpriced IPO. Nobody gets allocation. So then they try to buy when it opens, but anybody who buys when it opens ends up getting screwed and buys at the top. RIP. Most popular model sells for $12,600. Guinea pig. Those are the smaller, probably like dog-style robots. Yeah, look at this. This lady's doing the Quilla DeVille walking her robot dogs. So their revenue, Unitree's revenue is 1.7 billion. What is that, about $240 million? I mean, that's still pretty good. If they're bringing in $240 million in revenue. Let's see what the oh, I can't. Okay, great. All right, we'll look at that at a different time. Okay, cool. Let's see what else. Was there anything else on Anthropic here? Applied AI, Marvell. We saw that. Marvell had a big pump after the Google warrants announcement, which isn't a surprise. The goal for a lot of the companies, like Google, especially with its TPUs, is to get as many people manufacturing these chips as possible. They've got a big shortage of TPUs. Talk about a shortage of memory chips. They've got shortages. The compute chips. Okay. What else? Let's see. Iranian president calls for end of war. We saw that. Alaska plane crash that killed 8. What's this? Which one was this? A Cessna 441. Oh, this was recently, huh? I wonder if there are any. Sometimes they got you could see these on X. Sometimes people have footage of what's going on. No. Just the aftermath. This is a twin prop. And, you know, somebody told me once, and I thought it was such a great line. They said, flying is very safe, but also very unforgiving. I think that's a really good line. You know, it kind of makes sense, because when the birds go down, they don't tend to do well. Oh, wow. Here's this is an older video. This is unrelated. But here's somebody bouncing a 441. This is so you can see what a 441 looks like. Oh, man. Look at the wing vortices right here. Look how cool that is. When it hits the ground, you can see the dust shows you how the air flows off of the wing of the plane. But this is so dangerous. The porpoise. Anyway. All right. So, get off aviation here. Alrighty. So, let's see here. Politicians who once championed data centers are now bashing them. That's true. You've got Greg Abbott, who's being remarked over here about this, talks about auditing all of the data centers because of the energy usages. Mostly because most of your voters are concerned that, you know, energy costs are going to skyrocket because of these data centers, which many of them are trying to bring their own power in, getting their own gas turbines or whatever, or even like Bloom Energy. I wonder how Bloom's doing right now. Let's go see. BE stock. So BE, yeah, they've really retraced. I mean, we really topped out on a lot of AI hardware names in June. And it's so weird because so much extra capital is coming to these, especially after the Anthropic IPO goes public, you know, which is now just talked about. I mean, they're talking about it right here. There's just going to be so much more capital flowing to these.
And at what valuation? That's another question. So you mentioned that Anthropic had been valued at $965 billion. So in an IPO, do they get to 1 trillion? Do they get to 1.5, 2 trillion? So those are all things that the bankers and the lawyers and the company, they have to figure this out, to figure out the support from investors at what valuation, you know, can support this deal. But it's really exciting for the IPO market, which always opens after Labor Day. And we'll be following when this S1 finally hits, and we'll get a look at all the financials for the first time.
Right. Yeah. You know, Anthropic should have a lot of cash on its balance sheet. And so the question is, why do a big IPO? And Shireen, you spoke on stage, right, with Daniela Emode, the president, co-founder of Anthropic, in June, and you just put this question very directly, why an IPO? What was the response at that time?
Yeah, an IPO offers a repeatable process to raise large amounts of capital. Again, if you think about the incredibly high cost...
You just keep going back and issuing shares.
AI model at the cutting edge these days can cost billions of dollars just for one model alone, potentially. So, you know, that's just sort of the state of play right now. So her answer was that we need to be able to raise money when we need, and IPO provides that process.
Liana, I do want to get into the process. I went back and checked my calendar. From the time SpaceX flipped its S1 public to IPO day was about 23 days. And like, you know, I have a bit of shell shock from that period of time. I'm sure you and the team do as well, of how it transpired. But it happened very quickly. So we're reporting that Anthropic might flip its S1 public by the end of this month, September. What happens? How does it happen?
Sure. So you mentioned that Anthropic is already on
end of this month or end of September.
is get their ducks in a row to make this public with the SEC, and if they want to get on the road show, to get on the road after this Labor Day period, you know, analysts are saying this filing could hit as soon as next week. We haven't reported on a specific timing. We said it could be within a few weeks, but it wouldn't be crazy to see this next week because, as you mentioned, you have 10, 15 days, maximum 23 days. You know, this all happens very fast. And IPOs are all about the market conditions. So SpaceX, sure, it's trading a little below, its price, but it's still a massive company.
Below its IPO price is what she's saying.
Okay, it wasn't a total disaster. So if you're another company waiting in the wings to go public, you see that.
True. I mean, it could have gone way lower, right?
And then don't forget also OpenAI is also keeping an eye on this. So
Right.
Anthropic has that to think about too.
The top line of our report, Anthropic is seeking to match or top what SpaceX raised, and on a valuation basis too, in the weeks to come. But also point out SpaceX just in the last 10 minutes went above $135 a share, its IPO price. Bloomberg Shireen Ghaffari covers Anthropic. Liana leads the team on Bloomberg Deals. Thank you so much. As Anthropic...
It's true. This morning it lost the 133 line, and it's already recovered it. It's back at 136 now.
Data privacy. According to a Bloomberg source, Anthropic plans to give businesses more control over where their data is stored when using its AI models, particularly its frontier models. Bloomberg Tech managing editor Sarah Fryer is with us. Really important piece of reporting, because Anthropic has been given so much credit for its commercial progress. But this was a key concern customers had. Explain what we're detailing in that report.
Well, customers were concerned about Anthropic retaining their data for a few reasons, but probably most of all because then Anthropic has their data and can train on it. Of course, Anthropic said that it would not do that. They said they wanted to retain the data in order to guard against cybersecurity threats after some of the concerns earlier this year about potential breaches of customers. They said, we'll retain the data for a while to make sure that everything is fine. But of course, that was not a popular plan with its customers, and it's deciding to give back more control.
Anthropic declined to comment on our report, but it ties very closely to what's happened in recent weeks and months. Models acting outside of the instructions they've been given, and the focus on the race with OpenAI has been about enterprise, right, and ARR.
And that's exactly where OpenAI has come in with their Codex plan. And it'll be really interesting to see if Anthropic can actually keep their growth rate going when there is so much competition coming. I mean, Elon's chomping at the bit to get into the enterprise coding, API biz.
You have OpenAI, they're trying, and even SpaceX, they're trying to do things to cater to those enterprise customers that Anthropic has. It's still a very early market. And so they do need to think about not just what do they think is the right move for cybersecurity, but balancing that against what their customers expect and require in order to retain those customers.
Bloomberg Tech editor Sarah Fryer, thank you so much indeed. Now, coming up, Broadcom's looking to raise more than $60 billion in debt. We're going to break down one of the biggest bets yet on AI infrastructure. It has a very complicated structure that the team are going to explain to us. This is Bloomberg Tech.
So I'm just reading that there are some incentives for the Tesla Cybertruck, potentially of up to $120,000 in California. That brings down the cost of those semis a lot, because that would almost put it at parity with the other vehicles. So, the current estimate is that they'll be able to sell 36,400 units by 2030, which represents about $24 billion in sales. If we're at 20% margins on that, 24 times 0.2, be about $4.8 billion bucks. But that's over multiple years, so that gets divided. Automotive, margins 20%. We already know that. So what is this? Let me see what the detail is here on the $120,000 figure, though. So this is a stacked incentive program, California's primary point of sale discount program for zero emission commercial vehicles, reducing the upfront costs for battery electric trucks like a semi. Other mandates, state and federal programs. Yeah, it doesn't actually give you. Oh, but there are vouchers you have to get. Okay, so it's a CA voucher program. Only 5 have been issued out of 1,150 applications so far. So it's kind of early, but it kind of makes you think, could the next frontier for Tesla be the semi-truck. Let me see what the specs are for the vehicle, because the biggest concern people have is obviously the range. I'm going to write these notes down and we'll kind of look. I'm actually writing these down on the spreadsheet that we made for Tesla and SpaceX. So let's write down some of these notes. So this was, let's see here, faster Excel than diesel, basically same innovation we saw in cars, right, with the electric powertrains. The torque is just amazing. We are looking for 300 miles of range versus 500. Why would you not get the 500? That's the expectation, at least. We'll see. You know, and them teasing the announcement of it is very exciting. Cost per mile is where the enthusiasm comes from. Cost per mile expected at 31 cents versus 67 cents, which, you know, eventually that, especially if you get tax credits up front in California, that's great. And the FSD will come. Like, we don't even need autonomous. FSD, like fully autonomous, right? Fully autonomous. FSD is so freaking good. It'll come and be amazing for the semis, you know, once they get the data for these bodies. So it's pretty exciting. I don't think it like materially changes much. Excuse me. But what it does is it creates some enthusiasm again for the stock. So present value of the stock, I think it's like 350 right now. 350. And if I look at this as Tesla only, if I bump their operating income, see, even if I come here and bump this to like $3 billion a year, how much does that change the price target? About 30 minus 3, $27. So there's about a $27 delta in what it's worth to the stock by about 2030. Worth about $27 to the stock. It's about 10% actually. Well, almost. It's more like 8% now. It's actually not bad if you think about it. That's you know, that could be why we're seeing some of the enthusiasm here with Tesla now up 5%. And you're really coming off that Leofold area of pricing, which also makes sense. I mean, that was a little overblown. Okay. So okay. Cool. Okay. Oh, here's the Broadcom note.
I think we've seen this before, right? You look at things like aircraft leasing has happened in this way. You think about data centers now. I think this is kind of the evolution, and people are thinking on the fly with these kinds of structures.
And in a lot of parts of the
This
market,
is the Broadcom SPV.
From the equity perspective, Broadcom up a percentage point following the report. Bloomberg's Ryan Gould, thank you very much. That Broadcom deal gets right to a bigger concern overhanging the AI trade. The cost of funding it all, but record debt issuance, higher rates, growing pushback on data centers, particularly in this country, all raising fresh questions about how quickly the build-out can pay off. Delighted to welcome back to the show Erica Klauer, a founder, CIO, CEO of Science and Technology Partners. Let's start with your interpretation of the reporting about this vehicle that Broadcom has set up.
Well, thanks so much. Lovely to see you this morning. And, you know, this is an extension of what we've been seeing for the last several months, which is extraordinary levels of debt coming to the market to build out the AI infrastructure. And the market is having some indigestion with dealing with all of this debt. Just to wrap some numbers around it, it's quite staggering. We've had over $220 billion of debt issued so far this year, which is up more than double from 2025, and that's just year to date. And of course, in 2024, the levels were just about 20. So this is quite a big jump. And not only is the debt quite expensive, but there's so much of it. So it's difficult to find homes for it all. The coupons have gone up. And so many of these companies are now having to face much higher borrowing costs than they had initially anticipated maybe 6 months ago.
The reason that I wanted to get you back on Bloomberg Tech, Science and Technology Partners, a long bias fund, just zeroed in on the corners of the technology market we care about most. Eric, you're coming at this at a cost of capital lens, right? For lots of people, they go straight to the circular financing question. How do you feel about that side?
Well, I think it, of course, is a concern because to offer financing to a customer and in turn expect that they will be buying your products is indeed circular financing. And so I think that this is a legitimate concern for all investors as they are examining these deals.
In the United States, particularly ahead of the midterms, there is a lot of societal debate about the impact of data centers, and there is action to push back against specific projects. Do you have to model that into your outlook for CapEx, for growth of data center?
I think this is such a good question because this gets at the heart of why we're seeing so much volatility in the market. It's not only that the cost to build out these mega AI infrastructure facilities are going to be higher because the coupon must be higher in order to get it placed, but also one will be carrying that more expensive debt most likely for longer because of two key reasons. One you just mentioned, which is that in states like Pennsylvania, New York, Texas, there are data centers that are facing whether it's regulatory or community concerns that are delaying some of the facility build outs. There are also shortages of workers to build out.
Okay, cool. Let's I want to break down some of this Tesla information. So let's do a little summary on some of the Tesla info and some of the other as well. Hey, Kevin, can you make a chart with those micron projections, assuming they buy back? Yeah, I mean, those are all the big assumptions. I'm trying to think of, let me see how many shares. If I look at, that's actually, it's not actually that hard to do. And it depends on the share price in terms of how much they can actually buy back. But if you look at, let's go to their last earnings report. So share count here has actually been expanding, right? So share count has been expanding. And why? Let's go look at the cash flow statement. Repayments of debt. Oh, because they're paying off debt. As opposed to doing too many. Well, we got repurchases here, so why? Other proceeds from the issuance of debt, stock comp. I don't know. Somehow we got an expansion of shares, but let's see how many shares there are. So shares outstanding right now. This company has 1129 issued and outstanding. Is that what they say? Is that what they're using to calculate EPS to? They are using 1145 for diluted. So if I go with 1145, and that's in millions, so 1.145 billion basically. So this would be you know, if you went in and assumed a share buyback, well, let's see. If I take the EBIT, I would need to take the net income projection, which is not that hard to do. Micron. So we take a net projection. Net income projection for just the next few years would be, okay, here we go. 2026 is $107 billion. 107 billion. I'll just write it like this, 107. And then 173, 190, 199, Oh, that's interesting. The net income is expected to decline over here to 167 as probably as that pricing comes down. That makes sense. Okay. Let's see here. So if I now divide by current shares, let's see what EPS I would get here. Current shares of 1.145, I think it was. 1.145. Yeah, 1.145. Approximately. This divided by this. That gets me, yeah, that gets me close. But these are way, oh, well, these are EPS growth rates. EPS growth rates. This is just pure EPS. And if I now do a buyback, growth rate, assuming share count stable, right? And so now I come in and say, okay, well, over the next, what's the rumor? Like buy back half of the company over what time frame? Micron, share buyback, half company. Let's go see. Okay, UBS estimates that they could buy back 40% by the end of 2028. So that's just a UBS estimate. So there's your bull case, right? So bull thesis, UBS, they buy back 40% of shares by 2028. So let's assume they do that right here. And that'll be, you know, now all of a sudden we have 1.145 times 0.6. Now we only have about 700 million shares outstanding. Oh, this is not the growth rate. This is EPS. Projected shares stable. And this would be under buyback. EPS projected under shares bought back. 40% buyback. So here, we would then have earnings per share of, come on. Here we go. Earnings per share would be net income, this number divided by this. No. Net income, billion, divided by... Oh, sorry, I'm dividing the wrong number. There we go. Yeah, I mean, their EPS would be meaningfully higher, but you would still get that curve out. So now, if I do a buyback scenario versus not, okay, so I could then chart these two charts here. Oh, that's not the growth rate. Hold on, let me get the growth rate. So buyback in 2028, right? So the buyback occurs right here. That's, let's just say, that's where you get the buyback shares. Now we could get, those would be, oh, but those aren't growth rates. Hold on a sec. That would be here. EPS here. The growth rate, I just need to fill in 3 of them. So I need to do this divided by this minus 1. And then this is actually times 100. Because of the way I have the growth rates listed there. Times 100. There we go. That's pretty good. This growth rate would then be based off of this year. So you'd have a spike for 1 year, basically. Yeah, but you're still coming down, right, in that scenario. So really the buyback gives you a spike for a year. That's where your benefit is, right here. And so the difference of the curves would look like this. There you go. Yeah, that's actually really interesting. So the blue is where you have the boost. That represents your buyback right there. That's actually kind of crazy. That's crazy. So the buyback really doesn't change the EPS growth rate much. It sort of delays the decline. That's an interesting way to think about it, just because the growth rate has been so high. Let me see if I did that right. EPS growth. Where did I put the chart? Micron growth rates. Okay, I just want to look at the data again, just to look mentally fact check here really quick. Those are the growth rates. Yeah, no, these are the growth rates. These are the percentages. Yeah, so no, this is accurate. EPS growth rates, assuming 40% buyback in 2028. All right. And it could be spread, but basically that shows you the difference. So, but now it's labeled better. Where'd it go? Whatever. I will plop it. Oh, okay. It was right above it. There you go. That's cool. I like math. Not really. I actually don't really like math. But I mean, I hate to say it. It looks like a buyback in 2028 doesn't buy them massive shortage growth rates. It just boosts their, EPS growth rate for 1 year, or the time after the buyback. You get a slight boost, but not massive. The pricing, which I guess it sort of makes sense, right? It's like they're already earning so much. They are already earning so much. This is probably logically due to the law of large numbers, right? Like they would have to earn twice as much revenue, maybe, for it to really start impacting. Like if I came in here and I said, our EPS, let me see. If I came in and said our EPS was going to go and massively skyrocket, like we're going to have these pricing shortages and pricing is going to 5x, right? Like imagine pricing 5x for example. Okay? So I pricing 5x's in 2029 roughly, and then we go to, again, I don't know, 50. Okay, so their EPS skyrockets. That chart's going to look a lot better. Yeah. But it's still not the growth that we've recently seen. See how that like spiked up? Whereas if I now undo that, actually, let's keep it for a second. So I want to take a screenshot of it, just so you can kind of see the differential. Let's go back. It's really a law of large numbers game. So this is, here's the difference, side by side. Here's the difference side by side. So it really shows you the EPS growth rates, they just can't be that high. The EPS growth rates, even if I 5x EPS in 2029 to 2030, only nominally bump because we hit such a ridiculous surge in 2025. It shows the magnitude of what memory just did, right? Like those growth rates are so insane. Even if you 5x EPS, it doesn't show much. So that makes sense. That's actually kind of cool. I like that. That's and I appreciate you asking those questions because I wouldn't have come to put together that analysis unless you asked. And it's fascinating because it puts into perspective, wow, you know, they really went from a small place to a massive place. Okay, let's drop that in. Okay, I threw that into the Micron item there. Okay, as far as, yeah, okay, good. So, let's take a peek at this. Tesla's still holding on to 4%. You know, the Qs are coming back. They're trying to come back to 715. Look at that. That's nice. That's been the struggle. Struggle bus. I'm actually trying to get back over here. Okay, let's do a little bit on Tesla now, because it is pretty exciting. The semi-truck. So, where did I put it? Oh yeah, here we go. Cool. All right, we'll do a little summary on this. There we go. Cool. Well, the Tesla semi-truck is getting closer with volume production expected soon. In this segment, we're going to break down what we think this actually does to the price target for Tesla stock. Tesla stock up 4% today on the news. And I have to say, there's some exciting stuff going on. There are currently images circulating of a Tesla semi-trucks getting tested with LiDAR racks, which is one of the early stages of really validating FSD for this type of body size. One thing to know is that Elon has told us that full self-driving isn't the highest priority for the semi-trucks right now, that there are many other priorities at Tesla, including the Cybercab launch, which, you know, is expected within the next few weeks here. But we know that in the long term, probably once these actually hit volume production and volume sales, FSD is going to be critical. I personally am a massive fan of full self-driving. I think every single car should have full self-driving the way Tesla does. I hate when I get into a car that does not have full self-driving. I don't even really care anymore if a car is fast or has the acceleration. Like, I got the Cyber Beast outside. I got the Model S Plaid. You know, and then I got the Model X as well, although that's the 75 version, so it's not as fast as the others, though it's still pretty good. You know, the Model X, I think, was 2.9 seconds, 0 to 60. The Model S is 1.9, roll-off subtracted, 0 to 60. And the Cyber Beast, I want to say it's 2.5, 0 to 60. So I've got 3 Teslas with, like, massive speed and torque. We almost never step on it because we're using FSD all the time. You turn on FSD, who freaking cares? You know, it's like, I put it on chill mode, honestly, which is so weird. It's like the opposite, I feel like, of my personality. You know, I want the jet pilot, you know, full throttle, baby. But I don't with FSD. I love these Cybercabs out in the parking lot. This looks pretty cool. Whoever had this video, they did a great job. It's actually very exciting. But seeing those racks on there does indicate that there is at least a team working on getting FSD for the semi-trucks. Now, what's really remarkable here is that this can have a meaningful upside impact on Tesla stock. We're going to do some math and value this out. But the most important thing that we have to talk about first is how California could actually enable a lot of sales of these vehicles the same way that we saw basically solar and batteries get incentivized. So the Tesla semi-trucks are expected to sell for between $240,000 to $300,000 per vehicle. Actually, it's $260,000 to $300,000. And 2 variants are the expectations. So a base model that has 300 miles of range and a long-range model at $300,000. Those are, they come in at roughly twice the cost of what a lot of companies pay for semi-trucks. But California California is estimated to have about $120,000 per vehicle of incentives, which is basically the entire extra cost for a fully electric semi-truck could potentially be borne by the state of California. So it would entirely make sense to litter the state of California, like up and down the I-5 or the 101 or whatever, with Tesla semi-truck charging stations, probably more likely the I-5, and milk sales in California at, probably 20 to 25% margins. And we'll play with the margins to see how this could actually impact the stock. But what's remarkable is these cars, you put them on FSD, they'll be the safest possible out there, and their cost per mile is expected to be substantially less than diesel vehicles because of the servicing aspect. Anybody who owns a Tesla knows these puppies basically never go into service, which is really exciting. But let me give you some of the estimates right now. So the estimates on, I wrote down some of these notes from the institutional research that I've been reading. So the current cost per mile are expected to be 31 cents per mile for a Tesla electric vehicle semi-truck versus 67 cents for diesel, which, if you think about it, every 100,000 miles that this vehicle drives, you're saving $36,000. And so let's think about it. Like, how many miles are we going to drive a day? Well, let's assume they drive 8 hours a day, 5 days a week, right? At 60 miles an hour times 5, that's about 2,400 miles a week at average working weeks with breaks and stuff like that. All somebody else could get in the truck is about 46. It's about 110,000 miles per year. Let's just do a quick fact check on that and see how many miles a semi-truck. How many miles does a semi-truck tend to drive per year, right? So my guess is 110,000, just based on that quick math. Damn! People are gonna think I looked that up beforehand. I didn't. I just applied really quick basic logic, okay? A long-range haul semi-truck typically drives between 110 to 140,000 miles a year. Okay! Obviously, a fully autonomous vehicle in the future could do a lot more, right? I literally calculated an 8-hour day, 5 days a week, weekends off, and I didn't include 6 weeks. So you could triple the usage of these semi-trucks if they are truly fully autonomous, which is the, long-range goal. Now you really have a robot on wheels. But every single year, that puppy saves you $36,000 in maintenance and fuel costs. That's really good, because over 5 years, that's $180,000. You got a free truck after 5 years, especially after those Tesla credits, right? 5 years at $30,000 of savings, 150 grand, 260 minus the incentives at 120 is 140. There you go. You paid for the truck. Long range model, maybe it'll take you a 6 year, whatever. That's fascinating. That's really interesting. Now we'll have to see, obviously, how the charging infrastructure and that plays out. This is still, there's still a roadmap to go through here. But for long-term investors, this is actually quite interesting. And FSD will come. I'm not concerned about that. Every time they have a new chassis, it takes time for FSD to get applied. I mean, look at what with the Cybertruck. When the Cybertruck first came out, there was no full self-driving. And a lot of people are like, oh my God, I just paid $120,000 for a car and I don't have full self-driving. It comes. Now it's got FSD and it's great. It's really good. I feel like I don't even drive anymore. And I've been using autopilot, since 2017. One of the early, Tesla YouTube fanboys, if you will. But anyway, Bloomberg says the consensus forecast is that Tesla could sell $36 billion worth of these vehicles by 2030. $24 billion worth of them, and a quantity of 36,400 by 2030. So far, the California voucher program has only given 5 vehicles out of 1,150 the vouchers. So, this is really early game on the semi-truck revenue and how the California tax credits are going to work out. The California tax credits are also very complicated. There are I want to say like 3 or 4 different components that actually go into them. There's the hybrid and zero emission truck and bus voucher incentive program. Frickin' mouthful. Then there's the CARB mandate, which requires 5% of all of these trucks be zero emission starting in 2024 and rising to 40% by 2032. So there's a lot of regulatory push to get to these zero emission semi-trucks. That's why they're literally throwing state capital at these vehicles. And Tesla shareholders would stand to be the beneficiary of those basically liberal handouts. It's like corporate socialism for the green vehicle mandate. You know, Donald Trump did the opposite, which hurt Tesla stock by taking away those credits. But California is like, oh, we'll give you more. Which, fine, California can go into more debt. I mean, corporate socialism, hey, you know, whatever. That's California for you. So let's do a little bit of math on this. If, let's say, my projections for the semi-truck revenue, the last time I did this, I only calculated a semi-truck operating income of $1 billion. That's operating income. So that's after, you know, cost of goods sold. And my total forecast for the company doesn't even include robotaxi. I consider this as just selling vehicles, right? Like the Cybercab, let's say it's 99.9% good and they just sell it as that Model 2, you know? Like, I'm doing that to be conservative. Some people, they're like, oh my gosh, Kevin said there are not going to be robocabs? Okay, I'm done listening. What a loser. It's like, the point is to build in some conservativeness. So obviously, if the robocabs work as fully autonomous, that's fantastic. What big W, right? We need the Halo. If only the Halo guy could come in and say, big W.
Big W.
Anyway, the semi-truck, I had as bringing in operating income per year in 2030 of $1 billion. That might be low. If they could do $24 billion in sales between now and 2030, they will have ramped to the point where they could potentially do 50,000 of these a year. You know, if you do 50,000 of these a year at, you know, call it an average of $280,000. And then, of course, they'll make more money on FSD subscriptions for this as well. $280,000 times $50,000 per, that's $14 billion in revenues. Okay, $14 billion in revenues, I'll put a 25% margin on it because the tax credit benefit is going to go to Tesla, to the Tesla shareholder, a lot of it. The consumer feels like they're getting a benefit, but they're going to be able to get a higher margin on these with the tax credit, almost certainly. I mean, the benefit is not clearly only one person's economic benefit. The benefit is usually split, but I think the majority goes to Tesla. That's $3.5 billion of operating income by 2030. That means I was really low at $1 billion. If they could potentially pull off 3.5 billion here. Okay, so let's go to, where's that $1 billion? Semi-truck, well, let me not change it yet. So my forecast at only trading for 2.25, which is still expensive. That's, you know, there's definitely a hope value built into that valuation. Puts me at a price target of about $555 with $1 billion and no robocab, right? No robotaxi. Which, you know, obviously is, ignore the talk about combined. This is the Tesla only sheet. There. Oh, I guess I'm just borrowing that. It's the same number anyway, so it doesn't matter. Okay, a future value of 555 with a present value of 340 gives me a compounded annual rate of return of about 12% with $1 billion of operating income on the semi. If I now go in and I say, no, we're actually going to go, so 555 is the number. Let's keep that in our mind. We're actually going to have operating income of $3.5 billion. Okay, keep in mind, FSD revenue is already at annual recurring here of $2.5 billion. So I'm not going to add more in for semi-truck FSD revenue because even if you charge a lot more for the semi-truck FSD, which you should, especially since it's a business and businesses rip off other businesses, you know, $2.5 billion is still, you know, we got to get up from like $700 million of annual recurring revenue on FSD. So we still have a little bit of work to do, right? So let's go call that $3.5 billion here. Let's update that sheet. So the forecast then takes us to a price of $589. So based on $3.5 billion, that works out to about a $34 premium that you get for this stock, or I should say in potential value, for semi-trucks, really cranking more than expected. Now, did I run that $3.5 billion at 20% or 25%? Let me just verify. That was, I ran it at 25%. So that's at 25% margins. We get to $3.5 billion. And now, of course, that should grow as well, especially as the infrastructure grows. So right now, that can increase our forecast for Tesla stock to about $589 by the end of the decade. Now, there's still, these are really bullish numbers, and these numbers do not reflect the current analyst expectations, because that is EPS growth, or that would represent earnings per share of $8.72. Let's go see what Wall Street is currently forecasting, because I don't think it's anywhere near that high. So, okay. Analyst forecasts bring me to the end of 2030. I've got forecasts of I'm still at percentage. Okay, let me just set this to number really quick. And then we will get to see what the analysts are thinking. So $1.70 for 2026, $2.27 for 2027, $3.28, $5.23, $7.60. That's currently where Wall Street gets to. And keep in mind, that's at a 2.25 peg. If you underwrite this lower at a more of a manufacturer peg, it's going to be more like times 1.4, and that's going to be a risk factor as well. See, if I put in 1.4 and I don't underwrite the Optimus and the tech and stuff like that, I get to a 2030 fair value, not even a today fair value of basically where the price is now. So you are required to expect some form of increased PEG ratio there. But anyway, you can see my numbers here are, let's see, 8.72 divided by 7.6, about 15% higher than what analysts expect right now for earnings per share. And then you put the multiple on it. You put a low multiple on it, a low PEG ratio forecast, you're going to be a lot worse off. The forecast growth rate for Tesla right now sits at about 42%, I want to say. If I divide it by 4, it's actually gone down a little bit. 33.63, 44.3, 59.57, 45.15 divided by 4. Oh, no, okay, yeah, there. No, yeah, that's about right. 45% is the current forecast for growth. So if I take their current PE, it looks expensive. 359 divided by $1.70 is 211 PE divided by 45. Yeah, right now they're trading for like a 4.7 peg. So from a valuation today, based on where the analysts are, it's overpriced. But if we build in some of this enthusiasm on not just the semi-trucks, but also on FSD revenue coming up and getting to 4 million vehicles by the end of the decade, there's reason to see the share price move higher. Now, I've been of the belief that post-SpaceX, Tesla would come down, and it has come down quite a bit. But some of that, it's possible it could be getting closer to bottoming. Let's just look at the technicals for it. So if we go to Tesla, we've just broken through 347 again today on the semi-truck news. But look at this bottoming formation. We got an oversold here during the Leo Fold drama. That's reasonable. Now we've really built this sort of mid-threes recovery, which is exactly where the floor was during the peak of the Iran crisis, and also where we've seen a ceiling before the run-up that we had in 2025. So, hey, if it could really get the FSD licensing cooking, and we really get a lot more of these semi-trucks on, and we get vehicle growth, and we get, the Optimus robotic future, which I do have built into here. I've got for Optimus, which is still a while out. We saw the Unitree IPO. It's down about 39-ish% from its IPO. Of course, it was underpriced and it skyrocketed. But what do we have from bots? So bots here, I actually have very low income right now written in for bots on this estimate. So I don't even really have income from bots. Let me take this to 25 billion of that's bot revenue. And that would give us Tesla bot income of 6.2. If I pull in the bot, look at what the bot can do for you. The bot can take you even higher by 2030. And that's where the excitement is. So I just went to 672 from 589, I think it was. Let me see here. 589, yeah. So if I go 672 divided by 589, that's another potential 14% on top of that, just from the bot. So I didn't even have that in my 2030 estimates, which is also kind of useful. It's more conservatism. So that's not bad. If it could pull off, again, growing vehicle deliveries. And that's probably where I differ from a lot of the analysts. I've got a lot of people projecting, 2.5 to 3 million vehicles by the end of the decade, that the growth rate is getting harder to sell the electric vehicles. I don't think semi-trucks are really going to add like 1 million units, right? So you really have to assume a big push in vehicle growth to get to some of these numbers, and that the Optimus actually sells in volume. I mean, 25 billion at 25,000 would be selling 1 million of these Optimus robots by the end of 2030. That's, that's a lot. So let's write down some bottom lines here. Okay. So if I write down the bottom line and we say 1 million Optimus robots and 15 billion in semi-sales, that could get us to about, and 4 million total vehicles at 34K average, gets us to a 672 target on the stock. If we reducing out robots gets us to about I want to say it was like 582 or 589 or something like that. I think it was 589, somewhere around there. Now we can kind of start seeing, okay, all right, that's where our forecasts are, assuming 2.5 in high margin, 2.5 billion in high margin FSD. If I go a little bit more bear case here, and I take out the FSD and I drop that down a billy, so we only, it's still impressive, we only double FSD by then, and Optimus is still an edge case tool. Let's go take that down to, I don't know, let's go take it down to 5 billion. 5 billion edge. And, then we get back to that 592 range. So Optimus and FSD are doing some of the lift there. And then, of course, the multiple for the company. I don't know that it justifies a 2.25 because its net margin is so low. So the biggest risk factor is what multiple does Tesla get? Net margins are low right now. Today's net margins are 5%, 5.3%. That's terrible. That justifies like a 1.1 peg, honestly. Like it justifies basically a 1 peg. We're valuing this at 2.25 for a peg multiple. So margins should expand again. Margins are forecast to have bottomed. But even if margins triple by 2030, you're still at 14% on the lower side. So expecting that 2.25 multiple re-rating on just 14% net margins, not that great. We really, the real test of the stock is going to be a margin story. The real test will be margin recovery. What is the margin like on Optimus robots? What is the margin like on robo-taxis? What's the margin like on the semi-trucks? And that's always been the story for Tesla. It's how much can we apply full self-driving revenue to every other car? I remember when Elon first sort of hinted, oh yeah, we're thinking about licensing FSD to other companies. We're in talks with a major OEM. The stock would skyrocket on that because people see that as, wow, that's high margin. People are willing to pay for really high margin. The semi-truck is probably going to have substantially better margins than the regular vehicles simply because California is doing this to get those green energy semi-trucks. That's the whole sort of left-leaning branding. Really incredible. But yeah, that gives you a little bit of an outlook. I can reasonably understand why, though. If you take just a one peg in the, even if I take their numbers, Wall Street consensus, at a one peg and $7.60 of a forecast, and I grow at, I don't know, what do we grow at? We grow at, I don't know, maybe it grows at 30% there. You could be in the low 200s by 2030. So that would make today's fair value potentially even less, right? So it's all about that multiple, and that multiple comes from margin. So that's my take on this Tesla news. All right, let's go see what we got over here.
But you want to see NVIDIA say, this is how we're going to be able to do business, real quick.
Yeah, we really want to hear that. I mean, this has been something that has been dragged out, and we just saw news headlines, right, that China is now enabling. There are orders in the book. We really want to see this come to revenue, at least in the tens to $20 billion to start with.
Bloomberg Intelligence's Kunjan Sabani, who leads our research of NVIDIA and the other fabulous chip names, thank you so much. Oh, that does it for this edition of Bloomberg Tech. Seriously, an astonishing week in technology.
Boring.
Getting on a zip code level or nationwide. Spectrum reach.
Also boring. That's all right. Let's go see how the market's behaving. Oh, look at that. The Qs are back. Back at 715. No way. Look at that. Reject, breakout, coming back for the bounce. That's bullish. People are buying the dip. Tesla's obviously up. SpaceX up a little bit. I've got Moderna capped out around 10%. Yeah, some of that trading momentum slowed down a little bit. Listen in over here.
This was a macro move amplified by this massive short squeeze and then further helped by the industry headlines that we saw. So the rally really began when the Treasury yields pulled back Wednesday, easing pressure on risk assets and the dollar weakened. Bitcoin tends to benefit when liquidity expectations improve and has an inverse relationship with the dollar. So the market starts thinking financial conditions could become more supportive for risk assets and scarce assets like Bitcoin. And then the move just started feeding on itself, Carl. So Bitcoin broke out of its recent trading range.
Yeah, well, I mean, you get short covering, and then on top of that, you get enthusiasm for, it's the bottom is forming, right?
Sorry, liquidated roughly $2.7 billion around that day earlier this week. On top of that, we had this renewed ETF demand, which provided additional spot buying. And then you had the crypto-specific catalyst. We saw this last-ditch push from the White House and the crypto industry leaders to get the Clarity Act across the finish line in the coming weeks.
Well, and the CFTC chair is like, hey, one way or another, we're going to make this happen, whether Congress does it or not. That was a big bullish comment.
But investors had started to view the bill as effectively dead for 2026 after the Senate left for its August recess without a vote. So the macro created the environment, positioning amplified the move, and then a more crypto-friendly regulatory narrative, giving investors another reason to buy. Crypto stocks soaring with Bitcoin, Coinbase, Circle, and Strategy all up as well for double-digit gains on the week. Guys?
Yeah, the Strategy thing is really interesting. That's almost a 30% gain, and I think Saylor goes back to a pretty large unrealized profit, yes?
Yes. Yeah, definitely. And after all of the bearishness around the strategy, given this crypto winter, but anything can happen going from here. It's very likely we are watching this 4-year cycle, and that could mean in October, but it's very likely, or it's not likely, but possible that we do see some sluggishness in September leading into that again. So I wouldn't.
I mean, I don't know where. I mean, I think you're just sort of making that up. Anything's possible. Usually, when you create these bottoms, people get really excited about slowly building. So kind of exciting. Okay. So let's see. Let's see if the Doomers are back with anything juicy. Google's up about 1%. Merck, Trade Desk, $13. Rough. Oracle's even up 4%. Wow. Axon. No, the Doomers are on commercial. Axon got rejected by this little trend channel that it's in right here, but it's actually a great spot. You know, it's you're just riding the 100-day moving average essentially. I mean, what is the 100-day? It is the 100 days 587. I guess you're a little bit above that. It's about 10% above that actually. Okay. So let's go see what else is going on. Okay. So where do we have nothing? AI, next big leap into the real world. What is this? Is this robotics? Oh, yeah. Another Unitree story. Instead of large language models, we need large action models. Oh, see, now that's an interesting line I haven't heard of before. Now, you know, we've all heard before that there's this idea around, you know, like LLMs are got to keep spending because they got to keep going on the frontier. I think there's an S-curve limit to how much LLMs can really expand. But this is interesting. It's basically, hey, but we got to train all the robots. That's interesting. Okay, that's a good point. Listen in here for a moment. We'll come right back to that.
After this week, wealth management's a challenge, to say the least.
Wealth management is a challenge if you're a bond investor, certainly, because you were thrown for a complete...
Let's do it.
I like the green in the desk.
TD, because it is Bloomberg money. To 4 digits, the 30-year bond yields of 5.2688. That's stressful.
It's moving up when the Trump administration wants to see it moving
Great.
down.
Fu nailing it. Price up, yield down, or yield up, price down.
All right, whatever. Okay, let's keep going with where we were here. So what is this? Large action models. This approach is intended for piloting robots. Artificial intelligence models are trained on video games and simulations rather than literature, code, and images. They've recently reached a point where, in some circumstances, they can navigate 3D spaces and even manipulate objects autonomously with a simple set of instructions. It's still early days. If we're comparing this to LLMs, we're at like GPT-2. Yeah, I could see that. Despite the relative, let's see here. Despite the relative primitive state of the world models, tech luminaries are piling in. The bet is that fundamentally new architecture has to take AI to places that today's LLMs can't. Okay. For about 500 million years, animals have been evolving their brains capable of modeling the world. Text is a lousy representation of the real world. Yeah, that's understandable. Robotics have long known this. Physics-based simulations. Okay. Today's world models want to create a control system that's versatile when piloting a robot. Okay, whatever. I get it. We need to train the robots. Where's anything that's interesting here? General Intuition's model is trained on millions of hours of video game play. Oh, that's interesting. From real humans. They're training them on video game data? With a little fine-tuning, a model can pilot a robot in the real world as if it were a character in a video game. That's weird. But also kind of cool. In and around their office, General Intuition shows off a robot dog. While a typical AI for driving such a robot might require enormous amounts of training, this requires just a few minutes of fine-tuning. The system needs to know where it is, what kind of body it's in, and what the goal is. And then away it goes. Okay? Why does it only take a few minutes? Okay. So let me see if I can take a peek at this here. So So, okay. What did they call this again? They call this... So I just want to look up if I can get some more stories on this. This is large action models. Okay. So-called large action models. All right, what do we have here? So, previous demos of world models like Genie unveiled by Google DeepMind, blah, blah, blah. Yeah, they're a big investor, or partner, I should say, with Aptronic. Aptronic is a robotic developer that we have venture capital funding in. We've been excited to see what they could potentially pull off. Language plus action, right? And then you combine the two. That's fair. I mean, the LLMs peak out, and then you got to move over to large action models. Okay. Because I would guess if you're trying to get from GPT 2 level, you know, it's going to take a lot of GPU time. And if they're doing video games, doesn't that sort of imply even more demand for GPUs? Like, more data. More data processing. It's all visual intel. This is actually harder. I mean, I feel like this actually goes back to GPUs over CPUs, because I feel like CPUs are your more data-based. I gotta hit the restroom. We'll come right back and we'll keep talking about this, but I do think it's kind of cool. All right, let's go see if the Doomers have something while I hit the restroom. I'll be right back.
For the late Lindsey Graham's sister, and there's going to be a parade of other kind of Republican dignitaries with him. I now think that now the split that I'm looking at is within the Republican Party, those who have sided with President Trump, often at their own peril, now having to make the case for his policies when it seems like there isn't a whole lot there on
20 seconds. I got to get to Ms. Waller. 20 seconds. Does the far left want America to create wealth?
Yes, I think, but wants that wealth to be more widely shared. And so I think, look, the economy is doing relatively well by many measures, but the way that it's distributed is something that I think that they care
Okay, we're going back to normal Bloomberg coverage. The 30-year bond is coming up. My God, Nikki, what does this new Besant yield mean for our personal finance? There's got to be a seismic shift this week.
Well, you know, I think bonds used to be pretty drama-free, and the game board is changing for investors right now. I think one way to simplify and think about it is if you need money, it is going to be more expensive to get that money. If you have money, there are a lot more interesting places you might be able to put it.
Oh, that's a really good way of putting it. What I find fascinating, too, is that it's one thing for Bloomberg to fixate on the Treasury market, but you have CNN and you have other mainstream publications now featuring the 30-year bond yield on their screens right now. People are talking about it in a way that feels like it's alarming. I don't know if that's necessarily the case, given that the 30-year bond yield has been at 2007 levels for a couple of weeks now, but it's entering the conversation in a new way.
That's absolutely right. This week, it feels like something has boiled over. And even if things do calm down next week, I think we're in for a longer period of uncertainty, which is the theme we come to over and over again with politics, with tech, and everything.
One of our interns just brought this in. Let's bring it up right now. This is either the expense at the Gura household at camp this summer, or it's the U.S. debt clock.
Okay,
Did you get up to 39?
They didn't really say anything fun. Okay, so while I was over there, I saw this little article that came up on Tesla, and I thought it was really interesting. We should add it to our little Tesla summary. Let me throw it up here. Okay. What button? There it is. All right. On Optimus, another thing that's really interesting is there's now talk from Elon that Optimus and Grok could transform universal medical care in major healthcare breakthrough. And the reason he's arguing this is because he argues that there is a shortage of skilled surgeons and doctors, and that is going to enable the Optimus robot to basically take over medicine and provide substantially more supply of highly skilled doctors, which could theoretically lower the cost of healthcare. That's probably a long shot in the near term. You know, that's probably a 20 to 30 year out, like a couple generations out, in my opinion. But the premise is really exciting because, think about it. To be a doctor, you're going to, I don't know this, I'm probably going to butcher this, but I'm pretty sure it's like, your 4 years bachelor, then you got to go to med school. That's probably 4 years. Then you got to do your residency when you're basically new and just actually really getting more hands-on experience following your schooling. So, what is that? That's 4, you're 22, plus med school, you're 26. Your residency is done when you're 30, and you're, 300 grand in debt. And that's probably just an appetizer. I'm probably missing some stuff that goes in there as well. So, that's a long time to actually produce a doctor or a surgeon or whatever, which makes sense. It's a skilled industry. But that does show you, there's a lot of real hope that could go into what robotics can do. And of course, there'll be a lot of competition. The Unitree robots, we were looking at the IPO for Unitree this morning, and Unitree went public in the Shanghai stock market. They already these robots. Now, how functional they are, I don't know. Here's like a tabletop one. Here's one that looks like it has like a weighted plate at the bottom on wheels. Here are a bunch of different versions you could buy. So there will be Chinese competition, and I think that's probably a real risk factor to the optimist outlook for Tesla. I do believe that the Chinese will continue to outmanufacture us. And even if that means they're stealing our technology and that's evil and darn you, China, I think it's still going to happen. Like, I'm already seeing BYD cars all over Europe, and it kind of makes sense because they're just cheaper. So, and with the tariff situation, it's almost more desirable for the EU to lean on China for the vehicles than on America. They already lean, you got BMW taxis and cop cars in Germany, for example, or whatever, because, it's locally produced. It's ironically cheaper for them than buying like a Ford Crown Victoria, although they don't even make those anymore. But anyway, Unitree is interesting because, it IPO'd at this, I think, $50 billion valuation. The ticker for them on Webull, we wrote this down, it's like, there it is, I got it. It's 6888, which is lucky, 36. You'd actually see when it IPO'd, it skyrocketed up to $1,100, and that's where it's down like, 40-ish% or whatever. Market cap somewhere in the $30 billion range now, so it's really come down, mostly because, you're really looking for margin, right? That's where it all comes from, is margin. Of course, if the Optimus could be a surgeon for you in the future, that should be a high freaking margin product. I'd want it to be a high margin product. I don't want some, cheap Barbie doll kind of robot that's taped together doing this. It's got to be a good surgeon. But the point is, everything that we've talked about in the Tesla segment has been built on 2030 numbers and optimism for Optimus and trucks. All of that margin still remains unclear. So when you compare Tesla stock to other companies, in my opinion, it's really important. You remember there are 2026 fair valuation estimates for companies, and then there are 2030 estimates. So if you're comparing 10 different companies that you're thinking about investing in, generally what I like to do is I like to look at what's the fair value today, or maybe even at the end of the year, right? So I'm not going forward that far. Tesla only has an earnings per share estimate of $1.70 for the end of this year. $1.70, even at 45% growth, at, even if I give them at 5% margins, you should only give them a 1 peg. That puts them at like $70 for the stock, right? If you give them generously, I think, a 2.25 peg, it's $172 stock. So that's not great. That's how in 2026 the fair value estimates tell you, Tesla's a little pricey. It's because the difference between that 2026 estimate and 2030 is that there's a lot of hope expected for 2030. The problem is every time we have hope expectations for 2030, things just tend to take a lot longer than expected. So I think that's a fair way to hedge when we look at companies like Tesla. Cool. So, all right, what do they got over here?
For Being with us. Let's get right to it. Kevin Gordon with us later now. Rebecca Patterson, the fancy title, Writing Daily. Great work with Sebastian Mallaby, Senior Fellow at the Council on Foreign Relations. I don't care because it's Bloomberg money. Wonderful to have you here.
Great.
Long ago and far away at Bessemer Trust, I came in and I said, wonderful pontification to wealth management people. If you were at Bessemer Trust today, how do you handle this bond market?
You know, I would have been nervous about bonds for some time. I wrote an op-ed in the New York Times in June.
Yeah, dude, nobody cares. CFR chick. Oh, look at that. The Q's reject again. Let's see here. Train halls. Trying to see if there's any. There's really nothing coming across the wire services. Pretty quiet. Tesla shares rise 4.4%, 1 month high. Yeah, I mean, that's what we've been seeing, and that's why we were just talking about Tesla. But again, if you don't have it, you know, use the Meet Kevin app, and you can get the wire feed as well. This is what it looks like on the iPad, which I particularly think is exciting and fun. But yeah. All right, so let's see. Got anything juicy for us?
Of interest rates where it looks like they're losing control. I think the reverse happens.
I think that's right.
Agree.
So that is
okay. So Tom Lee still says 7,900 to 8,000 by the end of this month. Ed Yardeni says whatever pullback that we may still be into because of rates should be modest. We also thought it would be interesting to look at outside of tech what's actually worked and what hasn't this week, what the statement may be as a result of that. So I feel like you have to take this next thing with a little bit of a grain of salt. The fact that healthcare is having its best week since late June. It is the top sector week to date. I say grain of salt because if I, of course, tell you that Moderna is up 140% week to date and that Merck and Moderna had the kind of announcement that they did, it's kind of like master the obvious that that sector is going to have a great week. What are you raising your hand for? Do you have a comment?
I'm excited to talk about this.
Go ahead.
Okay.
Go ahead.
So I think if we take Rob's construct, that if we see interest rates come down, right, and the momentum trade takes off because long-dated cash flows are worth more with lower interest rates, the opposite's true here. And so I think what the market's saying is like, look, interest rates we think are going to stay longer. And yes, you're right, Moderna and Merck skewed it this week. But if I look at holdings in my portfolio, Pfizer, you know, like crazy little Pfizer, up 17% year to date. Bristol Myers up 25%. So you can look across healthcare.
Hey, Thermo, you own Thermo. I was up 6% this week, right?
Yep. But I think if you take that interest rate construct in terms of its influence on the stock market, that explains healthcare, not necessarily this week, but in a bigger picture. And if you say, hey, I think, you know, the 10-year is going to stay at this 4 3/4 level, we know the government's going to do whatever they can to tamp it down when it hits 5%. But there's a lot of supply out there. There's corporate debt supply.
Yeah, I mean, there's a limit to like what can Besant really do. So we get to 5%. Who cares, right? Anyway, we left off on the robotics. I want to go back to the robots for a moment. So the robots, I was thinking about this. Robots are really, you know, a physical and vision-based tool. Vision-based perception, so like cameras, LiDAR, everybody you know who likes Elon hates LiDAR, but the robots use them. Your iPhone uses LiDAR, you know, depth sensors. These are really going to be GPU tasks. And the training for them is going to be really interesting. I wonder what talk there is about NVIDIA. I mean, I know they talk about it a lot, but I want to see in their earnings what they talk about for this. Here we go. 7 days ago, NVIDIA stock rises on bet on robotics. This is from August 14th. Let's see. The chipmaker signed a memorandum of understanding with LG Group to develop a humanoid robotic. Oh, see that? There you go again with Tesla and the competition. It's the You know, now it's not just China, it's also going to be South Korea. You know, what, LG, I feel like it's going to have a giant TV. Just, life is good. All right, what else here? LG intends to unveil a next-generation bipedal. What's a bipedal? Like 2 foot? A bipedal is a machine built with a human-like body and 2 legs. Oh, the legs are called pedals? I'm sorry. I didn't know we were now calling 2-legged humanoid robots bipedal. I mean, it's like saying it's a bipedal human. It seems redundant. Okay. NVIDIA's Isaac GR00T Foundation model. Let's look at this a little bit. Okay. Here it is. Okay, whatever. I'll take your cookies. Isaac GR00T. Okay, here. Let's play that. Let's see what we got here. Haha. That's a YouTube video. Perfect. Let me pop that up. Okay, let's see how badly I screw this up.
General purpose robots, humanoids. But building one is hard. Every team starts from scratch, stitching together simulators, teleop systems, data pipelines,
Apple
and
Vision
training
Pro!
Infrastructure. Months of setup before research can start. NVIDIA Isaac GR00T, an open development platform for humanoid robots. Open models.
I like how they got Jensen to narrate this, you know? That's cool.
Simulation and training libraries and data generators. Plus, the robot computer. Fully pipe clean, ready to go in hours. First.
Hold on a sec.
Computer.
Wanted to see that screen.
Fully.
Isaac, data creation, real and simulated. Training scripts. That segment right there is going to be huge. Okay. What is this? Hold on a sec. Okay. So I'm just getting a little alpha wire feed right here. Omani and Iranian delegation discussed conditions for resuming negotiations that support the resumption of traffic through the strait. Well, that's good. Now, remember, Donald Trump said we're going to bomb the SH-9T out of Oman. So that's going to be interesting. Let's take a screen grab of this, though. Because this is very interesting on the NVIDIA portion. Okay. So, my take is that this is really the next frontier for NVIDIA. And you kind of have to ask yourself, do you want to invest in training robots or in the robots? So, a few clear robotic investment potentials. The robots themselves, Chinese competition, big unitary funding on IPO. You got LG partnering with NVIDIA. That's South Korea. I don't like that rolls off. Okay. But then you also have the training. Training might be an interesting component for robots. So if we're going from large language models to large action models, okay, that's going to basically say, you know, well, first of all, what we know, you know, at Reinvest, we use a lot of CPUs for stock and real estate data in our AI, but GPUs on vision-based, right? That's going to be huge in robots. That's going to be the core driver here. let me see here. Core driver, especially since video games are being used in training robots as well, should be GPUs for robots, which is actually bullish NVIDIA. And bullish them being able, like, that's a potential next S curve for them as well. Come on. Why can't I type anymore? It doesn't want me to type anymore. It's okay. Come on. There we go. Okay, so bullish. I would call it. Yeah, I mean, I would call it bullish NVIDIA GPUs, AMD GPUs to some extent, probably custom ASICs, especially for on-device, like the actual robot itself. But I don't think that they're gonna say. I don't know how much power you actually need on-device. I think training is more interesting. Training is probably the biggest load for robots. The inference on the actual edge devices, I don't know how exciting that's going to be. Tesla has the D1 chip. So there is obviously some risk of competition, as usual. Obviously, competition for GPUs for robots, D1 Tesla, the Google TPUs. Let's actually spell things correctly. And then the Sims are fascinating, but again, also for training. Okay. Okay. Let's save that and then keep playing the video. So, save. Let's see what else we have in that video. Whoops.
Pipe clean, ready to go in hours. First, set up the simulation environment in Isaac Lab. Capture demonstrations with Isaac Teleop on a real or simulated robot. Generate synthetic data with Omniverse and Cosmos, scaling one demonstration into thousands. Train policies. Evaluate them in Isaac Lab Arena. Deploy through Isaac Ross, running on Jetson Thor. Every element, modular, open. Use ours or swap in your own. Groot is powering robotics research across every discipline, for every domain, from research labs to factory floors.
Yeah.
One open platform. And now, a new addition. Isaac Groot Reference Design Robots. Built on NVIDIA's open platform. Ready for frontier research, for any lab, anywhere. The age of robotics starts here. NVIDIA Isaac Groot.
Oh, that's cool. Yeah, I think all of that, that's actually pretty bullish. Just like another potential S curve. Let's write down some of that thinking here. So if I go into, honestly, it's under the Micron side. You know, that could be a whole extra component. So extra growth curve. That would be potentially robotics. Training. Training robots. You know, I think, do I have? Hold on. Let me try something. I haven't done it on a live before, but let me see if I can pull it off. Because then it's just going to go faster. Let me see if I do this right. Okay, so far the answer is no. Nope. Guess I can't. Just logging me out. Dude, I've gotten logged out like 10 times today. I'm going to die. Okay, no problem. Okay, never mind. I'll just rewrite that. Okay. Why is that not working, though? So I'm trying to get the, what is it? The dictation hotkey should be working. Because then we can just dictate it. Yeah. Oh, that's just not working. Oh, that's lame. Why? Alright, whatever. Let's get to the bottom line here. Oh, there we go. No. Nah. Whatever. Command. Yeah. Doesn't want to work today. Fine. Fine then. I'll just keep typing. An F5. Oh. Nope. Nope. It's broken. Okay, no problem. All right. So basically, next demand S curve. Really, the question is when. But high bandwidth memory represents about 17% of Micron sales. Actually, I think it's 18%. So, and that is from our prior research, which is interesting. So we've got HBM demand at Micron, that's pretty juicy. SK Hynix, I want to say the majority of their revenue is HBM. Let me just pull SK Hynix really quick. So I'll pull that. And then in the meantime, robotics. Robotics, training using video games, LiDAR, vision, cameras, all going to be GPU heavy versus CPU. The scaling for robots creates a delay here. If we're just training in labs, the training is really nominal for robotic compute. You really need the GPT, like you need robots in everybody's house almost to really, I feel like, scale the training to like the next frontier levels. Frontier training for robotics at massive scale could help if the frontier LLM side slows down. But there could be a gap here, right? Let me see here. Oh, it actually, SK Hynix aligns with Micron. I thought it was much more than that. It's about 17.5% at SK Hynix. Okay. So let's draw that. Let's just go draw a little bit of a thesis here. We'll use the bottom of Microns. A concern would be that compute demand does this because of the frontier labs. The frontier labs peak out. We see compute demand slow. Probably a lot on the frontier, right? Open source and all that other stuff. The question is, when do you get physical robotic compute demand? which I actually think will probably be a lot higher than the language models. But that's an interesting thesis. So let's annotate that a little bit. Okay. Thesis is... okay. Let's get that file up. This is... there we go. Text out. Okay, so this would be frontier compute for LLMs, you know, Kevin's projection. We peak out on LLMs and don't hit AGI. And we don't really know where that is yet. We're probably, if I throw in an arrow, we're probably somewhere here-ish, maybe? Probably here. We're here. And then if this is robotic compute, scaling for large action models, okay? The current consensus, if you will, is robots inflect up in usage end of decade. And so we're really looking at, like, think 2028 to 2030. That could be right around LLM slowdown due to, you know, open weight and token costs coming down. Open weight, why is that not showing up? Oh, there we go. What the heck? There we go. And costs coming down. So that's going to be token costs. So really, if you think about it, robotic compute could actually save the big, you know, the big cloud providers. Robotic compute almost becomes critical for CoreWeave, NBIS, SpaceX, etc. Right? Like the big cloud providers. Because you need another S-curve. So you're actually, you know, if you're betting on hardware now, you're actually probably in part starting to price in some of that robotics revolution. Yeah. Yeah, that is interesting. Boston Dynamics supposedly is going to start, you know, having robots come out towards the end of the year, at the end of the decade as well. So it's not just the Chinese, it's also Boston Dynamics in the U.S. You know, I know Aptronics cranking. Then you've got, of course, the Tesla Optimus hope. But it's probably, you know, if this comes late, then there could be a gap, right? If the robotics curve comes too late, then there could be a painful gap, right? So, like, imagine, like, here's your worst case scenario, right? Imagine Anthropic peaks and IPO falters, funding slows, all in 27, you know, 28 before robotic surge, and growth rates collapse for AI spending. You could have a gap bear market in AI. And then that would be the time to go invest in those stocks for the robotic movement, right? So if you get a bear market between then and now, that's when you want to go all in on robots. That would be the time to do it. That gap would be the time to buy robotic stocks and GPUs again. That's interesting. Okay. Okay, I can see it. All right, we'll save that. Let's go see what else is going on for a moment. Let's jump into the Doomers.
Not necessarily outside of the Mag 7 where those companies just aren't going to be good performers, but we often find that there's this conflating, and you run into this where people think just because they're the largest companies, they're going to be the best performers in the market. That was the case several years ago, but that hasn't been the case in the past several years. So I think that, notably 24, 25, that's when you started to see more of a definitive shift. So the fact that they could still be up this year or up over the past year, that's true, but they're sort of ceding leadership to a lot of other parts of the market that have been asleep for a good chunk of this bull market. Yeah. Small caps is sort of the poster child of that. So I think in a rotational market where you've got north of 70% of companies in the S&P 500 that are trading above their 200-day moving average, that is much more consistent with rotational markets where leadership can change over time, and it's not necessarily portending, some massive drop in the market. Very different backdrop than late 2021, which I think is an important analog, because that's when things started to get way too top-heavy. Breadth under the surface was deteriorating, and then you ultimately had the bear market in 22.
I want to go back to what you said about the treat economy and how people are feeling that they want to treat themselves a little bit because the big things are so out of reach. The flip side of that is that phenomenon of FIRE, right? Financial independence and retire early. Invest really aggressively. Deny yourself everything for now so that by, 30 or 40 or 50, you can retire and go live your best life. How much does that come up in your conversations with this generation of investors?
Comes up a lot. I have a lot of discussions with individuals who, whether it's in a friend capacity and they're just letting me know their experience, or if it's at a client event and someone tells me about whether it's themselves or if it's their child or grandchild. I think the concept around labor in the U.S. and how that has changed, how you can have a lot more sources of supplemental income these days. Again, survey after survey showing that younger people think that content creator is sort of rising up the list of potential, for a job and for a full-time job. Not that that's going to be the dominant job. It's not that I'm, predicting that, but that's becoming more of a sort of a sentiment in the U.S. amongst the younger crowd, is that with the FIRE movement, but also having different streams of income, not necessarily relying only on one income stream from one job necessarily.
If 40,000 billion.
I will say, I always think the multi-streams of income is always interesting, because then you look at sometimes people's streams of income. It's like, oh yeah, I get $100 a month from this. I get $300 a month from this. I get $100 a month from this. And it's like, man, but your main salary income's like really low. We try to spend more time focusing on pumping that up. So I think there's a little bit of nuance there where you could really get more of a pop in your top line revenue, and it actually helps you a whole lot more than multi-streams.
Everything related to AI and the investments that you're seeing. Some of these numbers are just so large. I think that the mind can't really comprehend them. I was sitting in a strategy meeting this morning, and someone was saying, and I'm going to fudge the numbers and not remember them.
But it doesn't matter because they're big.
Numbers. But someone was saying, 1 trillion seconds. If you think about it in timing, 1 trillion seconds is, some decades ago in terms of years. So, you compound that to 40, or you sort of multiply that to 40, and it kind of puts into context how big these numbers are and how we really can't sort of fathom them. So I don't blame people for maybe shying away from wanting to approach that topic, but at the same time, again, we've been living with such large debt piles and large deficits for so long. I think also part of this is it has become a bit of the new norm. Not that I'm endorsing it, but when you have both sides that really don't seemingly want to do anything about it, and it becomes just this norm, that's what happens.
12 seconds. Yeah, is the glass half full or glass half empty right now as you write for the weekend?
Glass half full.
There you go. You can come back. Kevin Gordon, thank you. With Charles Schwab. Can't say enough about that.
Optimism.
Thank you for the response. And the
optimism. That's good. How is our market holding up? Tesla's still cranking. 5.3 right now. Qs are trying to go back to the 715 line. Robinhood, look at that. 13% today. Wow, from $98. Juicy. It's that crypto move. Really pushing. Really, really pushing. That's very cool. Okay, so what else? Let us see here. Oh, this guy.
Coke, we've seen in a long time. Net revenue was up 7% to $13.5 billion. Organic revenue up 6%. Gross margins 62.9%. Pretty good. I guess the GLP-1s haven't stopped people from drinking this stuff. They're touting the FIFA World Cup as the reason for the strongest trademark Coca-Cola volume growth in 17 years, up 5%. Powerade up 8%. Management raised guidance. Everything that we want to see.
It actually is amazing just how much money that company makes, and it just keeps going and going. It's really impressive. Good for them.
And where it recovered from as kind of the area where I'd say, okay, if we break that level, the buyers have changed their minds. They're not coming back. Let's walk away. Until then, I think you want to be long in the name. I think we'll see $100. What
do you think, Robbie?
We've owned it for a long time. I mean, it's having a great year. They have enormous pricing power, great brand portfolio, really benefited from the World Cup. It's tough to argue, you know.
It'll be interesting to see. I mean, people have to also adjust for the World Cup. I mean, that's every 4 years. So I know we could be excited about the World Cup's impact, but come on. Yeah.
Yield too low for you, or yeah.
Last point, I should have mentioned this. Coca-Cola and Monster did a deal in 2015. Coca-Cola took a $2 billion stake in Monster, so they own 19.5% of MNST. So not only both these companies doing well, they're actually business partners, and Coke is a substantial equity investor in Monster.
I appreciate that.
So to answer the question, the yield's a little too low, but not a lot too low. And so I've actually been looking at Pepsi also. Now, Pepsi has a huge snack portfolio, which would make Coke relatively attractive because they're
boring. Don't care about your snacks.
To the youngest Gen Zers. And what it suggests is that consumers are making more room for their pastimes in their budget. Bloomberg's Julia Fanzaris joins us now to discuss. I mean, sometimes they're not saving as much in order to spend on treats for themselves.
Absolutely. Personal savings are at a 4-year low right now. And people are saying, you know, at a time where everything's very expensive and you want to be happy, we're going to spend a lot and splurge on these hobbies.
What kind of hobbies are we talking about? I mean, there's like, you know.
She looks like whole 23 years old.
Big budget items, or are they?
Well, the funny thing about hobbies is sometimes when you start it, it's a very low entryway, but when you get very into it, that's when it gets expensive. So we chatted with people who, you know, they started off buying sticker sheets. Now they're spending $300 a month on stickers. Yes, to do junk journaling.
On what?
On stickers. Can you believe it?
Stickers?
Like stickers, just what you put like in a scrapbook.
My mother called those green stamps, and she could buy, you know, cheap china with it.
Well, she wasn't spending $300 a month on it.
But in the old days, we had time for hobbies. Like somebody had a 48-foot Hinkley Bermuda, or you played golf 3 times a week. We're not doing that anymore, are we?
I feel like the pandemic has pushed people to get back into spending time with themselves and going back to these hobbies. I actually spoke to someone who said they're back into golf because their coworkers were golfing and he's golfing with his friends, and now he got his own personal $650 Callaway driver.
Okay, so stickers, also crafting. Jeez. You talk to companies.
$650 for a driver. I don't know. Maybe that's normal in golf. I know golf things sell for a premium because, you know, people who golf. This is association with golf and dollars.
Generational, as you mentioned. People are spending more and more, and it's just not just, you know, oh, I'm buying like $10 here and there. They're making large purchases. You know, I was telling Tom earlier, I bought a $200 sewing machine because I wanted to get back into sewing. It has not been so lucrative because I did want to save on hemming, and I've had to fix a lot of those, but it's still very fun. And
is there like a modern AI tech sewing machine, or is it just
no way you justify a $200 sewing machine because you don't want to pay somebody else to hem the rare pants you need to get hemmed.
Didn't have the pink.
They didn't.
Boosting the economy. Boosting the economy.
We're going to books. Thank you so much for your comments on what Scarlett
Books is also a way to spend on your hobby.
Yeah, books is part of it as well. We're going to do Paris here because Julia darkened the door at Sciences Po a few years ago. My book on Paris, and this is a required read, David McCullough, I just simply can't say enough about it. The Greater Journey. This book is so strong about the arc from the 1830s, 40s through regimes, commune, all the challenges of Paris. You're angry when the book ends. It's a required read for every expat.
All right. Well, we're going to keep talking about robotics here. I do have to do a quick short sort of topic on the Tesla topic that we had. So I want to cover a couple things there, specifically mostly actually just the semi-truck, how exciting the semi-truck cost reductions could be over time, and really how the state of California is kind of bailing out that part of Tesla, right? I mean, that's pretty remarkable. So I'm a fan. I'm not a fan of paying more taxes in California, but oh well, I guess. So let's go hit some of it up here. All right, so we have this. Nope, it is this button. Yeah, there we go. Okay. There we go. Well, the Tesla semi-truck is expected to launch in Europe, and this is a game changer for Tesla, not because of Europe, actually, but rather because of California. Yeah, take a look at some of these notes. California is expecting to provide incentives of up to $120,000 per Tesla semi-truck. The Tesla semi-truck is expected to sell as a base model for $260,000, 300-mile range, $300,000 for a 500-mile range. That means Tesla could be subsidizing over a third, approaching half of the cost of the vehicle, which is really good because the upfront cost is about twice as much as a regular vehicle. But where it gets really interesting is if Tesla picks up, or California picks up the tab on incentivizing people to buy Tesla semi-trucks, and the cost to operate a Tesla semi-truck is half of the cost of a diesel at just 31 cents a mile versus 67. Then with an average of 100,000 miles driven per year for a semi-truck, not fully autonomous, that's human driven, right? That's an extra bonus. That could generate an extra profit of $36,000 per year driving a Tesla semi as opposed to a diesel semi, given the lower cost to maintain and charge, fuel in this case, the Tesla semi over a diesel. Now that's really interesting because it means, once again, California is coming in to subsidize a high margin product at Tesla. Because when the government comes in to subsidize a product, we also tend to see Tesla margins go up. We could actually see Tesla stock move up towards a higher price target, maybe even 10 to 15% higher with the semi-truck bailouts from California, thanks to taxpayers again funding green energy. So it's bullish Tesla. We'll see how their launch goes and what their margins end up being. Kind of interesting. I find that very fascinating. Okay, cool. So let's see what else they're yapping about here, if they change topics yet.
This
Or
weekend.
are they still talking about collecting stamps?
Are you going to?
Nope, they're talking about nothing right now. Okay.
All of the brokerages and all of the exchanges, it's not shocking that the brokerages have embraced this. They almost have to. They sort of have to cannibalize themselves because if people default to this rather than options and futures, they need to be there. The good news is, if you look at Robinhood's last earnings report...
Are they referring to prediction markets, I'm assuming?
The best thing that they're doing right now in terms of margins, better even than crypto. So I think that fear will remain above the heads of those exchanges. And there's going to be some political fights about it, too. It's not over yet.
Yeah. All right, we'll take a break. We'll come back. We still have final trades ahead.
Me too.
Boring. Okay, cool. What else do we have here? So, let's go see what else is going on. Okay, so we talked about that. Let's finish the robotics talk. So we looked at NVIDIA. We were looking at Micron. Let's go back here to robotics. And we also should think about like what stocks could really benefit here from robotics in the longer term, right? So robotic stocks. I mean, just like generically, you've got obviously NVIDIA, AMD GPUs. You've got Broadcom and somewhat Marvell for ASICs. You've got Marvell for edge compute and base station, AI for 5G, 6G. Broadcom somewhat in there as well, but also Qualcomm. Qualcomm on Internet of Things, you know, so like robotics, communications, comm chips. I would say Teradyne is probably in there as well. What's their ticker? Is it just TER? Teradyne stock. Teradyne is, yeah, it's TER. It's kind of gone nowhere since April. You could even argue since February of 2026, although its one-year performance has been fantastic. You know, it's kind of sitting on the shelf over here. So, $50 billion company. I mean, this is the roughly the market cap that you saw for Unitree. So, Unitree, which was 68836, I want to say. I want to say that was the ticker. I'll double check. Teradyne Robotics in industrial applications. Unitree. I've got 68836. Yeah. Yeah, that's going to be interesting. Okay, so, I mean, that's just an example of some. I'm trying to think if I could add any others. Humanoids. I mean, Boston Dynamics. It'd be cool if they were public. Probably, you know, memory for training. We've talked about that. So, HBM plays, which would, you know, for training. So that's going to be Micron, SK Hynix. Then, let's see here. Boston Dynamics is in. LG, like your South Korean plays. Qualcomm, we talked about that. The only other one maybe that I could think of right now would be like a Cognex. So that's CGNX. We can look them up and do a little bit of a look into them. We might do that right now. What is that? TAO for incentive layer for LLMs and drone robotics. 128 subjects are go invest in one before everybody else. What is incentive layer for LLM drone robotics? Go invest in one before everybody else does. Samsung, yeah, sure. Samsung would be in there. I'd agree with that. Samsung, I guess you throw in LG as well. Samsung, LG. So what is this? TOA incentive layer. Okay, I'm gonna look up TOA incentive layer. I don't know what that is. Okay, so what others? I mean, that's a pretty good robotic set. Obviously, I mean, the compute side would benefit, of course, too. The infrastructure plays. Compute infrastructure likely wins as well. That second S-curve, which, of course, would be SpaceX, CoreWeave, NBIS, etc. Oh, it's a crypto incentive. Like, okay, yeah, that's why I haven't heard about it. Okay, yeah, I didn't know about that. I'll have to look into that some more. Okay, yeah. Let's go back to the journal piece. For LLMs to process images and audio, they have to be trained on the media directly. Huh. Okay. Trying to process a 3D scene in this way has always proven massively inefficient. yielding models that are too slow to direct a robot in most situations when we're looking at, for LLMs to process images and audio, they have to be trained on that media directly, turning the inputs into tokens. But that's too slow for the 3D, basically. Okay, so how does that work then? But the world models come with their own set of issues. Yeah, I mean, so that's interesting. So, you know, if they're not using tokens, then I guess what would you use? Okay, so let's see here. World models come with their own set of issues. It was relatively easy to evolve GPT from one layer to the next precisely because it started out only playing with text. As LLMs grow, they are crammed with more and more data. Right, this also assumes that this GPU layer is as functional, right? So this would be assuming the current GPUs can help with robotic training. Okay, so I Googled TAO, I guess. Bit sensor, decentralized AI network. Relative to 3D training. I see. Okay, subnets are dedicated to tasks like 3D gen, synthetic data, compute provision. And Jensen endorsed BitTensor in March of 26. Okay, so robots require massive synthetic data. We know that. Okay. Large action models. Okay. That's going to be the big question. Wall Street Journal, I'll say. Wall Street Journal, oops, suggests compute is different than LLMs with converting text, image, audio to tokens and then processing. Okay, so they say that here. Let's run that over. This is, okay, let's see here. As LLMs grow, they are crammed with more and more data. They get bigger and smarter, but they continue to make mistakes. With robots, there are far fewer scenarios where we would accept hallucinations. I mean, that's fair. That's understandable. Real world is very complex. A lot of edge scenarios. Right. I mean, that's a fair red flag. So flagging that edge scenarios and hallucinations would be more unacceptable and dangerous in robotics. Yeah, I agree with that. Definitely agree. Okay. Okay. Going back here. Well, some thinking efficiencies in LLMs might make them enough to become AI that powers robotics. A hybrid concept exists. LLMs could call on world models. Okay. That's it. Okay, interesting. Large action models are called LAMs. So let's understand this a little bit. LAMs, large action models. So this would be, you know, all the sensor inputs, LiDAR, like we mentioned before, the video feeds, etc. Okay, they're called action tokens is what you get. Interesting. Action token instead of text token. I mean, that just sounds like it's going to be an insane amount of trading that you need. So I see. Okay, NVIDIA's Groot, which is 2 O's, or 2 zeros, combines text tokens and action tokens. it's sort of like a unifier. Interesting. BitTensor, these are crypto tokens separate from these machine learning tokens. And that's to encourage people to have to generate synthetic training data. I see. Okay. Tau BitTensor is a crypto token incentivization system, not related to machine learning tokens. I see. Okay. What incentivization? Did I not spell that right? Or am I making up a word? Maybe I'm making it. No? All right. Stupid Grammarly. That's why I unsubscribed. Bottleneck for Lambs is not text data, but high quality action data, which is scarce. Oh, that's why they're using video games. That's actually very interesting. So this is probably partly why we see Meta also, right? Meta putting glasses on employees to track worker actions. Amazon potentially tracking delivery drivers. You've got, what's it called? Video games. That's what we saw earlier. Video games as a simulation for robots and simulated sort of human movement. I mean, video games already do this really well, right? Like, think of the character movements that you get in like a Call of Duty or whatever. They're actually very good already. VR probably helps, but boy, I think that's why in the NVIDIA example, NVIDIA showed employees using Apple Vision Pro and a Meta Quest. I saw that. That was in this video. Let's just copy the video link directly. Okay. So we can sort that, or cite that rather. Interesting. There is talk that this might be exactly why Microsoft bought Activision. Wow. Rumor that Microsoft bought Activision for the game engine IP for robotics. That was like the 4D chess move. That's crazy. I wonder where that... I'm going to go look at that. Microsoft Activision for robotics. Yeah, see, just a regular AI result here says, oh no, they don't use it for robotics. Right, sure. Microsoft independently advanced robotics. AI for the physical world. First robotics model. I could see it. That's an interesting rumor. But I am going to mark that as a rumor. Okay. Oh, I did mark it as a rumor. Okay. Okay. So, back to the robotics piece over here. Oh, I don't think we really had anything else on this. It's just understanding this large action model concept. Large action models. Let's see what comes up with that. I mean, there's a lot that comes up with it. Let's see what comes up in the news side. News. Let's see. Here's somebody who's just got a blog on this. Large action model, generating actions. How do they work? Okay, here we go. Lamb. Oh, but this sounds this is more agentic. That's an agentic use. Oh, I see. That's why people also talk about action models in the form of, like, Salesforce is talking about it, not for robotics, but rather for, like, agents doing stuff. Just as LLMs made it possible to automate the generation of text, LAMs may soon make it possible to automate entire processes. Recent months have seen an emergence of a new powerful trend in which large language models are augmented to become agents. Okay. Large action model is a type of Gen AI that can perform specific actions based on user queries. These models not only analyze data, but then take actions based on the findings. Right. So you basically have, there's a LAM, how should I put it? So LAM for agentic AI and LAM for robotics. Two branches, I would almost call that. Okay. Yeah, let's write that down. I think that's a useful distinction here. Two branches, we should say. So branch one would be LAM for agents, agentic AI. And then the second branch is LAM for robotic AI. LAM for robotic AI. This is still, this kind of LAM, this is still text token work with sort of, I mean, basically just like orders of operations, like things we got to do in order, right? So like one prompt triggers the next, aka one prompt triggers next. Okay. And then here, the robotics one, this would be physical environment. So that's going to be, hey, we need to move your feet or whatever, really early robotic movement, etc. Yeah, I could see that being the next frontier, basically. I'll call it that, the next frontier. You know, kind of pun intended there almost. Okay. So that's interesting. I mean, that could give you, that's what could actually give you a boost on some of those memory stocks. But yeah, I mean, a lot of debt flowing in right now. So hopefully that sort of helps move the growth estimates out longer, and you can kind of keep the boom going, because you don't really want the boom to end. Because it's just a nasty recession. Silver as a precious metal in manufacturing. Yeah, that's true. DJI Neo 2 can follow the robot. The Neo, those drones are freaking awesome. I have the Neo 1. I think it's great. That's incredible. Okay. Next. Let's go see what's going on over here.
To really have them working together in a unified way, that's critical for both economies.
Well, and as you mentioned, it's not just the consideration of Canada as a trading partner, but Mexico too. And I wonder, in your mind, what perhaps a bilateral agreement here might mean for separate negotiations happening with Mexico, and what it might mean, frankly, for odds of renewing in some form or fashion the USMCA agreement.
Well, I think Mexico is obviously watching these negotiations very clearly. They have their own set of conversations going on with the United States, but they too are very interested in relief on some of these 232s, in Mexico's case, particularly auto. So they'll be watching. I think we'll come quite quickly to the United States following this agreement to ask for a similar treatment. Whether that means we'll get an agreed upon USMCA, continuation extension for the duration. I think that's less clear. I think there's a lot of different issues to work out, whether it's transshipment, Chinese investment, a whole range of things. So these bilateral agreements don't necessarily mean that the whole that everyone is going to jump on, this extension for USMCA. But either way, it's promising for all the trading partners involved.
Well, I'm glad you mentioned China specifically, Sarah. You obviously oversaw that relationship at the USTR and worked closely on this issue. In light of the president's threat of economic D-Day against Iran and in his suggestion that basically any country that is facilitating or the transfer, the smuggling of, or the purchasing of oil from Iran could face severe economic consequences themselves, I wonder if you have an idea of what actually that could look like and what China's response may be if we were to, say, implement secondary sanctions or more sweeping tariffs on Chinese goods in retaliation, how quickly they could retaliate in turn, or if it's likely to make them compliant with what the U.S. wants when it comes to
that is a challenge for the administration, is that they are very carefully trying to maintain this détente with China, particularly coming into the September 24th meeting with the president. And there are so many issues at stake between China and the United States right now, whether it is...
Yeah, this is boring. We know. Trump doesn't like China.
For anyone holding kind of a broad basket of them to do well. But what are you thinking about when it comes to what's in the basket for the back half?
That's a great question. So valuations in small caps are interesting. In the U.S. and international, we have, you mentioned ABUV, the U.S. fund. We have an international version, ABDV, that is basically the same strategy in international. It has some terrific. Both of them have outperformed their benchmark by around 4.5%.
That is it sounds like a really thick Italian accent. I can't understand a word the guy's saying. I gotta put that down to 0.5 speed. It sounds cool. It's either Italian or Spanish. I don't know. I'm leaning towards Italian. It sounds more like it. All right. So how's gold doing? I'm gonna take a look at that. Gold. Ooh. 47. Look at that. So the dollar devaluation really helped, huh? Oh, it certainly has. We still have not gotten back to our Warsh peak, but that's not bad. That's a nice, 15%-ish gain there from the floor. That's not bad at all. Good for them. The gold holders. Alrighty. Okay, let's do a little bit of a breakdown with what we've got on robotics here. I think we've done a lot of intel there on robotics. Let's do a breakdown on that thesis. And let's see here. Brain surprisingly, that's fine. Ghost job ads are getting so bad that lawmakers want to ban them. Employers keep posting roles that never seem to get filled. Well, that would be annoying. Applying for jobs that are basically fake. So, but why? Ad for a role with great pay. Sure, applications sometimes fall into a black hole, right? But as many as 1 in 5 cases, the company has no real intention. So why? Why do they exist? Spilling over. Is it just to make it seem like the company is hiring? Post less than real ads to build a pipeline for jobs that might open up someday. Oh. Or in case they reel in a dream candidate too good to pass up. Interesting. So you're not really heavily motivated. You're just somewhat motivated. I see. Okay. Okay. One sec. Okay. Cool. So That makes sense. All right, let's go jump into... Yeah, the robotics. It's really robotics, Micron, AI, Kenny G. I mean, there's really a lot we could talk about because Kenny G apparently liquidated a massive portion via block trade of their investment. Let me pull this here. It's pretty big. In this effort, we have completed nearly 100 block trades totaling over $4 billion in market value. These included the largest intraday block trade of the year in 10 different names. Wow. So 80% offloaded. Wow. Interesting. So they've already paper-handed out all that they... Yeah, I mean, they got a good deal on it all, so you can't really blame them. Okay. All right. Cool. Let's now, let's talk robotics and Anthropic and Micron and robotics. Man, that's a lot. I gotta write that down. This is gonna be a lot to cover. Okay. So we got... well, Ken G. Okay. Citadel. Anthropic. Then Micron. And then robotics. Okay. All reasonable. And then how is the market holding on right now? It's stable. See, look at that. You cannot get the Qs above 715. Philly. Okay. Let's touch on this. So. There we go. In this segment, we've got a lot to talk about, including how Citadel just paper-handed their investment into, well, 80% of the stocks that they bought from Leopold, who ended up getting Leo folded. We'll talk about that. We'll talk about the Anthropic IPO and why this matters for the AI bull market. We'll also talk about Micron and the problem but potential upside with Micron, so this will be really exciting. And then we'll talk about robotics, which actually really potentially helps Micron and a bunch of other names. We'll talk about this in large action models. There's a lot, so let's try to break this down as simply as possible. So first things first, Citadel. Citadel already offloaded 80% of their quote-unquote aggregate risk associated with a situational awareness stock portfolio. They completed nearly 100 block trades, totaling over $4 billion in market value. So my guess is, even though their institutional analysts are coming out, like I was literally last week reading a piece, and it was Citadel, 10 reasons why we're bullish on the market. And then you hear, oh, but JK, we've actually liquidated a lot of our positions that we bought from situational awareness. My guess is what happened here is when they picked up the portfolio on July 29th, we believe it was the morning of July 29th, we had such a large rally back in some of these stocks coming up, 20% in the span of 2 days. The ROI to basically dump the stuff right back on the market was just too great to pass up in such a short period of time. They would have made more money if they held more. But I do think it's interesting that they've paper-handed. And so that's led to a lot of people wondering, did they paper-hand because you have the next big suckening coming up? Maybe. So Anthropic is now trying to beat the SpaceX IPO. So SpaceX IPO'd and raised $75 billion, biggest IPO ever. Plus the green shoe, they ended up raising up to $86.2 billion. That was really impressive. But now everybody's kind of on pins and needles waiting for the Anthropic S1 because we want to see what their profit actually looks like. See, they're disclosing that they're actually seeing an adjusted operating profit. But a lot of people hear adjusted operating profit and they're like, what are you adjusting? The assumption is that what they're adjusting is all of their training costs. And so a lot of people are like, all right, whatever. We can't, believe a word this company is saying. Here's the quote. Anthropic saw a positive adjusted operating income for the second quarter. Yeah, that's great. But if you're adding back in your training costs, which in my opinion are like a pretty critical component of your costs of goods sold, you wouldn't have one of the best frontier models if you didn't train. And you kind of got to keep training to stay the best, otherwise you'll fall behind. The S1 is going to reveal the true story. So even though they're telling us, they're at $65 billion of ARR, that's great. But think about what that means for a moment. Elon wants to sell SpaceX compute for, somewhere around $40 to $50 billion a gigawatt. Well, in order for you to sell compute at $40 to $50 billion per gigawatt, you have to have way more revenue to justify that. Some people come out and say, oh, well, they're making $100 billion of ARR per gigawatt. But wait a minute. Anthropic is estimated to have between 1 to 2 gigawatts of compute. And right now, they're at 65 billion. Which means right now they're spending they're earning 32 to 65, right? 65 if they're only at 1 gigawatt. I think they're closer to 2. So they're probably only earning closer to $32 billion a gigawatt. And Elon is trying to sell them compute for $40 to $50 billion a gigawatt. That's upside down. Over here, it's decently low margin. And, if they're over here, they're upside down. So there's a little bit of a problem with how much Anthropic is expected to be able to earn compared to what their compute costs are. That's why people are looking for the S1, and that's probably why you're getting a lot of people going, let's see what this filing actually looks like, especially since debt levels are going absolutely crazy. Look at this piece right here. We sit at $3 trillion of off-balance sheet commitments, which represents $1.2 trillion in not yet commenced leases and $1.9 trillion in purchase commitments. In other words, we got $3 trillion of off-balance sheet debt that we're not even aware of right now. And when you factor in all of the other debt that already exists out there and is getting added together, we could probably start knocking on the door of $10 trillion of AI build-out debt. So that would be a combination of the off-balance sheet liabilities plus the on-balance sheet liabilities, the money companies like Google and Meta, SpaceX are raising. You combine all of that, you could be knocking on the door of $10 trillion of debt just for AI and the AI build-out, which is eerily similar to the top of the 2008 financial crisis, when the $10 trillion mortgage market was collateralized into multiple different Wall Street assets. And so when the real estate market came down, so did all those derivatives. And well, we all know how that played out. But right now, the level of debt growth on this hope that Anthropic's going to be able to keep paying their bills keeps expanding. Look at this. We just heard that Broadcom is seeking to raise up to $100 billion through a special purpose SPV, a vehicle, so special purpose vehicle. Broadcom is in negotiations with Blackstone and Apollo Group Management to raise over $60 billion in senior secured and 30 to 40 in subordinated tranches, with Broadcom offering guarantees. So here's the problem with companies offering guarantees. Those guarantees don't show up anywhere on their balance sheet. It's not like when NVIDIA guarantees, $100 billion project for OpenAI. I could go open up the balance sheet for NVIDIA and go, there's the $100 billion guarantee. We don't see that. It doesn't show up. And so one of the things that this article is arguing on Broadcom is that Broadcom's trying to quickly get in and raise a bunch of off-balance sheet debt, quote, before the SEC potentially changes the rules. But so far and lately, the rule changes are actually going in the opposite direction. just a week to 10 days ago or so, Jensen announced this $500 billion incentive financing structure with KKR and these other suits on Wall Street. And that came immediately after the SEC removed the asset-backed securitization rules for data centers. The bottom line of that meant data centers don't have to disclose their utilization rates, what's inside of their asset-backed securities. You don't require skin in the game anymore. Like, those regulations were removed. We're going in the opposite direction. We are removing regulations and limits on this debt. And that is in part why we're seeing credit default swaps rise. So you've got a lot here. Citadel dumping, not a surprise, they're traders. Then you've got this big Anthropic S1 coming up, which could potentially reveal massive holes in this whole profitability argument that, Anthropic's going to be able to pay, they're going to make $100 billion ARR for every $50 billion they pay in compute. Well, the numbers right now don't seem to justify that. Maybe they'll grow into that. We'll see. But that's also why we're seeing credit default swaps now skyrocket. So you could obviously see this credit default swaps right here. These are the CDSs. Oracle is up here at the top, which has surpassed its peak of right during the Leofold event. So Oracle surpassed its peak. You've got Broadcom, which just rapidly surpassed its peak. And then you've got NVIDIA, which is roughly at peak, slightly above peak credit default swap. Interestingly, the only company that actually re-rated lower or de-risked was SpaceX. SpaceX seems to have de-risked in the credit default swap market. Interesting, maybe because of their money raise or whatever, but I personally think SpaceX is going to have to raise a lot of money. And that's not trying to be bearish on SpaceX, it's just Elon wants to generate this or get to 10 gigawatts of compute. But how are we going to get to 10 gigawatts of compute? See, here it is. Right now, SpaceX ended the second quarter with 1.4 gigawatts of AI compute capacity. The stretch goal is getting to 10 gigawatts of compute by the end of 2027. Well, at 50 billion per gigawatt, especially if you're spending on the leading edge chips, which you likely will, the Vera Rubins and otherwise, that's $500 billion they got to come up with. So what's their balance sheet? Well, their balance sheet is sitting at $87 billion to work with. So we need, 414 to roughly $430 billion of extra dollahalas. So where are we going to get extra $30 billion? Financing. SpaceX has actually made that clear that their expectation is to finance the majority of their capital needs, which is in part good for shareholders because you don't want to see a lot of stock dilution by them issuing stock, especially $400 billion worth. But I mean, it's a lot of debt and rates are high and somebody's got to pay this and debt keeps getting more expensive. Tesla or SpaceX actually had to increase how much they were willing to pay for their debt in one of their latest bond offerings, but they're still only paying like 7% on their debt, whereas CoreWeave is paying 9 to 10% on their debt. So SpaceX is still in a better spot. I think they're paying somewhere around 1.5 above Treasury, somewhere around there. So it's like 6.5 to 7%. But anyway, the Wall Street Journal is projecting, and this blew my mind. Like, my estimate was, SpaceX is going to raise, $400 billion in debt to go get to 10 gigawatts of compute. You ready for this? This blew my mind. The Wall Street Journal projects, well, actually, it's not the Wall Street Journal. It literally just says Wall Street. Wall Street apparently is projecting SpaceX is going to spend $1.3 trillion over the coming 5 years. That's crazy. So in other words, like, the spending is just continuing to go. And that's obviously what's leading to so much enthusiasm at companies like Micron. And so we actually put together some charts. You could get all these charts over in the Meet Kevin app. You could download that for free. You could also get your Alpha Wire over in the Meet Kevin app. I actually have it up and running right next to me. And this is sort of what it looks like. Oh, look at that. SpaceX AI expands Grok bot availability to Super Grok Plus, Cursor Pro, and Cursor Teams, whatever. So if you want to see this and not get too distracted by social media, I think it's kind of cool. You can download that in the Google or Android App Store. Sorry, Apple or Android App Store. Just type in Meet Kevin and it should come up. But anyway, let's talk about Micron for a moment. So what's fascinating here is that this is a chart of Micron's earnings per share historical on the left side and their forecast for 2026, 7, 8, and onward. except this is their growth rate on earnings per share. So as you could see, historically, we have these booms and busts where you get 100% up on growth rates, and then it comes down negative 30%, and then it's up 100%, and then it's flat, right? Just to show you the magnitude of growth rates that we have seen for these high bandwidth memory plays like SK Hynix or Micron, which represents about 18% of their revenues. The growth rates have been so magnificent that you've gotten this insane spike over here to where, just to put it into perspective, if I take their forecast earnings 5 years out and I just jack up their earnings, so I'm going to go like jack them up as much as I can, and I'm going to literally 5x their earnings. The blue line I'm about to show you is going to show you their EPS growth rate if you 5x their current forecast for 5 years from now. Right here. That's it. This little jump is all you would get. So instead of getting a relatively flat blue line right here, the green represents what, you know, we could see potentially with, the green would represent without buybacks, the blue represents with buybacks. Getting a little granular there just to show the impact of buybacks. You could read that over at mekevin.com. I don't want to overcomplicate this video, but the point is, the growth rates are projected to be this on the blue line. If I go in and manipulate the growth rates and 5x it in 5 years from now, which is not projected, they are projecting growth, but not a 5x, right? So I go crazy here. This is all I get for the spike. So the reason I say this, like simply put, the reason I put these charts together is we need a really big next wave of enthusiasm to really get growth rates to skyrocket for especially memory plays. Now, how could you get that to happen? Robotics. That's where robotics come in. See, robotics are really interesting because in robotics, you can maybe have the next S-curve coming from large action models. Now, you have to divide this. So first of all, this is sort of the outline that we have here, right? Let's go get my eraser here. Okay, so we've gone through Citadel, Anthropic, Micron, robotics. Now we're going to talk about robotics. Okay, so here's what's interesting about robotics. With robotics, you have two types of large action models. So like apparently what they call them these days. That's what the kids are calling them these days. Two types. You've got large action models that are agentic, but agentic is really just a text-based LLM going through an order of operations. Okay, if this, then this, then this, then this, then this. So it's like a prompt getting fed in over and over and over again. That's very different if there are two types of LAM, large action models. That's very different from a robot. A robot is going to require synthesizing video data, LiDAR data, sensor data from like fingertips or the feet, if you will, whatever. That's a lot of data. And in my opinion, that is going to be significantly GPU heavy and require a crap load of high bandwidth memory for training. And so this is the next S-curve for the AI play. It's robotics. There's just a little problem with that. And there are obviously some stock names that we could talk about that could benefit from this. But I want to hit the problem first, not because I want to be a bear, I just want to be realistic. So I drew this out. Ignore all the red text for a moment. So if this is where, I think we're probably here on the LLM frontier. So LLMs are really good, but I think the growth rates are collapsing in how much LLMs can improve. That's cool, but you know, it's not great. It means eventually we're going to see negative growth rates. And that's already actually getting priced into some stocks in the AI trade, that if in 4 years from now you see negative growth at a company, you know, some of the storage plays like a SanDisk or an NVIDIA, you start seeing some of those growth rates turn negative unless there's another S-curve. The next S-curve could be robotics, this green line. Best case scenario, this green line shifts over and it picks up at the peak. The problem is, I don't actually think we're going to scale robotic compute until the end of the decade. Like, realistically, I mean, companies are saying 2028, 27, maybe even. I think it's more realistically going to be 2030 or even into the 2030s. I mean, Elon's talking about Optimus robots doing surgery. I can't wait. I think that's great. I think it's awesome, but it's probably 20 to 30 years out. That would be really bad for this cycle, 20 to 30 years. We don't want to wait that long, because if we have to wait that long to get our GPU training over here, you're going to have a crappy lull in between. So there is a very real potential we peak out on frontier LLM AI and the spending and the money raise that's possible. You get a bear market. If we get that to play out before robotics take off, that would be the best time to buy GPUs and other related stocks in the stack. Think about it. NVIDIA GPUs, AMD GPUs, Broadcom and Marvell for the ASICs, application-specific integrated circuits. You don't have to remember that. Just little chips that do a specific purpose. Marvell for edge compute, base station AI for 5G and 6G. This is what Jensen's talked about. Qualcomm, communication chips. Qualcomm chips right here in your phones, Internet of Things, robotics, Qualcomm. Teradyne, the stock's been on a tear. Unitree is really your Chinese competitor for robotics. This is its ticker 6888836. Apparently, I don't know if it's all Asians or just Chinese, but I think it's just Chinese. I hear Chinese are really like 888s or 88. Like you go to the Chinese supermarket and things end in 88. I guess it's like a good luck thing. I don't know. I've never been to China. But high bandwidth memory plays for Micron, SK Hynix, that could be what actually really helps you boost that growth rate at the end of the decade, which is now in decline. So right now, where we sit with EPS projections for the company, buybacks or not, okay? Blue is assuming they buy back 40% of the company. The EPS growth rates don't move that much compared to the baseline because the growth is so massive right now. Like, if you remove this big bump, these buybacks would be huge. Buying back 40% of the company in Micron would be so cool. UBS is projecting that, right? That'd be amazing. But compared to the growth where we are now, here in 2026, it's just, you can't get there again unless you get another S-curve, and maybe that's robotics. Some people say CGNX. I don't know much about this company. It's like apparently a robotics vision AI play. Cognex. Don't know anything about that one. I'm just being transparent. Samsung and LG potentially. LG has a partnership with NVIDIA. And then what would also win or get bailed out, depending on when it comes, is would be compute, right? So like SpaceX, CoreWeave, NBIS, IREN, whatever. The question though is, if we end up, we S-curved up with our LLMs, if we have this big trough before the S-curve for robotic training comes, this is going to be very painful right here in a gap. Best case scenario to kind of keep the economy booming and to keep the whole bubble going, if you will, the party going, to keep it going. Best case scenario, maybe you don't see an LLM cop out, and instead you see robotics pick up right here. So robotics start picking up on GPU training before you get that decline in the LLM training side. And we'll see Anthropic IPO will be a big suckening that will test markets for this. NVIDIA is a big player too with what they call a unifier model. Their Groot model unifies text-based tokens and action tokens. There are a lot of people that are excited about BitTensor to basically incentivize training. This is also why, there is some lack of training data for this. This is why there's talk about Amazon and Meta putting glasses on their employees, and even Tesla, so they could track how their employees operate and create more data for robots in the future. It's like you're training your own replacement, which is kind of eerie. There's even a rumor, or maybe call it an inference, that Microsoft bought Activision because the gaming labs literally have some of the best potential training data, maybe, for robotics. Think about like Call of Duty characters, what's that company? Unity. There it is. Those Unreal engines, those are really good. Like, these are really lifelike movements, and you could actually use those in robotic simulative trainings. So there's a lot of hope for that next frontier coming. There are a lot of requirements to get to that. We also put on the MK app under the data tab, you could see where's the NVIDIA page? We took a little video or a screenshot from the NVIDIA presentation on this. And yeah, we actually covered most of this already. But this is sort of Jensen ends up narrating how this real and simulator data comes in to train robots. This training phase is going to be huge. I think right now it's a tiny fraction of the compute that's being done. But as robotics go more mainstream, that's going to be the future. The next 50 years, there's going to be a crap load of training robots. So if you could have that really long-term time horizon, man, it's juicy. The question is, how much of a debt bubble 2008 do you go through between then and now? Or now and then, I guess, would be the way to put it. So, my take on all of this is I think the Anthropic IPO is bullish short-term because even though it's going to create a suckening, it's going to generate so much capital that's just going to get recycled into hardware. So I still think you'll see this sort of hardware 2.0 rally post-Iran ceasefire. I still think software bottoms in Q3, Q4. Kind of already been seeing quite a bit of that bottoming. Some of the software plays that we're really a big fan of in the course member trade alerts have done very well. Palantir, Salesforce, and we got others as well. From certainly up from their lows, like substantially up from their lows. I think we were buying Salesforce somewhere around 160. It's broken through, I think 210 now or something like that, 205. But anyway. The Anthropic IPO could still benefit markets between now and, let's say, 6 months from now. The question is, when does that curve start turning? That's going to be your big red flag on the cycle. Because when that Anthropic LLM turn starts, you're going to want to pay attention to that. And hopefully robotics have taken over before that. All right, cool. So, let's see. A lot of talking. I need more coffee after that. Lots more coffee would be nice. I'll make some tea. I might make some tea. What do we got over here?
Guard finds it can't pay its Quds Force, can't pay its besieged militia, can't pay its other components. After a while, when you pay a lot of guys with guns and then stop paying them, they may show up on your doorstep and say, "Hey, boss, where's the money?" Causing further destabilization of the regime. We shouldn't be in the position we're in now. The idea we've been at war for 6 months really is comical. We had 6 weeks of American and Israeli attacks on Iran that did do considerable damage that Trump stopped and allowed going back to really April when the Iranian regime began to reconstruct from the damage that was done during that initial round of attacks. I think the confusion in Trump's own mind has severely undercut the military pressure and the economic pressure we could and should have brought on Iran, which is why now elements of the regime, which is very fractured at the top, think time is on their side. They think Trump is under so much pressure because of the elections. I don't see at this point they have any incentive to do much of anything other than continue to try and dig out until the elections are over.
Well, it's one thing to consider the political pressure in the looming midterms, Ambassador. It's another for Iran to be looking at the reporting of the U.S.'s depleted munition stockpiles. Do they have valid reason to believe that, frankly, that the U.S. is limited in terms of what kinetic activity it could pursue going forward? Is the economic option really the only one the president can really take at this point?
Well, I think if you look at these reports of shortages in U.S. munitions, it's principally on defensive munitions to try and bring down incoming ballistic missiles, in particular our Patriot systems. Of course, that's not the only way to prevent incoming missiles from hitting targets in Israel, the Arab countries, our own bases, obviously. One way to prevent that from happening is to destroy the missile launchers inside Iran, which we were on the way to doing when we stopped 6 weeks ago, or stopped after the first 6 weeks. So much of this problem, I think, is of the president's own making. I don't think anybody should doubt that we have the capability to bring overwhelming military force against Iran, and specifically just in one aspect, to bring military force to bear to open the Gulf Arab side of the Strait of Hormuz to get their petroleum and related products out into global markets. That seems to me that should be the corollary to the blockade and other sanctions. Stop Iran from earning money, but do more to help Arab producers get their products through the Strait of Hormuz.
Well, I think that's why they're making more port investments on the opposite side of the Strait of Hormuz, on the Gulf side, so you don't have to worry about going through Hormuz at all. If you can avoid it, why not? More pipeline infrastructure, even pipelines in development to move from like Saudi Arabia or Iraq or whatever out to the Mediterranean. So you're just totally avoiding the Strait of Hormuz. The Strait of Hormuz just becomes less and less vital as time goes on after this. I know in the short term it's like crap, it's driving oil up, but my guess is we'll see the Strait of Hormuz turn into a non-commercial route for oil in the long term. Honestly, I still maintain somebody needs to start thinking up business plans for the Hormuz booze cruise, because that's what it's going to turn into in the future. Hopefully, I mean, maybe I'm too optimistic, but I hope in a decade, you could kind of go cruise the Hormuz like you would the Mediterranean, and it's actually safe, right? That'd be nice. Because nobody wants to go on a cruise and then a drone hits the pool deck or the concierge lounge. Okay, I had to mention I had a great time on the Disney cruise. Big fan. I was obviously we talked a lot about it when we were on the cruise on the videos, but. And I'm so vacationed out now, but that was fun. It's a really, really good sort of life experience with the kiddos and Lauren, so really enjoyed that. Yeah. Okay, anyway. So let's go see how our sticks are moving right now. The sticks! Yeah, Qs are going nowhere. SpaceX, still holding on to 1%, though falling a little bit now. Looks like some of that enthusiasm is now getting squeezed out of the market. Yeah, you can see that trade momentum slowing down here. It's pretty normal. Once you get to lunchtime East Coast, the trade momentum comes out. Wow, Palantir pushing another 3%. That's great. Big fan. How's Salesforce doing? They make so much money, Palantir does. 207. Yeah, they were at 211 earlier. Nice. Siege tactics work, just have to be able to last long enough. Yeah, encircling the enemy and starving him out. That's true. Just gotta survive yourself. How about bonds? So we saw oil was almost 95 now. It sucks. Yeah, almost 95. It's just getting worse. 4.74 on the 10-year. You're killing me. Oh, look at that. The 2-year's actually gone up 5 bips today. In a weird way, it's actually good if the 2-year goes up, because if it's too low, the market isn't pricing in enough hawkishness for Warsh. This really needs to be 4.35 to unprice some of the hawking. The hawk? Let's see what they got over here.
Technicals as it crossed a key support level. Next, dollar debasement as the Treasury has intervened in the debt markets. And finally, renewed optimism on the Clarity Act, with a Senate vote scheduled for mid-September. Cosmo Jiang is a general partner and portfolio manager at Pantera Capital. Cosmo, it's good to see you. 23% and it keeps going, or now is the risk that maybe nothing happens with Clarity?
Thanks, Kelly. Great to be here. We're really excited to see this rally. I think it's important to realize it's coming out of this really long consolidation. Right? Bitcoin has been stuck in a range for the last 10 months and pulled back nearly 50%. And so after you see this period of compression, markets get really wound up. And then when you get a move, it tends to be a large move. And that's what we're seeing happening. Right now, from everything we see, positioning is starting to reverse. People are going from very much on the sidelines and even net short positioning to now realizing they want to be long.
Yeah, I mean, August or the 19th was a nice little catalyst. You gotta give credit where credit's due. That was very useful for the crypto market. I want to look at this. Let's talk about this here. All right. CNBC is now reporting that Manhattan rents have hit an all-time high. And, you know, I don't want to be the person to go, I told you so, but I hate to say it, a year and a month ago, I made this video and I called it, Why the Rich Secretly Love Mamdani for Mayor. And a lot of people got mad at me for saying this because they're like, oh, this is like reverse psychology, blah, 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 you don't like Mamdani. I didn't say that. I simply said, and you can see it right here, it was only a minute into a video when I said it wasn't that hard. So what I wrote is that if you have a rent freeze or you disincentivize building vertically, you can see the transcript right there, what ends up happening is prices go up. And so we expect that in Manhattan or Brooklyn, prices would go up because fewer people would end up buying real estate. Fewer people would develop real estate. That would end up leading to fewer or constricted supply. And there it is. Democratic policies that constrict supply have historically led prices to go up. You see this in California. You see the opposite in Texas. And you would expect it to happen in Manhattan. And what a freaking surprise. Here we are. Manhattan rents hit all-time high. Here's what we know. Well, let's listen and, I guess, hear what we know.
Manhattan rent hitting a record with the wealthy choosing to rent rather than buy. Robert Frank is at the table this morning. This is a sort of interesting shift.
Institute more taxes, pied-à-terre, you know, held up in the court process, then authorized to continue going on through appeals. It's a giant mess. Of course! More competition to rent, less supply. It's basic economics.
Interesting because we've talked about record rents in Manhattan before, but this just keeps going higher. Rent in Manhattan reaching an all-time high, driven mainly this time by the very wealthy. Median rent reaching an all-time high of $5,000 a month in July, and the average rent now over $6,000.
I mean, that is a lot for the vast majority of the country. But just to be clear, that represents about a $5,000 rent would represent about $1.1 million, maybe $1.2 million value property. In parts of Manhattan, that's getting you like a 1-bedroom. In Brooklyn, maybe you're getting a 2-2. You know, you're not living a very spacious life. You know, a lot of these, even a studio in Manhattan can run $600,000, $700,000, $800,000, and the rent for that's going to be somewhere around $3,500, right? So obviously, relative to the rest of the country, these are extremely high rents. But I would not say that you're very wealthy because you're paying $5,000 a month in rent in Manhattan. Like, you're trying to get freaking by, man.
$300 a month for an apartment. That's according to the Real Deal report by Jonathan Miller. Now, the biggest moves are at the very high end, luxury rentals. So that's the top 10% of the rental market. Saw prices up 35% compared to a year ago. Right. Median rents in luxury now close to $14,000 a month, and we're even seeing
median in luxury at $14K. I mean, those are high levels. Those are, yeah, that's going to get a little pricey. And it wouldn't be a surprise that the wealthier end is also like, all right, whatever, I just won't own, I'll rent. Honestly, with rates the way they are too, that's a logical decision anyway.
Six-figure rentals. That's right. There have been at least 7 apartments this year renting for over $100,000 a month.
They're kind of turning this into like a talk about luxury, which is fine. But overall, this is statistically what we're seeing reported by the Journal and other places as well. And what's interesting is even if you get, you know, like the $14,000 level, folks absorbing rental supply, you're constricting available rental supply for even other levels because now the, you know, $10,000 a month person has who might stretch to 13, 14, 15 or whatever. Now all of a sudden there's less supply for them to shop at. So now they're stuck paying more for a 10K property. That's now going for maybe 11. The 9K renter is now paying 10, you know, whatever. It trickles down, unfortunately. Makes it more expensive for everybody is the point.
Makes owning a second home more expensive and less predictable. Some affluent buyers will naturally reconsider whether purchasing still makes sense.
Yeah, not at 7%.
Now, for more on the high-end real estate market and how the wealthy are responding, CNBC we see shows from is just driving demand. And on the supply side, you've got this rent freezes on rent-stabilized apartments. So 1 million of the 2 million apartments in Manhattan are now frozen. Right. So if you're a landlord that owns multiple buildings, which many do, you're frozen on one side, you're going to raise them on the other. So we're just going to see them increase. And by the way, on the wealthy side, it just makes sense if you have a pied-à-terre, given the cost now, to rent.
This is exactly what we predicted last year. And again, not trying to like pat myself on the back. The whole purpose here is just to say, this is what happens when you get interventionist policies into real estate to try to drive affordability. What you actually end up doing is you drive less affordability. The way to increase affordability in real estate is very simple. You need to build more homes. You could build a lot of homes in parts of Utah, in parts of Arizona, in parts of Austin, Texas. And if you can have a lot of land, keep building homes, you will drive down that median price for rent and for buy. You restrict growth because you have policies like Manhattan does where it says, oh, we're going to disincentivize you turning this single unit apartment that is 100 years old into 16 units. We're going to say you could only turn that into 4 units through, you know, these liabilities or regulations or this, that, or whatever, which is practically what happens. I'm skipping some of the details here. But now a developer says, all right, whatever, I'll just build 4 units and sell it as a residential rather than building 16 and going up another 2 or 3 stories. Again, you're constricting supply by government policy, which makes rents unaffordable.
Markets so they could compete with the free supermarkets? That's what that was happening over the last couple of days that I saw, that there is an idea that they need help, that the competitors to the free supermarkets.
The supermarkets haven't even opened yet.
I know, but already there's talk that they're going to need help to be able to.
Well, there's a discussion. The discussion is happening mostly online, but there was somebody who was interviewed that's part of the administration, I think, to some degree, and there was a question of Mark about what happens to the supermarkets that are in the neighborhood of the other supermarkets.
That's why exempted the profitable stuff, which is cigarettes and liquor and lottery tickets, which is how most like bodega
they
type
don't
things
get sold at the free
and they're not going to get sold at the free one. So that was
you
a
know
gimme
about
to the
all
rest.
this stuff.
I mean, I haven't heard about the latest debate of subsidizing.
Tangential discussion here about the grocery stores that Mondani is trying to open. It's a crazy business to get into. We should go look at like the Albertson stock. Jim Cramer was pumping Albertsons yesterday. Maybe we need to go look at their financials really quick.
Who were suggesting that this idea could actually become popular and start sweeping the country because, again, goes back to giving away things to people.
Well,
and
you
whatnot.
look at these rent numbers.
Yeah.
And it makes sense that a lot of people elected a socialist mayor. I mean, when an average apartment...
Right. Rents are high, but then you continue to restrict supply, you just make it worse. That's the problem. It does make sense as a reaction function to go, oh, rents are too high. We need to, figure out how to lower rents. We got a chat here that says, what would be the way to bring prices down in Manhattan if space is limited? It's exactly what I just explained. What you have to do is you have to have the same incentives for building more units, or maybe even better incentives for building more units, rather than incentivizing building fewer units. You see more conversions from a single apartment to a duplex or a fourplex than you do to building vertically and going to 8 units or 16 units or 32 units. Because once you go over 4, you run into insane problems with permitting in Manhattan. If they said, we're going to incentivize getting rents down, we're going to make it easy to build vertically, you could literally build infinite supply in Manhattan. Infinite supply. Because you could just keep building up. There's plenty of room in Manhattan to build more towers. Now, obviously, then traffic goes crazy and people don't want that and stuff. I'm just making an extreme argument that you could build a whole lot more. You've seen it in Brooklyn. Brooklyn, getting a lot of conversions from single units to duplexes, quads. Why are they not going to 6, 8, 16 units? Permitting. It's the same process over there. So anyway, the more liberal the local policies, my bottom line takeaway of this, the more liberal the policies, the more likely prices are going to go up over time rather than down. Then you look at an area like Austin, Texas, where you see really conservative policies. You actually see prices come down 25% off their peak because these conservative policies mean, hey, free right to build. quick, easy permitting. Permitting's not really a roadblock to building supply, so in boom and bust cycles, supply overexpands and prices come down, and then all of a sudden, rents and prices are down 25%, and people are like, oh, wow, yay, things are more affordable. But then the existing owners are like, ah, crap, things are more affordable, But it's the benefit to, people who ordinarily, like the irony here is that a vote for a liberal politician is actually a vote for higher prices and higher rents, whereas a vote for a conservative politician is a vote for the free market, and typically the free market correcting those high price distortions. That's why I personally try to only invest where there are liberal politicians in terms of real estate, because I actually think they are a put option for the underlying real estate, because just keep setting prices up. Kind of counterintuitive because, a lot of people are like, yeah, but I don't want to live in a liberal area. Fine. But it's a strategy. It's something to think of. All right, let's go back over here.
Perspective, it's really about follow the money. We're seeing CapEx numbers continue to go up. We're seeing the companies that are doing the building of the AI infrastructure layer that are just flat out in terms of demand. And so we look to the fundamentals, and the fundamentals look good.
So it doesn't sound, Jason, like you're particularly worried about some kind of imminent market bubble. And I'm not saying that's what JP Morgan Chase was saying, but their technical team was basically saying there are similarities in the run-up in 2000, and we all know that didn't end well. Do you think these types of companies that we're seeing public now are very different than 26 odd years ago?
They are very different. I think there are always some similarities across cycles. But I think those similarities are pretty weak. When we look at, again, the fundamentals, I guess that's the word of the day, the companies that are issuing a lot of this debt, whether it's Broadcom, whether it's the big five companies, Oracle and, Amazon, et cetera, that are building out data centers and debt has gone up, to be sure, and certainly, they're making big bets here in AI. But I think that's because it's just so dang transformational that the long wave growth of AI over the next several years is a secular growth story, and demand is still far outstripping supply. So we think it's.
I'm going to do another deep tease, as Contessa would call it. Later in the show, we're going to talk, Ben, about how much debt is coming out around AI. Debt by itself, not a problem. But there was a Wall Street Journal piece the other day where they talked about maybe upwards of $3 trillion in off-balance sheet liabilities.
Yeah, we were just talking about that. We literally just talked about that. It's crazy. You're crazy.
Would you agree that because you've got two private companies, OpenAI and Anthropic, kind of driving things, a lot of off-balance sheet stuff, it is very easy for the market bears to make a case about being nervous?
Yeah, I certainly.
Ben.
Oh, sorry.
Me first, sorry. No problem. Yeah, I was actually going to say, Brian, a lot of this debt is also tied to equity, right? So these companies have actually, let's say that the hyperscalers fund OpenAI and Anthropic basically in their equity, and that risk of equity tied into the bonds that are being issued, that's, I think, some of that makes people nervous, as in, you can tell from that CDS market, now it's Broadcom that's really blowing out. The other day it was NVIDIA, because they're all doing the same thing. If you continue to sponsor the equity of companies like Anthropic, and then anything off balance sheet, there's a bit of a, let's say, sort of a scar from the financial crisis here too, right, where we had a lot of off balance sheet vehicles out there that ultimately became a real problem for the economy. What does this mean in this case is off balance sheet, activity that we're seeing playing out. So I think that's the nerve here. That's big.
Yeah, Jason, you want to jump in?
Yeah, I mean, I would echo what Ben mentioned, but I would also say we have to come back to demand, because these things just can't be flipped on immediately. A lot of this debt and a lot of the off-balance sheet activity, a lot of the financing that Wall Street is bringing to bear on this AI build-out is because the lead times here are multi-year. And so this doesn't have us concerned when we think about matching cash flows and revenue. As Jensen says, compute equals revenue, and we look at the amount of debt that's being used. It's still very much a self-finance, for the most part, AI build out, with some capital efficiency being brought in through favorable debt rates that these companies are getting.
Jason, great to talk to you. Thank you for chiming in here. Ben Emmons, nice to see you. Thanks, guys.
That's kind of boring. Okay. Let's see here. Supreme Court lets Trump administration continue construction of the ballroom for now. Really? Interesting. Yeah, that's just coming through here at 11:06. Interesting. Okay. Well.
Bond market this past week. Sarah, how do you see it?
I think that it was a surprise that he came out and said this is what we're going to do in the long end of the curve. I think everyone's been looking at Chairman Warsh, and looking at the Fed and seeing what's going to happen with interest rates there. I don't think that people were expecting the Treasury Secretary to come out and make his own news on this particular front. And I think there are, as you can see, quite a lot of questions about, one, how this is actually going to work mechanically, two, whether or not this is going to actually help the long end of the curve, which was arguably the idea, because you've round-tripped that already.
Because it did and didn't.
It did and it didn't. And on the other hand, gold is just like, okay, we're gone.
Yeah.
And it just is going again today. And I think that that's, whether or not the only signal that gold gives is that we don't like anybody else's decisions, or it's just a way to play a different angle. I think that you're seeing that reverse in interest rates didn't reverse gold. So that may be an anticipation of further movement.
Gold up 5% this week. So yeah, we've seen a big move.
I mean, Ira, where do you stand on this? Now that this is Friday, it's been a couple days. Yields are still moving up.
Yeah, yields are kind of flattish, right, from the beginning of the week. So yeah, it did a whole lot of nothing. Devil is in the details here a little bit. So we won't find out the exact size. He says maybe next week that they'll tell us more information. I did think it was really funny when Scott Bessent said, we're doing this because there's low liquidity in the middle of summer and things like that. But this doesn't start till September 9th. So I'm not exactly sure.
Technically the summer, right?
I guess, but it's not August. It's not now,
yeah,
right?
Not the summer.
And in fairness, I was looking at the depth of the market actually right around the time that he said that. And actually the depth of the market was not bad, right? The depth of the market was your typical summerish levels, not insanely low. So it's not like they really needed the direct liquidity support here.
That's what I was going to say. Political, or did the market need this, Sarah?
So it's interesting. I think that people have been concerned globally about rates rising, especially on the long end. And that's been a problem for investors. It's been a problem for all these companies that are now trying to finance the entire AI build out.
Government.
So the question is, are we doing something because this exact amount of money is going to make a change? Or is the fact that we're saying we're going to do something, reminding everyone that the government can come in at any time and change the game? And I think it's a little bit, to me, of that. I don't know how you feel about that, Ira, but that was my take, was a little bit like, we're going to do something and not just stand there and let the market figure it out.
Yeah, I think they did this, and it was kind of underwhelming, right? It's kind of like the Federal Reserve in December of 2007 when they did they did a $40 billion program for a $300 billion problem, and it's something like that. Maybe there will be a little bit more shock and awe, but there are risks to what they're doing too, right? Like if they're going to issue a whole lot of T-bills in order to buy back a lot of debt, and let's call this what it is.
Yeah.
If it's going to work, and if
it's not going to work. The interventionism, it never works.
Getting long end yields down. They have to do this in size. And we have to then call this an Operation Twist, similar to what the Treasury Department did in the 1960s. And if they do that, the one big risk for them is what happens if the Federal Reserve has to raise interest rates, because they're going to be issuing T-bills, which capture that interest rate move almost immediately compared to 30-year debt, which obviously
because they're issuing short-term debt to buy down the long end. So they're going and buying, 1 to 2 year stuff. It's crazy.
A move from the Fed?
I'm not sure what the answer to that is, and I don't know if there's any actual coordination going on that we don't know about. I mean, what we see is what the headlines are. We don't see what everybody's talking about behind the closed doors. So whether or not there is a conversation, I couldn't tell you. One would hope that there might be some sort of coordination, or at least an understanding, because otherwise then you start to look like you've got the government departments fighting one another. So what's your take on that?
Well, I think that they're not coordinating, because if they were coordinating, then the Federal Reserve would not have stopped buying T-bills. The Federal Reserve was doing these reserve management purchases, buying $10 billion of T-bills every single month. So if they were coordinating, and Treasury Secretary Bessent said to Kevin Warsh, hey, we're going to be issuing more T-bills to buy 30-year debt. How about you buy some of those T-bills? Well, the Fed's not buying those T-bills. So if there was coordination, it was pretty poor.
Is this President Trump potentially too saying, hey, Scott Bessent, I need you to do something because my Fed chair isn't doing something?
Yes.
Is it possibly?
Yes.
I don't. Absolutely possible, right? Because again, I think we're all
it
trying
is.
to understand.
It's exactly that. It's like Kevin Warsh isn't doing his job. Bessent, you handle it.
Okay, so do we get answers at Jackson Hole this coming week? I mean, we have
Yes.
a Fed chair who has already shown he doesn't like to say a lot or lay out the metrics of what metrics he is following and the Fed is following, the FOMC, in terms of figuring out monetary policy. Do you think we're going to get anything this week?
Well,
More
he's told us he's going to frame the big questions, and
you can lay them out, but if you don't say what you're following,
well,
right?
and this is the challenge that Kevin Warsh really has had, and I don't think he's done a particularly good job in communicating with the markets, because you have to give the markets something, right? You can't give them nothing, and he's basically given the markets nothing. So he has to either give some kind of forward guidance, or say, if this happens, then we will react this way. So give a reaction function. You have to do one of those two things. It's interesting because he put Mervyn King, former Bank of England governor, on the communications task force. This is what Mervyn King wants to do. He says that, hey, we want to give the reaction function. We don't want to give forward guidance. But Kevin Warsh clearly has, if he read that paper, then he's not following it for sure.
Well, and I also think that you're at the point now where you have to really look at that speech. If it was going to be under a microscope, now it's under 5, right? Because now you went from we're all
every LLM is going to get that speech, and we're going to get analysis.
And everybody was focused on the Fed, and then they turned to the Treasury. So now the Fed's now they're extra focused on what they're going to say. And the fact that the communication has been, I would say, uneven is a word that you could use, doesn't help the situation. And I think that it makes it more important to clarify whatever. So I think Jackson Hole is, we're all going to be sitting around on Friday watching what's going on.
And we'll probably all fall asleep because it won't be very interesting.
But we're going to have to watch it anyway.
Well, we're all going to be waiting for the walk, right? We're going to be waiting for all the central bankers.
Tom, Mike, and Lisa are going to be there. It's going to be interesting. Sarah, layer on top of this, and we've already talked with Ira about this, about the data center build-out. And you write in your notes, the pushback against data center build-out could be a blessing in disguise, as well as investor concern over CapEx spending has been
to slow down the bubble, basically? Is that the argument? Is that what they're going for?
We've been talking about how the hyperscalers and everybody AI-related tapping credit markets and what that's done to maybe crowding out the Treasury trade. What's how worried are you about all of this tapping of the credit market for these AI guys?
I think that there was definitely concern about how much money was being raised, how fast, and at the same time, you've got the government racing in to raise money. I mean, everyone's raising money, right? So that was an issue. Whether or not this money is actually going to have a return on investment is another question that people have been going crazy about. The idea that it's an arms race, that you have to spend faster than China. The fact that there may be a bottleneck could be a blessing in disguise, just in the fact that people are worried so much about that spend and how much of that spend is coming out of debt and equity and no longer cash flow. And if that slows down, maybe that gives investors some room. Whether or not that becomes a further race to the top between China. I mean, I'm not sure how to look at that CapEx relative to other things, and I think that investors are struggling with that.
Hey, join the crowd. I don't know how to look at it either. Like, I feel like increasingly we say this, we see the headlines, we see the spend, and we're trying to put it in context.
I also want to ask you about where equities go from here, especially if rates stay high.
Equities.
Because, we haven't really seen, I mean, even this week, it hasn't been carnage in the S&P 500. But the 30-year...
Well, definitely not in the S&P or the equal weight. Equal weight just hit all-time high. It's just, what about the tech side? The NASDAQ's getting stuck.
Came in and did something to the long end because that was starting to get investors worried, and you were seeing the S&P start to degrade, and the indices and other stocks underneath it as well. It's really going to be, it's a combination of it's going to be about earnings. And somebody made the point this morning, and I can't remember who it was. They were saying, earnings are great, but people are outspending those earnings. And that's a really good point, because as we get into 2027, are we going to continue to up the ante on spend, and are the earnings going to follow? And I think that that's really, earnings is the biggest problem or benefit to the S&P. And right now, that's all been working in everybody's favor. If that starts to trip and that second derivative starts to go, it doesn't even have to go down, it just has to grow less fast. And that becomes an issue unto itself, given where valuations are.
Can we just keep going? This was really great. Come back next Friday?
Sure, I'll be in Princeton.
You'll be on vacation. You'll be on vacation. All right. Maybe a couple of weeks from now. Ira Jersey, thank you so much. Bloomberg Intelligence Chief U.S. Interest Rate Strategist, and Sarah Hunt, Chief Market Strategist at Alpine Sachs and Woods. Just a reminder, we did have a headline. U.S. Chief Justice John Roberts saying President Trump can keep building his new White House ballroom for now while the Supreme Court considers issuing...
Saw that about 5 minutes ago or so. Okay, so let's see. Then we've got... Okay, how about let's see here. Let's go look at. Let's go back to CNBC for a moment, and then we're gonna go see if we can find some other juicy videos to talk about or react to. There's some juice out there. All right.
Shipping companies.
Yeah, but doesn't, David, we got to let you go. But doesn't that raise costs then? Because now you're using 2 ships, not one. Ship-to-ship transfers are risky. The insurers, which Contessa covers so well, they're going to be like, "Yo, you're using 2 ships? Pay us twice."
Yes, but you have to understand the alternative for the producers in the Middle East Gulf is making no money at all. And rather than making $0 a barrel, they're happy to make 70 or whatever it is then, discounting all the extra costs.
David Weck of Vortex, really smart stuff. Appreciate you coming on, David. Thank you very much.
Just to be clear and on the record, insurers never use the word yo.
As soon as I did that, I knew you were going to jump in and be like, "There's no insurer that's ever been like, yo, like that's not going to happen."
Okay, but just
it's Friday. I'm not wearing a tie. Let me have some.
Okay.
Just let me have a little something. If you want to stay plugged in on all things energy, you can scan the QR.
Nope. Don't want to stay plugged in on all things energy. All right, whatever. So let's see what else is going on. Okay, so CRM 207, Tesla's holding on to its 5%, clean hold or bounce off the line over here. You've got the Qs here. Let's go look at that Cognex company or whatever. Cognex Investor Relations. So let's go look at this. That's this company. So this is... They do like lasers and stuff? I mean, those all look like lasers. Let's go see what they say. So here's their February annual report. Company. Okay, here we go. This should be interesting. So, let's see here. Okay. This is company founded in 1981 makes advanced machine vision easy, paving the way for manufacturing through automation. We're a global technology leader in industrial machine vision. Yeah? That's what we talked about. Our solutions blend hardware and software to capture and analyze visual information, aiding the automation of manufacturing and distribution tasks. Okay. Our largest end markets are logistics, packaging, consumer electronics, and automotive, which are 85% of our revenue. Wow. So logistics and packaging, consumer electronics, and automotive. Okay, I can wrap my head around that. Annual. Let's go see here. Oh, and then we gotta get some more coffee. I'm logged out again. Let me log back in. You know, I'm getting logged out every time I open the tab. That's odd. Okay. So, quick look. I have not analyzed this company before, but a quick look on Stock AI actually indicates that its fair value is down about 25% from where we sit right now because of high moving average. So, good balance sheet, decent pricing power, TBD, I guess. We'll have to see. And let's see some of the risks. Customers are deploying one vision, reducing deployment complexity, accelerating time to value for AI-driven vision. That's good. Data center revenue represents low single-digit percentages, but is growing over 30% year over year. Management targets component inspection, rack assembly, and deployment automation. Okay, so that's probably why, in part, they're getting hyped up a little bit, is this idea that, oh yeah, we're in the data center too, didn't you know? Didn't you know? If the data centers win, we win. All right, Cognex A21. This is the earnings report. Alrighty. Let's pop this open. So, quick look of this. Let's go to the cash flow statement. Whoa, where is it? Should be right here. Shareholders equity, cash flow. There it is. Scrolled right by it. Okay, so this company has basically doubled their income, their net income from last year. We'll have to see why. They don't really spend much on plant, property, and equipment. That's basically nothing. So this is pretty much pure cash flow, right? So I've got 110 mil of free cash flow in 6 months. Around, call it 220 mil in 12 months, ballpark, if we can do that. That's just a really quick estimate. So 220 mil, what's the company worth? We get a cash flow yield that way. It is a $10 billion company. So that's about a 2% cash flow yield. 2.2% cash flow yield on 10 bill company. Okay. Then balance sheet, I've got deferreds of 50, so that puts me at about 216 minus 50, 166 million in bills. I've got plenty of cash. I've got 400 mil cash, so balance sheet good. That's what the stock AI tab indicated as well. Long-term is mostly deferred income taxes, which we technically have the cash for. Technically enough cash to have no debt. So that's a pretty good place. So they shouldn't be fundraising. Nope, they're rebuying stock instead. Cool. Rebuy. 105 mil. Similar to last year. Okay. Then we go up here to revenue. Well, net income there's the double on the net, roughly. Part of this is due to, no, investment income's pretty similar. A little bit of a reduction over here. Okay. So operating income did essentially double. That's very impressive. Why? Because their revenue grew and their costs didn't grow that much. Let's do the math on this. That does smell like pricing power. 291.2 divided by 249 is 17% rev. This is going to be up like 4%, 4 to 5%. Probably closer to 4. 5.2, I was close. 5.2% costs up. So that's pricing power. That's great. And their operating income is up 2x. Because their R&D is stable. And G&A slightly down, actually. Slightly down. Wow. So revenue pop. So I wonder if this is because of pricing or what? Let's see if they say. Well, results, R&D expense, revenue increase 27%, stronger performance across most end markets. Revenue from customers benefited from consumer electronics, customer procurement. Revenue from Europe decreased. So European revenue down. American revenue up. China up 47%. Wow. Yeah. More favorable end mix and higher volume. So whatever they're selling here, they're selling more of for higher prices. This is actually pretty good. What is the valuation of this puppy? Let's go find out. And then we will do a restroom break. Actually, honestly, I'm going to do the restroom break right now. I will come right back, and then we'll do the valuation. So I'm going to press one of these be right back buttons. How about a fun one? I'll play a fun video while I'm gone, okay? It's a treat for you.
Man, your boy Kevin just lost lots of money. Oh, but that's okay. I am with you, with you. Oh, man, your boy Kevin just lost lots of money. Oh, but that's okay. I am with you. Here we go, come on, push it, find the dip, find the dip. Here we go, come on, push it, find the dip, find the dip. Here we go, come on, push it, find the dip, find the dip. Here we go, come on, push it. Oh my God, what's happening?
First of all this whining by Wall Street is making me sick. 140% of GameStop was short. GameStop was short. You can't allow Wall Street to short 75% of a stock, crush these companies into the dirt, thousands of stocks into the dirt. Then when the individual makes money, everyone's entrepreneurs. I have a kid who bought a house, paid $50,000 and bought a house. After decades of the shorts, you have to accept the fact that individual investors are playing the same game that you're playing, and now you're losing.
Here we go, come on, push it, find the dip, find the dip. Here we go, come on, push it, find the dip, find the dip. Here we go, come on, push it, find the dip, find the dip. Here we go, come on, push it. Oh my God, what's happening? Here we go, come on, push it, find the dip, find the dip. Here we go, come on, push it, push it, push it, find the dip. Here we go, come on, push it, find the dip, find the dip. Here we go, come on, push it. Oh my God, what's happening?
There's a lot of power in organizations online. 2 million people can get together in a subreddit. I think it's really funny that the GameStop stock is going up and just affects the market in that way. There's 20,000 people live in a Discord who are spamming rocket emojis, yelling, "Go to the moon."
Oh man, your boy Kevin just lost lots of money. Oh, but that's okay. I am with you, with you. Oh man, your boy Kevin just lost lots of money. Oh, but that's okay. I am with you. Here we go, come on, push it, find the dip, find the dip. Here we go, come on, push it, find the dip, find the dip. Here we go, come on, push it, find the dip, find the dip. Here we go, come on, push it. Oh my God, what's happening?
First of all this whining by Wall Street is making me sick. 140% of GameStop was short. GameStop was short. You can't allow Wall Street to short 75% of a stock, crush these companies into the dirt, thousands of stocks into the dirt. Then when the individual makes money, everyone.
All right. Well, a little break. A little buy the dip break. Okay. So, on the valuation for this. So this is Cognex. Okay. Financials. Okay, there we go. Okay, so $1.69 forecast EPS. Let's write that down. Okay, so I've got $1.69 forecast EPS end of 2026, and if I then grow that at 1868 plus 13.69 plus 25.27 equals 57.64 divided by 3 years, 19. $60 stock divided by $1.69, 35 on the PE, divided by 19.2% growth. $1.85 for a company with, 24% margins. me make sure I'm doing that right. 169 forecast growth. Yeah, 19%, 19.2-ish. That sounds about right. 169 EPS. Oh, current, the last 12 is $1.29. So, sounds about right. PEG. It's not horrible. It's probably closer to fair. You know, it depends. With a 25% net margin, yeah, that's probably the place where it could go. I think it's probably, you know, a little aggressive to say 25% downside would be, that would take it down to about $15, but it would take it down to about a 1.85 PEG times point. What do we have? 85 times 0.75. Take it down to about a 1.4 PEG. Yeah, it's not unreasonable, you know, for a manufacturer here. Probably reasonable range of, you know, $45 to $75 stock, depending on the multiple you want to pay. This last year's growth was exceptional. You know, 85% EPS growth, not likely, or that's not in the forward forecasts from analysts at least. So let's see where some of that came from. Let me see here. Operating margin. Yeah, they're like 2.5x. That makes sense on why the forecast or the PEG ratio could be seen as lower. Operating margin used to be 12%, now 29.4%. Massive move in 5 quarters. This is because of a shift. So we're calling this factory automation. There are 2 components. There's factory automation and the logistics. This is the part that's growing slower. Growing slower, lower margins. And this is the hope. Growing faster, higher margins. So that's how we're seeing that pricing power. So this is re-rating basically at higher pegs. This is re-rating at higher pegs because the margin from AI spend is growing a lot. That makes logical sense. Let's see here. I'd like to get, let me see if I can get a list of top products or like, and segments, right? Like let's segment that out. Because we saw China and like the breakdown of where the revenue is coming from. But it'd be nice to see a little bit more color on, you know, actually what some of these components are. And I need a sandwich too in a moment. Okay, let's get this loaded up. So, I'll look at that in just a second. Did these die on me? Oh, maybe they died. Oh, they're there. Okay, all right, that one. One's dead. Ah, I'm streaming too long. All right, so standard product. Okay, so we have. So they have machines that are AI-enabled systems combining edge AI, deep learning, robot. What is this? Insight 6900 is one of the machines. All right, so let's look at that. There's an Insight 6900. I like the name of it. Modular AI vision controller. Oh, that looks fancy. So this puppy launched in May of 2026. What does it do? Run advanced AI models, handle high complexity workloads, Insight 6900 vision controller. Okay. Key features. Oh, here we go. Advanced image processing for AI inference. Well, that's kind of cool. 65 megapixel resolution. Plug and play. Interesting. So it can match with these cameras. That's actually very interesting. I mean, here's like your robotics play, right? See, powered by Jetson, which is Jensen. Very interesting. Oh, here's an example. Look at that. Training data set. I've got, what is this, like microscopic stuff? This looks microscopic for testing. Train AI models centrally and adapt them locally. One vision. Wow. I mean, that's pretty cool. That's where the upside is that the margin is expanding rapidly. So that's cool. Yeah, that's actually funny. That's one of the changes that we have coming for our, it's probably coming in about 3 or 4 weeks. We're going to more of an exponential moving average on what operating margin does, as opposed to just like this historical average. Because this historical average is like, historical operating margins are low, but now you've got this growth in operating margin. We should really be leaning more heavily on what's happening recently. And so that'll actually change the valuation for some of these companies that are growing more recently to the upside. So really, 45 is probably too low. It's probably, I mean, I don't know that you could get more, like at 185, it's not bad. Can I get to 240 on this margin profile? Maybe. A 240 multiple would give me, let's see here, 19.2 times growth. And then where's the EPS is $1.69. Yeah, that'd get me to about $78. $78, that's current peg versus 240 peg. All right. So that's a very interesting one. So that's the, I don't like that. Okay. That's this Insight Vision system. Okay, then they've got Dataman barcode readers. Barcode readers, okay. So let's write down some of this. I've got barcode readers. Barcode readers, vision, AI/camera, processors. I've got One Vision platform. Customers train a One Vision platform. Customers train AI models on their own image data. Oh, that's kind of cool. Okay, so the backbone basically for AI training, which is going to be critical for robotics. So, okay, so this, what's it called? This smart thing, what is it? Insight Vision system. So some examples of what this could be used for. This could be defects in cans on a factory line, just as an example. Let's go with pill defect identification for pharma. It could also be circuit boards defects. Defect ID. The barcode scanner. Conveyor belt moving, hundreds of items. Needs sensors to track. I don't know. That's what they're doing here. It's very interesting. And you could even do weld. Oh, that's interesting. Identification, weld inspection for like cars. Weld inspections for cars. You could do, oh, here you go. Die placement for HBM stacking. Ooh. Because those are going, they've got to be properly aligned so you can connect the channels, which is what HBM is after all, just stacked DRAM. Robots, obviously we've been talking about robotics. So you've got robotics need to interpret camera inputs. Very interesting. So I wonder what competitors do you have in this camera space for, AI robots? That would be the interesting thing to look at. Let's listen over here for a moment. I'm going to take a little snack.
Through the private sector, bringing in various CEOs from large companies to try to target the administration. They're not necessarily looking at going after the companies themselves, but it will be a naming and shaming process.
Whatever.
And we learn about, the fact that this company was working with this particular rating agency?
Look, I think, these insurance businesses were big clients for Egan-Jones. I think from what we can gather, at least a fifth of the assets related to Mark Walters' insurance companies relied on Egan-Jones ratings. So I think it shows, despite Egan-Jones being a relatively small firm, it does play a really outsized role in rating a lot of the assets in the insurance industry, particularly at a time where Wall Street has really seized upon using policyholder funds for other investments.
Right. And as you guys remind us, an investment grade rating from a firm like Egan-Jones can help lower the amount of capital that insurers must hold in case the assets sour. So allowing them to run essentially their businesses more efficiently. It's just kind of a good understanding. Ava, we were talking about this after this story broke. And it's just this idea, we saw it during the mortgage meltdown and the 2008 crisis, that kind of somewhat cozy relationship, right, between ratings agencies and the companies that need those ratings. I'm not saying anything is untoward, but what are we hearing from the company, from the U.S. Attorney's Office in Manhattan, from TWG Global? Like, what are they all saying about this?
Look, I can definitely speak to the U.S. Attorney's Office in Manhattan, because that is a key part of my beat. And, we've heard from leadership over the past 12 months that they are very interested in what is happening in private credit. It's going up, it's going down. They're looking at how it's grown so quickly, whether marks are being applied correctly, and how the role of these third-party firms, what role they kind of play in assuring investors that this stuff that they're investing in is in fact investment grade. And ratings agencies are one particular area that prosecutors have been very much interested in.
Okay, so you're following this story. There's a lot of layers to this, this kind of saga here. What is top of mind for you? What are you watching next as you continue to kind of report this out?
Yeah, absolutely. So I'm keeping a keen eye on.
Yeah. All right, take a look at this. This is a competitor. Keyence. They're a direct competitor to Cognex. Digital microscopes, smart sensors, vision systems. It's so key for robotics right here. So I find that very interesting. Look at this. Constantly developing advanced proprietary vision systems. Smart cameras, scanners, 3D cameras. Kind of cool. Download catalog, and there you go. Oh, vision guided robotics. Here we go. Picking by robots. This robot will pick batteries for you. High-resolution camera also allows the incorporation of OCR 2D scanners to read text. Price. How much for this 2D? Ah, I gotta put my stuff in. No. I just want to know how much it is, man. Kind of cool, actually. Ooh. Okay. Taking lots of pictures. I don't know what good any of that is. Maybe that's just a way of being able to scan an object or something that maybe was just manufactured. Oh, that's calibration, I see. Let's take a look at this. Sorting. I mean, this is like the goal of what the Optimus is supposed to do. Oh, that's cool. I mean, these tabletop arms, I feel like, are the best forms of robotics. Oh, wow. Yeah, it's scanning to get ready for its next pickup. That's pretty impressive. Doesn't have to be in the humanoid form. Hey, but what if I wanted it to turn it around? Can it do that? I mean, apparently it can, because it's organizing these really nice. A human's still faster for now. But not for long, man. That's interesting. Yeah, it's just taking the ones that are oriented, you know, upside down and arranging them into that order. I don't know why this is so... Oh my gosh. Wow. That was a perfect stack. Okay, yeah, that's scary. Oh, wow. We're screwed. Oh, wow. I mean, that's pretty awesome. Wow. Oh, whoa. That's what it looks like to it. That's pretty cool. Japanese machine here. Wow. Well, good on them, huh? Okay. Well, that's cool. So that's some of their competition. Wow, a whole extra space, huh? That's really, really incredible, actually. Okay. So let's see here. Let's go take a peek. Let's see. What is next? So that's kind of, okay, that's kind of cool. Might talk about them more in a little bit. I want to go see what else is actually going on out there. Let's see if there's any juice we could talk about. Critical disengagement, says someone. Oh, yeah? Carnated, oh, that's a tough one. So, apparently, the car on self-driving, it just doesn't want to live anymore. It wants to jump. I could see that being an issue for the cameras. Not really seeing the wires there. You know, those are some of the edge case scenarios. All right. Here's somebody's post that says AT&T is doing exactly what OpenAI and Anthropic fear about enterprise. They're routing 40% of employee AI usage to open models and intend to boost it to 60%. Now, where did they see this note? Austin said he's found that open source models are just as good or better. I want to see that article. Oh, of course it's the information. The information's actually, I like them. They're pretty good. Pretty good publication here. Anthropic and OpenAI had better hope more companies don't follow the example of AT&T. The telecommunication firm plans to keep its employees spending on Anthropic and OpenAI models flat. See, AT&T has like a crap load of employees too. We should look this up. Oh, it literally says it in the next line. Let me fact check it. AT&T, how many employees? 133,000 employees. So the number's actually wrong here. It's actually 133,000 employees, at least per the, a quick little search over here. U.S. workers at 109. So we got another 20,000 somewhere else. But the numbers have actually been shrinking. Look at that. 2022, it says 160K. I don't know if that's right. 2023, 149. Let me see if I can pull some extra data. Okay. We'll look in the meantime at this. AT&T offers some AI-powered features to customers, like a chatbot in its mobile app. The majority of the AI is internal. Over the past year, he said AT&T boosted its use of open-source models to the point where models now provide power 40% of the employees' AI queries. Well, yeah, that makes sense. AT&T plans to raise the figure. Okay, so got it. So less than half are open source right now. But that's expected to grow to 2/3. Just as good or better than older models. Well, of course, if you're comparing to the older models. We actually agree with that too, though. I mean, we find with the artificial intelligence we're working on and what we're developing with Reinvest, we find that, we're maybe the open weight models are maybe 3 months behind the frontier. 3-4 months. Who cares? Like a fraction of the cost. So AT&T had 281,000 employees in 2015. They have 130,000 today. Wow. The steepest cuts came in 2021 and 2022. They dropped 43,000 a single year, driven by the divestiture of DirecTV and Warner Media. Oh, okay. All right. Well. However, the client has continued at a moderate pace. Interesting. Huh. AT&T has also gotten savings from using so-called model routers that automatically route employees' queries to a cheaper model based on the complexity of the task. I mean, that's smart. Because if everybody is sitting using Apple job cut affects more than 200 people, oh, interesting. Apple's firing some folks. Apple cuts jobs. Yeah, here it is. It's on our Alpha Wire. Remember, you get this for free in the Me Kevin app. Apple, well, during free beta. Apple cuts jobs in Siri and Vision Pro. Per the Doomers. Interesting. Anyway, back to this job cut part here. Siri, we all know, sucks. Sorry if I just activated yours. After the company began using Light LLM, the cost of some advanced AI tasks such as coding fell by 56%. Oh, that's actually smart. Using these routers for coding tasks as well. Light LLM. Let's see here. The AI gateway for platform teams. Put your full AI stack behind one key. See who's driving spend, cap it before it runs, and send each request to a model that should handle it. Ooh. That makes a lot of sense. If you've got 1,000 employees and they're like, yo, what time is it? You don't need the frontier model to answer that. Max budget. So this is software to sort of limit cost optimization, maximize the ROI of your team, load balancing, the cheapest deployment that could serve the request, simple prompts to cheaper models, and hard ones to stronger. I mean, yeah, if you've got a big enterprise, this makes a lot of sense. This is very logical. That's pretty impressive. Sub-millisecond overhead. Read the benchmark. Wow. 0.66 latency. How do they pull that off? Light LLM. Okay. I mean, my guess is it probably just uses some kind of LLM to decide. Like a really lightweight LLM does a quick like, okay, we should send this to that. You know, that's probably what it is. Okay, interesting. Okay, AT&T started developing its primary internal system, Ask AT&T, in 2023, which relied entirely on OpenAI, purchased through Microsoft. Okay, so there's your Microsoft Copilot, right? The company has since expanded the number of models that power and edit code. Salespeople take contemporaneous notes or summarize client calls. Customer support can look up staff. Makes sense. What's up, Shurish? Ask AT&T service now processes 45 billion tokens or small pieces of text per day. Yes. Okay. Company runs some of the workloads using NVIDIA and AMD servers in its own data centers, which is often cheaper than renting. Wow. I mean, that's actually really interesting to hear from AT&T. That's like, oh, hey, we're going to go buy our own hardware and just run the open weight models ourselves. That's actually, honestly, quite bearish for the frontiers. China is also, or AT&T is also analyzing DeepSeek and Moonshot. Austin said that in AT&T's experience, open source models have typically been around 6 to 10 months behind frontier models, but the gap seems to be narrowing. Right. Remember, I was saying 4 to 6. So that's fascinating. That's very interesting. So history repeats. Let's see what people are saying about it. This is going to be the case of most enterprises. Oh, I totally agree. All the pure AI-based companies don't have much value once the open weight models match them in performance. Right, and I think we're converging. Older models is the full quote. Right, right. The Twitter person didn't include that in their quote. So many of these are just like AI replies. But this is a very interesting information piece. And it does it does continue that sort of open weight threat. This is basically the exact concern as to why we want to carefully watch what's going on with the Anthropic IPO. Because the Anthropic IPO will start sort of flushing out how much of an issue that really becomes. So let's write some of that down. Let's see here. Here. Okay. Anthropic, OpenAI, risks from open weight. Okay, so this is the information right here. The information suggests AT&T is, go away, trying to run 2/3 of their Ask AT&T model, stop it, model through open source, which they think are 6 to 10 months. I think that's what they said. I'll verify that. Behind frontier models at a fraction of the cost. They can even run them on their own data centers. Run those models on their own data centers. So that's also a risk then for the data centers. So, you know, some competition. That provides some competition for data centers. Certainly competition for frontier LLMs. Okay, so let me see how many months they said. Let's see here. Yeah, 6 to 10 months. Okay. Okay. They say the gap is narrowing. Okay, so, you know, my take here is this amplifies the importance of the Anthropic IPO. We finally get revenue discovery in a transparent manner to see how open weight models catching up to Anthropic's Fable/latest affect Anthropic's revenue. Until then, it's all speculation, right? Until then, all speculation. But if open weight hurts Frontier, then it also hurts some cloud compute, as some of these models can easily be run in-house. I mean, we're running a ton of models in-house with just like 5090 GPUs or RTX Blackwells or whatever. It doesn't have to be, you know, GB300, for example. This light LLM is also very interesting. Let's jot this in here. Okay, so light LLM also helps route to cheaper LLMs automatically. Basically removes the human from the loop. Removes the human from the decision of which model to use. I don't know about you, but I find myself just trying to use like the best model all the time. But that's just for like, if I'm chatting, right? I always seem to default to the best model for generic, you know, writing or research or whatever. But at scale, that's not worth it when you're paying per token. You know, like a flat subscription, it doesn't matter. So flat subscription doesn't really see that pain. But, you know, so you're paying, let's say, $20 a month for GPT or whatever. Who cares if you're using, you know, the latest model or what? And if you're not hitting your limits, it doesn't matter. But for a company that's doing a lot of AI 24/7, that obviously matters. So, you know, the impact, you know, it's too soon to tell. Too soon to tell the impact on Frontier Labs. But again, Anthropic IPO in Spotlight. Very interesting. The light LLM is fascinating too. Light LLM. Here we go. Okay, and that was the info. Let's just tag that right there. Okay, very cool. So let's see here. What else is going on the info? Nothing super exciting. Okay, let's listen in over here for a moment.
U.S. equities, despite the phenomenal AI trade, so to speak. That needs to be taken into account. Dollar depreciation will continue to provide some tailwinds to international equity markets. At this stage, not so convinced about the full rotation from a tactical perspective, but I believe that the trend of dominance of U.S. equities is coming close to an end.
Alessio, always smart. Great to have you.
Yeah,
Alessio DeLong.
I don't know about that, man. That's a far-fetched claim.
At Pro Shares, helping us kick you off to the close here on the final trading day of the week. When we come back, a closer look at commodities reeling amid Treasury market upheaval and those rising U.S.-Iran tensions. We're going to drill down with Dan Stroyven, co-head of Global Commodities Research over at Goldman Sachs. And from crude oil, well, to water, liquid death to be specific, we're going to ask the CEO about how the canned water brand is actually pushing its way into the conversation about AI data centers. Yeah, and not one, but two heavyweight legends going to be joining us later. Legendary sports agent Lee Steinberg going to be talking sports valuations and
sorry.
Treasury signal was. And so
there he is.
I don't think it's manipulation. It's
Hey, Bitcoin went up quickly, Tom Lee. Come back. Tell us about your bags.
the noise.
What if it doesn't work?
Well, if it doesn't work, they have more dollars to put to work. So I do think, the Treasury Department does have a lot of resources available. So I assume it's going to work.
So you assume that yields are going to start going lower again?
I think that we need to just have some ballast until we get some clearance or signal from what oil is going to do and the direction of CPI and things that are giving the market a little hesitation. And of course, Jackson Hole is this coming week, and I think that could provide some clarity, and all that could quell whatever risk premium is being built into yields.
Bryn, how do you see it?
Well, I think a lot of the narrative this week has been, well, Kevin Warsh is in a little bit of a pickle because he's been saying, well, let's let the stock, let the
I like the green top.
Tell us what's happening. And then at the same time, as a juxtaposition, Secretary Besson is buying treasuries. But when you actually peel that back, the 30-year, first of all, the 20 and 30-year are very illiquid. It's about a $6 trillion total market. If you look at long duration bonds, no one signals off the 20 and 30-year. It's really the 10-year, the 5-year, the 2-year, and they're not buying that. So I do think Fed Chairman Warsh actually has the ability to thread the needle to say, first of all, these purchases.
Oh, interesting. So it's based on, thank you for sharing that. So it's just based on like the language in the actual text rather than like an AI analyzing it. So it's more formulaic in that case. I mean, that's good. That keeps the cost down. That's great.
Really what everything is set off of. And so I think that the market, though, the stock market will be range bound this week because, as both the professor and Tom said, the meeting at Jackson Hole, which he speaks on Friday, I think that's really going to be the seminal moment where we understand what is he actually thinking, or what's he going to tell us about what he's thinking, since he already says he's going to be a man of few words as Fed chairman.
Tom, do we think that next week is the most consequential for the direction of stocks in the next few months? You're not going to hear from NVIDIA again for a while after next Wednesday. And then I don't think people really think that anything from the Fed's going to happen in September or even October until you get to the midterms. That feels to me like it makes next week even more consequential for stocks.
I'd agree. I think it's what I'd consider a clearing event, because let's take the AI story. There's been concerns about data centers and political opposition, and it's caused the trade to stall. I think Jensen Huang's going to re-inject a lot of confidence that, look, there's still this relentless demand story, and it's going to be taking place regardless. And similarly on the Fed, I do think the uncertainty builds between Warsh's appearances, and so I think this is another chance to course calibrate.
You raise an interesting point. So you think what certainly appears to be growing opposition to data centers is having an impact on that trade in the stock market?
It is, because if data centers can't be built, then the entire bottleneck trade doesn't look as durable. So I think that what we saw in Ohio and in Florida and Texas and Pennsylvania, which is now governors putting potential moratoriums or even voters saying it's a political issue, is causing investors to pause.
What if that doesn't change? I mean, I'm literally looking at one of the most recent polls right in front of me that I happened to see earlier today, and the support is decreasing across all.
I saw this GIF, and it is great. It is like perfect. Look at this. It is Treasury Secretary Scott Bessent intervening in the Treasury market to keep yields. Oh, that's priceless. I don't know. That's a good one.
Because they're all downstream stocks to the AI story.
How about that, Bryn? This correlation between the lack of support and decreasing support for data centers and problems in what has been an incredible trade this year. I think we're all thinking about the same kinds of names when I bring this issue up. The Microns and everything else.
Well, if you think about what goes in a data center, it doesn't all go in at once. And so I think memory can be more affected or will be more affected than certain hardware. But I think that what happened in Texas, actually, where obviously I am, is a really big deal. That, from my understanding, like, I get what Governor Abbott's doing. It makes a ton of sense. But now that, like, no one's getting through on the permitting for the most part. And so I do think that we're already seeing this logjam, like 60% of capacity that was supposed to come online in 2027, Scott, has not even started to be built. And so I do think this is not a narrative. It's not a story. It's happening. And I think going into the midterms, I think the Republicans are really concerned that Ohio is going to flip. And that's another data center country or data center state. And so I think this is really important that investors really need to take a close look at this. It's not going to stop it, but I think it will definitely, we could have some downsides as we're trying to figure out, well, then what do you do with all this stuff that's not being able to be built yet? Is it going to get built? Where is it going to get built? So I think the market is discounting it right now, and I think that's probably not a wise idea.
Professor, is this an existential issue that stock investors aren't taking seriously enough?
Yeah, I mean, it reminds me of 10 years ago about the whole fracking debate. Remember, the states, shut it down and all that. Those states that allowed it, boy, they gained energy independence, and it saved us now. I mean, we doubled oil production, and with what is going on in the Middle East, had we not had that energy, we would be in a
fracking, basically, yeah.
State. So, I mean, the case has to be made that data centers are going to be net positive, and there's a lot of misinformation, just like with fracking, a lot of misinformation on these data centers. But remember, Texas is number one. If Abbott, says, we have to look at things, I think Pennsylvania, my state, is number three. Shapiro, who was once a big supporter of it, has pulled it on. I think they're reading some of the polls, and the midterms are coming up.
As politicians tend to do. But is there? Do you think there's significant market risk that's being underappreciated right now around this issue?
Well, I think there's enough money to solve a lot of these problems. Actually, I mean, a lot of the problems on water, they don't understand that a lot of it has now been solved. The question of now providing your own electricity, some of them are doing that, and paying for upgrading the grid. I mean, the amount of money that is available to ameliorate all these problems we just have never seen it before. So, hey, listen, progress is a trade-off. Economics is a trade-off.
It's like, hey, even though it's expensive to build a data centers, got the money for it. So, unlike other times in history, then again, do we? I mean, it's requiring a lot of financing.
Market rally, don't you?
Yeah, I think so. I think we're going to make new highs towards 7,900, 8,000 on the S&P 500. But part of it is, as you said, I think next week is a clearing event in a positive way, because it's introducing some visibility in two topics that are a little uncertain.
And NVIDIA.
And Bryn, this market, if nothing else, has been able to deal with these clearing events pretty orderly, let's say, from situational awareness to all of these other issues that we've had along the way in this bull market. It's a resilient market that has found various ways to deal with whatever's been thrown at it. Most recently, the upset in that hedge fund, what it did to the momentum trade, and how, as I said, we've worked our way back to not that far from new highs yet again.
I think just like America is resilient, the economy is resilient. What we haven't had a recession in 15 years is that the market is resilient. And so I think earnings are still there. I do think there will be air pockets around these data centers, by the way. I do think that's going to cause some air pockets, but ultimately this is coming. We want this to be here with AI. And but I do think there'll be air pockets, but I think the market's telling you, you need to be in it. Don't get shaken out. Do not get shaken out. Stay in it, because this is an exciting time for both the market and the economy.
All right, we'll leave it there. Bryn, thanks. Professor, always thanks to you as well. It's Friday, tradition of ours, which I like so much. And Tom, thanks for being here as well. Broadcom, the latest.
All right. Let's see. One person killed in Sweden school attack. That sucks. All right. Let's see what we got over here. JP Morgan. This is as of today. We've got... Let's see what they say here. Overnight news was largely muted. Notable price action, retracement of the bond wheel, announcement, blah, 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 blah. Yeah, we don't think this will have a lasting impact on yields. In other words, what Besson is doing. Right, like the squirt gun, right? It's like nonsense. Okay, so PMI, this was good, by the way. The PMI joint data came in good, especially with jobs, so that was nice. Here we go. Oh, they're talking about Salesforce. CRM remains an unloved name within application software. Short term, the only reason to own CRM is if you believe that second half subscription revenue re-acceleration is still intact. Such commentary on the call will be very important. The cynics will say, who cares if subscription revenue growth accelerates? It's still single-digit organic growth. In other words, CRM is going to need more than one solid quarter to truly flip the debate. Yeah, that's fair. And, you get earnings and these stocks go down 20%, or like Palantir, they're up 30%. It's earnings are a crapshoot in terms of, because you're really playing with people's expectations. You're playing with their emotions. NVIDIA and Jackson Hole, obviously, next week. Midterm election seasonality has failed to materialize. Post-midterms, on average, the S&P rallies 100% of the time within 6 months, 100% of the time within 9 months, 100% of the time within 12 months. Wow. If you go back that's going back to 1990. And if you go back to 1950, the 6, 9, and 12-month returns maintain their 100% hit rate. Wow. That's bullish. I'm bullish at Q4, like going into the end of the year. But it's also interesting that the 3-month can be a little bit more volatile there. But that's a great stat. Like, I feel like we should just turn that into a little graphic. That'd be cool. Let's do that. I'm going to copy and just screenshot that. That's a cool graphic. Ross Stores lift earnings. What are they saying?
Across a range of incomes while existing customers spend more. Moving over to BJ's Wholesale, because they raised their full year forecast, and they also pointed to shoppers seeking out value. Higher income households driving the beat, with grocery, consumer electronics, and home goods the top categories. BJ's member count reached a record 8.5 million, and membership fee income helped lift overall revenue, those shares up 3%. Finally, shares of Boston Beer falling after the company said its CFO will be leaving the company next month to become CFO at the ingredient maker Ingredion. Boston Beer appointed its longtime chief accounting officer as interim CFO while it searches for a replacement. Those shares down 3%. Scott?
All right, Pip, thank you. Pippa Stevens. We're just getting started here on the Bell. Up next, been nothing but net gains for NBA owners in the wake of the record pending sale of the Los Angeles Lakers. Our own Mike Ozanian following the money on the big reset now.
Boring. Mom's a big reset.
Strategy and Robinhood, just to name a few. Dan Dolev, senior fintech equity research analyst over at Mizuho, joins us now. Dan, so what's driving this? I mean, is this about regulation? Is this about the debasement trade? I mean, it seemed like everyone had just kind of left crypto, not for dead, but certainly dormant. What happened?
Yeah, dormant. That's a good way to put it.
Exactly what happened. It happened when nobody expected it to happen, right, Romain? I mean, we all thought it was dead, and now it's coming back. I do think it's sort of M2 money supply. I think sort of the second the Fed said that they're going to start buying back, treasuries, I think that's what sort of triggered the whole thing. And you saw that correlation. There's a massive correlation between M2 money supply and Bitcoin, and I think that's kind of what's driving it right now.
So if it's the treasury bond buying that's pushing people into risk assets, and if that's what has triggered the rally rather than crypto fundamentals, as soon as that rally's over, as soon as the bond buying rally ends, does that mean it's over for Bitcoin as well?
That's why I wouldn't get sort of over my skis now and too excited. I think it's actually too early to tell where it's actually headed. Things look good right now. It looks awesome for Robinhood. It looks, good for Coinbase, good for MicroStrategy. But I would say I still think that we should focus on the fundamentals, and we should look at areas outside of crypto. For example, Robinhood, which has only less than 20% of crypto exposure to the revenue, as a better bet than just a pure kind of crypto buying spree right now.
So when we start to talk about kind of what sort of makes this stick, and we should point out we're still well off those all-time highs on Bitcoin of 126, but this idea of the companies that are benefiting, we always sort of look at the pure play crypto companies, Dan, but talk to me a little bit more about some of the stablecoin issuers. You mentioned Robinhood, which is obviously a well-diversified financial company at this point. Is that kind of more the longer-term beneficiary here rather than maybe a pure play like a strategy, et cetera?
Yeah, 100%. I mean, I love, I like strategy and I like Robinhood. I've outperformed on both. But I would say that Robinhood is so well diversified here, right? It's rallying today, and there's still upside to my price target. But think about it, it's less than 20%, maybe less than 15% of its revenue is tied to crypto. They're selling crypto, or they're letting you trade crypto at a very low take rate. So they're a share gainer. B, if crypto doesn't work, they will continue to work. They're getting into Europe, they're getting into Asia. That's your best hedged bet to benefit from crypto, but not to get hurt when crypto is not having a great time, like in the last, call it like 6 to 12 months.
Just real quick, only about 30 seconds left, Dan, but any concern here about the interplay between the crypto space and what's going on, or whatever the heck's going on in the treasury market and the dollar?
I think that the notion that the dollar is getting weaker, I think is actually very good for Bitcoin. It's very good for crypto. I think that's what's driving it. And if that kind of trend continues, then you should see continued momentum in this whole crypto market, which is great for MicroStrategy, great for Robinhood. Why not?
Dan, have a wonderful weekend. Dan Dolev, Senior FinTech Equity Research Analyst over at Mizuho. Robinhood shares just sort of cherry pick here, up 13% now, heading for their...
All right, what else? So, let's see here. This is always interesting. If I can get this to load. We'll check that in a little bit. Okay, yeah, there we go. Okay, so I got this chart. So this is on that JP Morgan piece. If it's true, which probably is accurate. Let's go drop that in. Call that. Okay. So, market rally post midterms. So that would be post November, beginning of November. So it does get you into there. There we go. We got our little chart. That is quite bullish. Bullish Q4 per JP Morgan, right? And not just Q4, but also bullish Q4 onwards, right? Because 3 months thereafter would be like December, Jan, Feb, Feb plus with 100%. certainty. We'll see. You know, it could always be that we break that trend. But that is interesting. The stat there that going back to 1990, you have a 100% hit rate on a positive SPY or S&P 500 XPX, 6 months, 9 months, and 12 months out after midterms. Although they did mention that leading into midterms, we haven't seen the usual volatility. Looks like there was just another OpenAI departure. Key OpenAI sales executive resigns. I don't know why. Like, they're just resigning right now. It just seems like a wild time. Seems like a wild time to do that. When House Hack Canada. It's just a travel, you know. It's I mean, like I'd buy the dip if it were closer, but you know, it's a lot of traveling to go manage at a distance. You could do it, but it takes some work. It takes a lot of work and structuring. Canada's really particular about who can invest. Fortunately, you know, we got Canadians in the family, so you know we could pull it off. But yeah. Let's see what we got here. This is P Equity posted this, the flow show with Bank of America. Okay, so let's see. I mean, if private credit can't rally on QE5, then what is the world coming to? Right. Well, the best since 3 arrows are failing. We know that. That was 3% GDP, 3% budget deficit, and 3% inflation. Extraordinary monetary stimulus of the past 20 years has led to extraordinary asset gains. If Besson can't drag the 30-year below 5%, it means the US dollar slump at short risk, short leverage. It means US dollar slump and short risk, leverage, and cyclicals into midterms. So, pretty sure the 30-year is still well above 5. But let me see. I honestly have not looked in a while. This is going to be 30-year Treasury. Yeah, 5.28%. That's crazy, right? So 5.28% here. And what they're saying is the QE of the genesis of a great bull market and too big to fail. Okay. If Besant can't drag it below 5%, it means a dollar slump, short risk, short leverage. Yeah, that's the big picture. Let me see what they mean. Let's go see what they're saying. Okay, bull bear scale is now up at 9.5, indicating positioning right now is an extreme bull. Clients 66.5% in stocks. Secular consensus is anything but bonds. Yeah. Anywhere but China. Anything but the dollar. Gold remains the cleanest dollar debasement trade. Short AI bonds. So AI debt, basically. Huh. Besant, anything but bonds, Besant put. BOJ hike. U.S. admin won't let 10-year Treasury cross 5%. Well, I mean, it is above 5%. But I suppose their argument is that's why they're intervening, to try to get it to come down. All right. This is not particularly useful. The anti-consensus trades. I see. Oh, here we go. Success is expected. Failure is unthinkable. Let's see. Yeah, that's just the same line they had at the top. Is that all they say? Yeah, it's literally all they say. They don't give much more of an explanation. You know what? That's a good AI-able one. You know, it's let's see here. Can't even spell right. That's all right. We'll figure it out. Spell here, her. All right, we'll get back to that in just a moment. Let's listen over here.
You follow demand. However, the refining sector is under very significant supply constraints because of the major outages both in the Middle East and Russia. At the moment, global refinery runs are down 8% year over year, despite the fact that US refiners, for instance, who are not constrained by drones or strike attacks, are running at 97, 98%. And so to incentivize the refineries outside of Russia and the Middle East to run as hard as possible, these very strong margins are required to prevent inventory levels from falling to critically low levels.
I read it right. You know, I'm not losing my mind. That's what they're saying. So they're basically saying, so, you know, like the translation here is basically, hey, if the government, because the government always steps in with some form of QE or bailing out the markets, if for some reason they can't get it to work and you can't get the 30-year below 5%, then you want to go short risk and private credit at that point. Okay, that's what we expected. And the reason I guess you would consider, well, it's a little confusing. The value of the dollar would drop because of the issuance, right? Not because of the yields. Because usually when yields go up and so you fail to bring it under 5%, you would expect the dollar to become more desirable. But you're also debasing that dollar. So, okay. All right. I get it. Let's try to actually break that down a little bit. And so the way to break this down is here. That. Okay, let's put that into, I'll just slap it in here somewhere. Give me a second here. Insert. Just need a place to work. There we go. Okay, cool. Got it. So I just threw it into the JPM article. Honestly, I'll just put it onto that page because it's kind of interesting. There we go. Okay. Screenshot above is B of A. Basically, if Besson intervention fails, which he's signaling more intervention, then the result, dollar debased, gold up, dollar down, risk assets down, AI infrastructure and private credit, hyperscalers down, and financials down into midterms. So that's kind of like suggesting, hey, expect some volatility going into midterms. I wonder how much more Besson is really signaling. We did have that CNBC interview yesterday. It might be worth pulling that up. Let's see. CNBC. Nope. Besson. Okay, here it is.
Securities yesterday, and joining us now in a CNBC exclusive interview to discuss is Treasury Secretary Scott Bessent. Secretary Bessent, welcome back. It's good.
We believe that there are many underlying factors that the market is not looking at, and we are going to make a market in these. We routinely do buybacks, and we're going to increase the size of the buyback. And Sarah, I would note that it could be more than the $4 billion per issue.
Yeah, I was going to ask how big this could get.
Yeah.
If they've gone back the other way, we've a rate.
And part of it is signaling here and to show that we believe that the yields don't reflect the underlying fundamentals. This Iran conflict, we will get on the other side of this. We don't know when, and we can talk about the economic measures we're going to be taking against Iran in a minute.
Sure.
We believe that the liquidity, especially in the 30-year point, is very poor. And we are, in the administration, we are announcing probably at the end of this week, beginning of next week, an increased focus on fiscal consolidation. And it's coming from President Trump. Russ Vogt and myself will be examining both on the revenue side and the cost side what we can do.
Yeah, because that's where I was going to go and where a lot of the analysis has focused, as you know, Mr. Secretary, which is, strong signal from the administration on the buybacks, but, the fundamentals are ultimately what is going to prevail here in the bond market. And the fundamentals are hard to ignore when it comes to the size of our debt, with public debt increasing to now $40 trillion.
Yeah, I mean, look, Sarah, there's nothing magic about the 40 trillion.
Interesting. OpenAI, I'm just getting this through the wire right now. Look at this. OpenAI dropping API and credit pricing for GPT-5.6 Sol by over 20%. So we see more of that competition pre-IPO. That's what I would argue this is. I would call this, more pre-IPO competition to gain coding share. Musk wants in too. So we find that very interesting. I would actually like to take this and throw that into here as just sort of like a little AI topic. It's good for us to keep an eye on that. Oh, I don't like that. Okay. News. OpenAI news. There we go. Okay, let's go back to Scott Besson.
Year 2025, we were at about 5.7% of GDP, and one of the things that's temporary here that's influencing the deficit has been these tariff refunds, and we won't have to do that again. And the Ambassador Greer, through the 301 process, is re-implementing the same level of tariffs, and I would expect that our 2026 tariff income is going to be roughly what it was in 25. And we're going to be able to keep that in terms of the budget consolidation. The other big item in the budget that we're seeing is the hit that we're taking from to revenues for the immediate expensing of factories and of equipment and farm structures. And I think that if people sit back and think that's not government spending, that is actually an investment in the future, and we're increasing the tax base is on shot here. We have a lot of potential energy that will turn into kinetic energy.
TV's a little loud. Okay, then let me fix that. Oh, thank you for letting me know. Hold on. I think you're right. It's probably like, what, 6 decibels too loud? Let's try that.
During this year, next year, as these factories come online.
So do you think we've seen peak deficit during this administration?
I think a very, very good chance we have. That we are going to be laser focused, as I said.
That's probably better.
OMB Director Vogt,
that better?
myself, the President, that combined with the Vice President's Fraud Task Force, where I think we could save several $100 billion.
In months about what's going to happen.
Oh, they're talking about this now.
with the bets and scooping up some of those assets from the embattled hedge fund situational awareness. Hema Parmer joins us right now, who covers this for us over at Bloomberg News. All right, so what we knew was, let's just say Leopold Aschenbrenner got in a little trouble. Situational awareness got into a little trouble. Ken Griffin came riding in to the rescue, as he's done in the past, bought up some assets, we don't know exactly what, presumably at a discount. Now he's out with a letter saying he offloaded 80% of the risk. So what does that tell me? He just made a bunch of money?
Yes, basically.
Okay,
Well, basically, he did buy this at a 10% discount. Also, these were assets that had already fallen in their value, so an added discount to that too. Selling a good portion of what he did buy to the market. Some of those were block trades, at least $4 billion worth. So we do see him sort of like locking in those gains, selling them at a premium to whatever he bought them at, which is what hedge funds do, and making a sizable chunk of money off the back of this deal.
Well, do we know exactly how sizable that chunk of money was? Are you able to talk a little bit about how it did boost Citadel's returns?
Yes. So the fund was up about 6%, like 5.7% through till June for the year. In the month of July, it made an additional 6% in gains. It made more than it made all year in 1 month alone on the back of this deal. So the fund is now up 12% year to date, which is a great turn of events from going from basically doubling their return in just 1 month on the back of what was a great deal for them, for sure.
Obviously, Citadel's got the deep pockets and the liquidity to be able to kind of swoop in like this, but I assume they couldn't have been the only firm out there looking to maybe find a bargain. Do we know anything about anyone else who maybe got a piece of this?
Yes, so there was a bidding war basically to get some of situational awareness's assets, and Citadel ultimately won that war, buying a chunk of the stock book up at a 10% discount. Other people that wanted a piece of it, Jane Street, Millennium. Keep in mind, Situational also has this huge private portfolio.
Yes.
So we saw some more like venture private equity types like Sequoia and Green Oaks bidding for that private book. Ultimately, Situational would not want to sell those coveted Anthropic stakes, so it went with this Citadel deal. But it was a war, and look, Citadel got...
Yeah, because they got to cash out on the IPO to sort of reload the bags to hope that they can keep investing, basically. It makes sense.
This deal, which has worked out well.
Is there a movie script in the work for this as well?
There should be somewhere, you know? It's been news,
Hema, talk to us a little bit about what kind of an endeavor it is to sell, to offload a stake this big at this scale.
That's a great question. So what was interesting about the news that came out today is that they made 100 block sales and selling off a market value of $4 billion. Now, a block sale is when you're selling an asset, you want to sell a chunk of it to a buyer directly, because when you sell that in the free market, it can then spiral the size, the performance of that one asset. So you sell it in chunks. The fact that Citadel sold 100 blockchains individually to all these different buyers. Some of those, about 10 of those positions, were the biggest intraday block sale for that day.
All right, Hema, I have to leave it there. Stick around after.
Yeah, that's what we were covering earlier, and we actually already posted the video about. So I feel like they're a little behind on that, but that's all right. Okay, so I think people hear block trades too, and they get really freaked out. Like, oh, that's a scam. It's pretty normal. I mean, I'm not trying to make normalize the way the suits handle their trades, but yeah, I think they get a little overblown with negativity. Okay, so what else here? Let's see. What is this? Justice Department and TikTok settle for $400 million in child's privacy suit. Wow. Okay, ads here. No problem. Let's go see how the market is holding up. Yeah. In the meantime, let me just... Okay. All right. Let's go see how the sticks are, and then we'll come back to this Warsh piece. Okay. Still sitting right below 715, Path is up at $16. SpaceX is up over its 133 line. Tesla's almost at 6% now. Nice. Very nice. Good bounce, you know. So still got to get to 80K though on BTC. Still hanging slightly below that target for or based on technicals. 3.3% on Palantir. That's pretty good. What else is going on here? No, the rest is kind of boring. Volatility's down. Okay, let's go back to this. So this is on the Besant sort of credibility piece. So this reversal of yields kind of sucks for Besant's Aura, not to be misspelled Aura ring here. Sort of, you know, you've got this historical, the US and Fed combined to solve problems, right? So historical belief, US and Fed joined to solve market issues like during COVID. And this last little, you know, fake operation twist or whatever you want to call it, some people are saying it's a turning point. Basically, the end, like it's the end of the Fed put and the Treasury put collectively as one, right? This idea that the Fed put is invincible, that they could paper over everything with more printing, essentially gets called into question. Especially with the 30-year, you know, at its highest level now since 2007. So now you've got concerns over, you know, an independent Fed. You've got concerns over the balance sheet and concerns over U.S. Fed coordinated responses failing. So you potentially, you know, as they say, expose when the tide goes out, you see who's been, you know, swimming naked, basically, right? It's sort of like you're exposing yourself. Self-expose. So not good. And I don't think they, I mean, I think today I think they were even worse than they were the day before they intervened. Let me see. We're at 4.376 on the 10. We are zooming in here. We're basically at the same spot. I mean, the operation was here. This was the operation right here, this drop. So we're way higher than where we were. We're almost at that, the other high that we haven't seen since, you know, 2025 on the 10-year. It's worse on the 30-year, though. So if you pull the 30-year, the 30-year at these levels, 5.275, 5.28-ish, around there. This is the highest and worst level since, what is that? Yeah, 2007. Yikes. Hit a high of 5.44. Ugh. Okay. Very well. Next. So that's Besant. What other commentary is there here? NVIDIA earnings next year. Let's listen to this.
on our out-year numbers still makes it attractive for our portfolios. You know, they've also increased their capital return to shareholders with a significant increase in the dividend. And so we continue to believe, given the growth outlook that we have for AI spending, as well as the return on that spending, that NVIDIA continues to be an attractive opportunity for our shareholders.
I want to take the flip side of this, because also on the same day as NVIDIA, of course, it will be completely overshadowed. We're going to hear from Salesforce, and there's been a lot of talk about AI kind of eating the lunch of all these sort of traditional software makers. When you look at the software space, particularly the software as a services space, do you find anything attractive there? Have we made too much of their demise?
I think so. I think it's a good time to be looking at some of these names. I think the multiple contraction that we've seen in those names and the resilience of their business models, we think a lot of them, like Salesforce, as you mentioned, is adjusting to this AI world and incorporating into the products. And so we think that they will be resilient and that they'll continue to grow. They've been targeting accelerating growth in the second half of the year. And so if they were able to achieve that, I think you could see some nice move in that stock. And so we have been nibbling at some of these software names, but I think we need to be careful because there is still a lot of uncertainty, as you point out, on what the future is with the competitive dynamic between AI and these historical legacy software names.
So Jeremiah, the market was able to absorb the SpaceX IPO, the biggest ever. What would it mean for the market to have a potentially even bigger IPO with Anthropic? Do you think it will be able to absorb that, both from an equity and debt perspective, actually?
The suckening 2.0.
Yeah, so I think to be able to absorb that, we need some of the significant amount of cash that's sitting on the sidelines to come into the market and hopefully attract investors. But you could certainly see some trading out of some of these mega cap names as well and moving into names like Anthropic. But it's also going to be a specific type of investor, so more of that aggressive growth investor that's willing to, you know.
This is nonsense. You're going to end up holding the bag. Yesterday's rise in yields came despite Besant's attempts to ameliorate the market situation in an interview on CNBC. Right. That was the long interview where it's like, oh, you know, we might even do more. Could be bigger. Nobody cared. Like, the market is literally giving Besant the finger for a second day in a row. Or it is literally giving a finger a second day in a row. Ignoring Besant. Jawboning is, I think, the word. Jawboning on CNBC. Besant said that the buybacks previously announced that they could be bigger. Intriguingly, he also said the administration would be announcing an increased focus on fiscal consolidation, probably at the end of this week, beginning of next week. Right. So we don't know what that means. Long yields fully reversed Wednesday's rally. 30-year reversed most of theirs. More of a Band-Aid. That's what I called it. Remember I called it the SpongeBob Band-Aid? That's funny. Let's throw that in right here. Indeed, we argued in our note dedicated to the 250th anniversary, while financial repression could play some role in managing the debt burden, it needs to be combined with genuine fiscal consolidation. Right, like, AKA don't just rearrange the toxic debt. Yeah, totally reasonable. Like, nobody wants to be played here. Will there ever be House Hack Mexico? Well, it'll be called Reinvest. Reinvest Mexico. Or Reinvest Canada, eh? Or Das Reinvest for Germany. I always say, there's no shortage of a good deal. There are no shortages of good deals. None. It's only a shortage of capital. The more capital you can deploy at a 20% discount, the better. Yeah. So then we've got, needs to be combined with genuine fiscal consolidation. Cool. Meanwhile, what do we got here? The stagnant situation in the Middle East also added pressure to rates yesterday. The market digested Trump's threat over the night. That's fine. Financial repression could play some role in managing it. Yeah, we saw that. Meanwhile, the stagnant situation in the Middle East also added pressure on rates. Right. We still don't have this, by the way. Like, we were promised a full economic D-Day this week. Last Friday was the promise. Market somewhat sideways, yields up, failed Operation Twist, and guess what? No announcement. We'll wait for this D-Day like we wait for Trump's healthcare plan. Oh, no, Kevin, don't go there. Sorry, we have a concept of a plan. CNBC interview yesterday, Besson also said that oil markets were misinterpreting what economic pressure means. Right. Oh, okay. Now they're going to hold a press conference on Monday. So now we're going to delay it. Delay. Delayed to Monday. Renewed pressure on inflation expectations, largest daily move. Expectations of Fed hikes edged higher with pricing of a September hike up to 36%. That's fine. None of that matters. Oh, the market is closing, isn't it? Oh, we got to get the bell. I almost forgot. Thanks for letting me know.
What may be delivered next week from both the Fed chair and NVIDIA. And I look forward to seeing you then into overtime. Like St. Paul.
The bell's bringing an end to the trading day at the NYSE. Manchester United marking the start of the Premier League season, and at the NASDAQ, stablecoin X ringing the bell to close out the week. Welcome to Closing Bell Overtime, live from Studio B at the NASDAQ.
Yeah, more crypto this week. Lots of fun crypto this week. Okay, so let's see. This is just JPM on flows. Faster revenue growth makes the sector's capital intensity seem more durable. The central question is whether the model providers can collectively generate enough revenue to justify rising capital being deployed. How realistic is the AI ecosystem on the surface? Blah, blah, blah. Question is, who pays for these? Much of the demand is likely to come from large enterprises. All right. Well, that's no fun. This is pretty boring. To reach $2.5 trillion of AI-related spending by 2030, the required enterprise share would need to rise further. Oh, wait, this would be interesting. So let's look at this. Average AI spend is expected to rise from 4.5% of CapEx to 5.8% over the next 12 months. If this is representative of a broader global pool of large enterprises behind basically world stocks ex-China, and if those companies collectively generate 30 trillion of expenses plus CapEx, then 5.1% or 5.8% of AI spend would imply roughly $1.7 trillion of AI spending, which would be revenue for somebody, right? So they're basically saying that's not enough. The denominator could rise from 30 trillion today to 36, 38, depending on the exact timing. On that basis, 2.5 trillion of AI spend would imply AI spend of 7%-ish. Meaningful increase from 5.8, but not an implausible one if AI shifts from experimentation to scale development. Okay. labor substitution, blah, blah, blah. Recent acceleration in AI companies' revenue makes the AI CapEx cycle look more economically viable than it did 6 months ago. That's good. The bear case is that AI infrastructure is running far ahead of monetization and is becoming harder to sustain if the AI cloud providers, model providers, and neoclouds are already approaching the combined revenue run rate of 1.6 billion, and if broader AI ecosystems are compounding at double-digit rates. Okay. Okay. So basically, simply put, bear case, as usual, AI spend outpaces monetization. Simply put. Thanks. We already knew that. Retail investors participated in the leveraging phase that started and intensified in July. Oh, yeah, I mean, that doesn't surprise me at all. Retail brokers route their trades to the OTC. Retail flow, let's see. We suspect the share of retail trading rose to even higher levels in July. We'll have to wait for that data. Yeah, okay, that's fine. That's just sort of more boring flow information. We kind of already anticipate some of that. Yes, people are using margin to YOLO into sometimes even leveraged ETFs. And how did the market close today? Did we get to break through at all? Nope. Couldn't do it. Look at that. Could not break through. We got stuck. Tesla still had a very good day though. Okay. So we got the Besant failure. We'll have to do a little summary on that. And then the Madani rents. Okay. Cool. Let's do a little bit of Q&A just to see what people have over at in the community tab. Which remember, you can join and ask your questions there by downloading the Meet Kevin app in the Apple or Android App Store. So let's see what we have. Community tab. Real estate in New York City. Now there's a rent stabilization. Oh yeah, look at this. Here's as a broker in New York City, successive left-wing administrations have not resolved rental apartment availability because rent stabilization laws have created a hostile situation between owners in the city. As a property manager, I manage a rent-stabilized building in this incredibly difficult situation. As the housing department keeps helping tenants that hurt returns, and rent control means it's not economical to bring 57,000 apartments to market. Sure. We've sold around 5 brownstones with 20 rentals and have all been converted to condos or single-family homes. The city wants this because it has allowed property taxes to be increased to fund their expanding bureaucracy, to help the very department fight landlords. Yeah, the ironies. It's extremely challenging and costly to build and renovate. As a developer, I can't get into the complexity of cost. Hence, new development costs are high-end condo rentals that most people can't afford. Yeah. So, I mean, really, the more you create, this is exactly what we were talking about earlier, the more you create these rent stabilization laws, the more you make it uneconomical to develop. And so that's why we've got, In the Heights saying this. I think it's fantastic. We should add that to our little real estate component. Chatting about this at 6:50 into live. Okay, let's jump into here. So this is our community tab. You're welcome to jump in there, by the way, if you have commentary on this as well, and add your 2 or 3 cents or whatever you got. Okay, there we go. Oh, does that not link? It should auto link. Nope, it doesn't. All right, there we go. I linked it. Okay, yeah, let's add this in. Here's our comment in. Let me rephrase that. Here's a comment in our community tab, which you could join totally for free by downloading the Meet Kevin app in the Apple or Android App Store, and you could join this discussion as well. But here's somebody who's watched me talk about rents and the rent issue in New York City. And they mentioned here that they are a property manager of rent-stabilized units and how difficult it is basically to be a property manager because their housing department is extremely pro-tenant, especially since New York City has passed substantial rent stabilization laws. And what they basically say is, hey, as a result of these laws, it's really difficult to actually bring rentals to the market. You're way better off selling them as condos or single-family luxury homes. Basically, you're better off appealing to the high end because it's not profitable to develop for the low end because the rents are too low for the low end. So it'd be probably because of the rent stabilization laws. So this is actually something that is economically pretty common. So first of all, we know that economically, when a government comes in and puts in a price ceiling and says, hey, we're not going to allow prices to to exceed, X for a certain size or square footage or whatever, then what you end up with is, there we go, let's put this in such a way that we can see it, the supply and demand intersection here, right? If we come in and put in a price ceiling, what we're creating is a shortage where we want more units, so we have higher demand, but at this price, we're only going to supply this quantity of units because practically, if we go develop a building and this is all the rent that we can get right here, then, and let's say that's 100 units, and if we could get a higher price, then we would develop or supply 200 units at the higher price because that's what it would make sense on a cost to build point of view. When the government comes in and puts it, and maybe the equilibrium price, mind you, is 150 units, right? When the government puts in a price ceiling, what we're doing is we're saying, okay, fine. Then it doesn't make sense for us at that price to develop more. So we're only going to develop 100 units. But the market at that lower price is demanding 200. So what do you end up with? You end up with a shortage. Now, shortages usually show up as an increase of prices, but you can't see the prices go up on these lower end homes because they're rent stabilized. So that pressure doesn't disappear. That pressure, that price pressure moves up the frontier. And then you see rents of the higher end go up. And that's how you see average rents end up going up. So economically, you can't paper over a shortage. You have to build more. But like what this individual in the community tab is saying, hence new developments are at high-end condo rental levels where, people can't afford this stuff anyway on lower end rents. Well, that makes sense because the developers are basically saying, look, we have to build in a way where either we're not subject to rent stabilization laws, or if we are subject to them, we are selling for such a high cost per square foot because we're putting in luxury furniture and finishes and kitchens and bathrooms and this, that, or whatever, that, we can now justify renting or selling this at a point where we can make a return on our investment. Otherwise, every developer, which could just be somebody like you or me, right? Or you borrow money and go develop a property, you look at it, you pencil out the numbers, take out a little piece of paper, you go, all right, it's going to cost me $1 million to build this, plus the land, it's going to cost me 1.5. If I can only rent it out for $3,000, well, at $3,000, per month, times 12 is $36,000, minus our property management costs and all the bull crap that goes into it, call it, take off 30%, let's say 35%. That's $25,000. If I could only earn $25,000 on $1.5 million, that is an effective return of 1.67%. Why am I going to go build in New York and deal with all the bull crap for a 1.67% yield? I'll put my money into treasuries and earn 4.5%, you know, or just throw it into the stock market. Like, there's no point. So then the more people like me who do the math and go, that doesn't make sense, that's stupid, the fewer people are supplying properties. It's not like there's just some big entity that's like, we will be evil and build less. It's the collective decision of thousands of developers who are like, nah, man, I'll go buy treasury bonds instead. This doesn't make sense. So it was really interesting, but that's sort of an economic background for why this fails in Manhattan. It's not a surprise. Cool. Cool extra insight there from the community tab. Let's listen over here for a moment.
Benign or friendly, and maybe contributing to the case that some have made that this kind of inflation is one that you should probably wait out as opposed to move quickly to tighten in the face of.
Look, that's my general view about supply side induced inflations, but I have to say, and as you probably know, I'm known as an inflation dove, not an inflation hawk. Mm-hmm. This inflation rate seems very, very persistent. So we like to look through these supply shocks because they're, if to coin a phrase, transitory. This one is not looking so transitory, and it may not be over.
No kidding.
You know, who knows what's going to happen to the price of oil over the next, I was going to say year. How about month? You know, we have Donald Trump in the White House, and Lord knows what's going to happen.
Yeah, it's been all over the place, of course. And then also, I suppose the other possible driver of just all of this, you know, private capital spending that's, you know, increasing demand for debt, increasing demand for, you know, real assets even and land might be a contributor to some inflation. And maybe that's also something that's not particularly rate sensitive right now.
I think everything, as far as I can tell, now I'm not in the market in the middle of it. As far as I can tell, everything that's going on having to do with AI, et cetera, which involves acquiring land, acquiring water rights, acquiring electricity, among other things, has nothing to do with interest rates.
Yeah.
And it would take an extraordinary...
Not yet. It's definitely not being constrained by interest rates, but the costs are up.
That's the case. That's got that momentum. Alan Blinder, really appreciate you being with us. Thank you very much.
You're very welcome.
Okay, so let's go to another one. I like that one. That's a good one. All right, so what else here? Let's see here. Kevin. Hey, Kevin, when are we going to have a home AI in the web app? iPad app no longer compatible with MacBook Pro. Oh, that's interesting. Okay, let me answer this. So basically, working on bringing Homes AI to web soon. Stay tuned. We're very excited about the pipeline. And it's coming. Okay. Good. So that's coming. Okay, what else? Let's see here. Let's go do, weird home situation. Okay. Let's see what this is. Strange home purchase situation. I'm looking for insight into this very strange situation. Under contract for a purchase price of $725. 5 days from closing. Oh, so you're closing next week. Title search found the original owners had to get a special exemption from the town by the planning and zoning to allow them to use the property's in-law for a family member, and states the exemption is not transferable. Oh, so like the ADU basically. It would need to be reapplied for. Well, that sucks. And it was advertised as fully functional. I mean, that sounds like a material change to me. That sucks, you know, because you're already like deep into loan approval at this point. Never disclosed to me that this was not permitted to be rented. When reviewing the home, I expressed I would use it for rental income is the big part of why I was going to purchase it. Attorney said I have the right to back out of the deal and receive my deposit back because the agent misrepresented. The other problem would be to renegotiate. Right. Do you have a recommendation? Current sellers are in a situation where they've already moved down south as part of a relocation clause for the company they work for, so they don't really want to go to trouble of relisting. Right. Well, yeah, of course you have negotiation power to get a better deal. But let's go look at your situation here. This is in Oxford, Connecticut. Okay. Oxford, Connecticut. Wow, they're giving you a hard time with permits for an ADU? That's weird. Multi-generation, fully functional accessory dwelling unit. Yeah? Let's pull some comps on this. Let's see what we got. So this is, it's a big boy. 5,200 square feet, 4 bed, 3 bath. 44 days. It hasn't been on the market that long. Okay, it's a little dated. That's fine. Some of the things are nice, like the kitchen. You know, this is obviously quite dated. But that's just carpet. Doesn't need that much stuff. What are the comps? Oh, they moved it to accepting backup offers already? Of course they did. Knuckleheads. So the comps out here are... Oh, I need to get something that is... You don't have a pool, right? You have a pool table. We do not have a pool. This has... Okay. If I sort by square footage, 635, 785. How new is this one? 2006 build, so it's a lot newer. Does that have a unit? 4 bed, 2 bath, 3,400 square feet, walkout basement. Okay. Well, they're listing it at 4,600 square feet. So that's a little deceptive. But that's not uncommon. See people do that. 3 additional generously sized. Okay. So this is a little bit of a different hood too. Let me go see what the condition was of this. Okay. Everything wants to load slowly today. That's all right. So we got this comp. This has a lot more land, it looks like. Yeah, that's on 8 acres. 8 acres. This is on 1.6 acres. You're on, I think you were on 1.5, if I remember right. 1 acre. Okay. So, 1 acre, 785, that got you 1.5 acres. I'm trying to find the condition of this one. Oh, here we go. Yeah, it's honestly like 2006 grade, but that's still newer than yours. Okay. The pricing really varies here. Look, here's another 2 acre one. And some of these are getting a little old. When did this one sell? This one sold... Ugh, 2024. Such an old comp. I thought I had this limited to 90 days. I don't think I do. Apparently not. Sold. Oh, it's set to any. Oh, that sucks. Crap. I need recent comps. I have to go to 3K. Oof. Yeah, there are not a lot of comps in this range. I mean, here's a 1-1er. What is this one going for? Does this have units? How many lots is, or what's the size of this puppy? This is home offers 4 bedrooms, 5th in the lower level. So this doesn't suggest an ADU. And what's our lot size? 5 acres. Yeah, so you're having to adjust for acreage and square footage because this is going to be, well, here's a 1 acre lot. The 1 acre lots, they go for a lot less. You know, people are buying the land. There's a lot of value going into these 5 to 8 acre lots. This one's pretty move-in ready. 1 acre, no ADU, but neither does yours technically. So it honestly, yours probably falls closer to this. You've got an adjustment for square footage because yours is, what's the square footage of yours? I mean, it says 5, but how much of that is basement or that ADU? That doesn't count. Doesn't say. Assuming there's no floor plan either. Okay. Not the easiest. And this was close in square footage. What was the date of this sale? History. That one sold July of 2025. And what has the market done in this area? What county is this? Oxford CT County. This is in New Haven. Okay. Redfin Data Center. Let's go see what we got here. New Haven. If I can find the darn thing. Where's the data center? I always make it hard now to find. They just want to take you straight to their blog. I don't want your blog. I want prices. There we go. New Haven, Connecticut. Okay. So you actually do have price increases coming from the summer of last year. Yeah, we're slightly up. Year over year, 4.9. Single family homes. Single family though, I dropped. That's interesting. So what's seeing the boost? Oh, they don't even show that. Condos are down more. That's weird. All home types? Oh, it's because the sample size is going down so much. It's such a small number of homes. 200, you're going to get a big sway. Oh, that's not so useful. So that's not a lot of good data. What if I just do the whole state? So the state is indicating flatter growth. Let's get rid of New Haven. Okay, fine. I will have to do this. No, it still has New Haven in there. Oh. Oh, man. They make it so hard. I just want to remove New Haven. Here we go. All right, let's just do Connecticut. Let's see if I could get single family homes. Yeah, I mean, there's still growth. There's nothing indicating you're really going super negative here. So, you know, you're probably, if this is your best comp, this guy's probably up. This is, what did this sell for again? This sold for, that's the current estimate. I don't care about that. 785. 785. I don't know. Even if I add 3% to it, it brings it to like 808. I don't know that it's 875. But that's a similar square footage with a larger lot than yours. And, you know, so you could justify the price. The condition of this one's better. You know, maybe you try to get 50K off or something like that, but you might be able to go aggressive and push even lower. I mean, this one's really low. It's got a more similar lot size, but your square footage is also significantly larger than this. So, you know, what'd you say you were in escrow at? Oh, you're under a purchase for $725 cash. Oh, wow, look at that. That's great. That's great. I mean, you're almost paying this price for that property. Now this one's remodeled, so you got to add some money for the remodel. This one's almost looks flipped. You know, that tile's pretty inexpensive, but this looks like your local kind of contractor warehouse flip. Let me see if it previously sold. Yeah. See, look, it's a flip. This one's a flip. So here's your flip grade on that square footage, which suggests you could justify, if you got an ADU, look at the upside. If you remodeled this one and you got an ADU in there, it could probably justify $850, right? Based on this, some of the, this comp, time adjusted, plus you have the ADU factor, remodeled. If you could justify $850, you're in at $725. I think they should make it appetizing for you. If you could get it for less than this and you got it for $675, I don't think your intention is to flip it, because then it's still kind of tight. Yeah, your intention was to rent it to family. I'd use it as an opportunity. Hey, man, now I got to deal with all the bull crap. And then you end up hiring an architect or something to go deal with the bull crap for you. But I think you've actually got an opportunity here, and rightfully so. I don't think there's enough spread. What's it called? I don't think there's enough spread to flip it. But I do think it's an interesting opportunity, and you actually got more of an opportunity here because of this. The only downside is if that process is a headache, your next buyer is going to have to deal with that. But that won't necessarily show up on appraisals. It's just when you go to sell it, you kind of have to know you're going to have to deal with that sort of discount as well. That's interesting. I feel like you got a great price here, 5 days from closing. But you could make it even better. All right. We'll shorten that and do a little summary on that. That's kind of interesting. Okay, so let's go. Let me just take a peek here. Was there another housing comment? I think there was. We're going to come back to Bill. I think there was one other person who was looking at a home issue. Let's see if we can look at that too. Real estate location. Here we go. Okay. Oh, that's annoying. This doesn't go away. We got to make that go away. Like, it's fine if there's, if there's like a new post that pops up, right? But it shouldn't be persistent like that. So we'll, let me screenshot that. I'm going to get that fixed. Fix. Okay, cool. So, quick question. I live in Texas, but it doesn't seem to be the best market for small investors. My research points to New York for better appreciation. Conventional wisdom says buy local, but what if your local market isn't the best financial move? I wouldn't touch this. Like, first property, out of state, property manager, coordinating rentals. Dude, you're going to hate it. You're going to absolutely hate it. I wouldn't do that at all. I wouldn't wish that upon anyone. Yeah, 30 minutes from where you live. Exactly. Abso-frickin-lutely. No, this is a terrible idea. Like, let's go speculate on New York. Like, it's fine if you've got, $100 million and, if you're wrong, it doesn't really matter. It's a rounding error. But that's risky. Congrats on the investing shares. My best time, believe it or not. Major opportunities, yes. Yeah, and I think there are parts of Texas that, I actually think Austin, Texas is starting to bottom. Let me look at the data center. Obviously, there was a period of time where it was justifiable to be bearish, but I think we're getting to the end of that. Yeah, look at that. That's pretty stable in the last few years here. I mean, you've really had pain from up here to really even just recently. 518 in this chart. Some have indicated 25% declines. I don't know. This right here is about a 20% decline. So, this was pretty peak over here, but you can actually see it's kind of stabilized. So you might have some opportunities, especially if you could find find a deal or something like that. So hold on, let's hop in over here for a sec, and we'll come right back. One sec. There we go.
And it's still taking it. So it is a problem that needs to be solved. We are not claiming that people should actually send their pee to these data centers, but there even is like some science behind like using recycled wastewater for things like cooling data centers is not a crazy idea.
Yeah, and that's, and I don't want to make, sort of belittle some of the real and legitimate concerns out there. And we've seen other brands also kind of jump onto the kind of the anti-AI sentiment. Polaroid ran some pretty creative billboards. And of course, we've seen a lot of politicians here in this midterm season now suddenly against data centers as well. I mean, how quickly did this ad come together? I mean, did you already know Jason and the team over there at Garage? You just called them up and said, hey, let's just do something funny on this?
Yeah, we've known those guys for a little while now, and I think we're very kindred spirits in terms of, loving to make people laugh and have the world maybe not take itself too seriously. So, yeah, we just kind of came up with this idea, and, everybody was excited about it, thought it was funny, and, we put it out in the world, and, yeah.
Well, and we played that clip ahead of you from Fei Li, a pioneer in this space. And we've heard this from other pioneers, too. This idea that AI kind of has a marketing problem right now. It was kind of oversold to a certain extent in terms of the promises. There was no real discussion of the negative aspects. And now we have a public that is sort of seized on those negative aspects and not necessarily focusing on the potential upside. So is that something that maybe creative advertising or creative messaging can maybe turn the tide on that and change perceptions about what AI means for our future?
Potentially. I think it's more about most brand new things that people don't fully understand. There's like an instant body rejecting the organ kind of a thing. And I think it's more about the longer it's around, the more people understand it, the more you start seeing how it's being used and how it's not being used. People's perception will evolve with it. But because it's so new and evolving so quickly, it's just, I think, kind of a crazy foreign object to so many people. And just, there is a lot of, bad that can happen with it. There's also a lot of good. But I think people just lean a little bit more towards, well, we don't understand this and it seems like it's bad, so let's just not do it.
Yeah. I am curious how AI, if at all, is affecting your business. We've talked a lot on this show about how AI has sort of usurped certain types of software functions that you would have subscriptions to. You run your own in-house ad agency. There's been a lot of talk about how AI is supposedly coming for that industry. What is the relationship right now between, advertising and artificial intelligence? Can they sort of coexist together?
I mean, I like to think of it as AI is really just a tool. And it's never going to replace some of the top tier true human creativity. It does help with a lot of the mundane things. And I like to say almost AI will make mediocrity obsolete. Like if you're just not very good at what you do from a marketing or advertising standpoint, and you just want something that's a cheaper way to do something that's like just okay, then yeah, AI is a good solve for that. But AI is not going to come up with sending pee to data centers and having this hugely successful, hilarious video.
I am curious, though, about the distribution of that. I mean, because that was basically a TV ad, and it seems like anytime you talk to an ad person, everything is, how do we, get on the social platforms and, push more content that way. Is that the wrong way to look at this ad that you released?
Yeah, I mean, this ad is only living on social. Like, we're not running it on TV. In fact, I think most broadcast networks probably wouldn't let us show jars of pee in a brand.
Believe me, we had a long debate about whether we were going to show it. But yeah, we tend to be a little stodgy, Mike. But it got a lot of laughs, and obviously it caught a lot of attention. Hey, before I let you go, though, I do have to ask you a serious question. That is just about your business itself. You hired Goldman all the way back in 2023. You hired a CFO from Pepsi. There's been a lot of talk about the IPO window and whether your company might decide to actually, jump through that.
Water.
Are you still planning to go public anytime soon?
I mean, we're really just focused on building a large, profitable business. Like that's our number one focus.
Good.
Like we're not focused on what's the exit, what's the IPO, is it M&A. For us, we're going to have a lot of options given the type of company we are and the stage of company we're at. So we're really just focused on the business itself. And when the time comes, when there's an opportunity, we're going to look at all of them and choose the best one.
All right, Mike, really great to catch up with you. We'll talk again soon. Mike Cesario there, the founder and CEO of Liquid Death. And of course,
Well, I mean, that's always the, investors ask about that because it's like, obviously that's the goal. It's like, hey, like, when do we get some of our attendees? Everybody wants their attendees today rather than tomorrow. It's totally reasonable. I feel like it would be unreasonable for people not to be curious. It'd be weird. You got to be curious. Anyway. Okay. So, what else we got? So, let's see here. Okay. So, I wanted to look at this property I'm just pulling up here. This is 745 Meadow Creek and Garland. Okay, there we go. For sale. There we go. Okay, perfect. This I like. Okay. So we'll analyze this as well as this other person's situation. Okay, so we'll answer these two questions and we'll do like a little recording on it. Okay. And let's plug this in. Okay, cool. All right. Two crazy real estate investor topics we've got to talk about. Number one is coming from Folly, somebody who says that they live in Texas, but they don't think it's the best market for small investors right now. Their research is pointing them to New York for better appreciation. What should they do? Buy local or go to New York? We'll talk about that, and I'm going to show you how and what to look for in Texas. And we'll also talk about the market in Texas and how to make money there. But I also want to talk about this. This is Bill's strange situation here where he's in escrow for $725,000 on a deal that was advertised as a fully functional or as having a fully functional accessory dwelling unit, which Bill intended on renting out when living there, helping him justify paying, $725,000 for a property in Connecticut. And now 5 days before closing, we get a rug pull and it turns out, oh, that might not actually be permitted for you. It might just be grandfathered in for the current owners, but not necessarily you. And there's no guarantee it could be grandfathered in for you. So we're going to analyze both of these situations and get to the bottom of exactly what to do. So the very first thing we're going to say is that if you want to join this discussion and you want to add some commentary to posts like this about real estate, you want to chime in on this sort of investor community, you're welcome to do that totally for free. You just download the Meet Kevin app, and those are the questions that I'm answering here. So let's jump into this one right here. So Folly, we're starting with this. This is the Texas one. And we've got this response right here that says, if you've watched Kevin's early videos, he says, one rule is that you should always buy within 30 minutes of where you live. And it's not solely just so that in case something breaks, you could go fix it. I actually never myself go and never have run to a rental property to go fix something myself when it's occupied. I don't want to see the tenants, okay? You don't want to build a relationship with the tenant because that blurs a business relationship. But I've done a lot of work on properties before they're rented out, myself with my own bare hands. Outlets, paint, flooring, I don't care what it is. So the 30-minute rule is really so that you could understand, hey, what's going on in this neighborhood? Do I want to go do a Craigslist transaction there at 9 o'clock at night? Do I feel safe in this neighborhood? Do I think, a future buyer or a future tenant will? How is the area evolving? Is it on the upswing or the downswing? And that's where you have to be careful, because it's really easy to look at properties on the internet, which we're about to do, right? We could be the victim of our very own warning here. But what I realized when we were buying for House Hack and deploying, essentially this $100 million company worth of real estate assets, what we did is we flew to all of the markets we considered. So, we flew to Atlanta, Tennessee, Denver, Colorado, different parts of Colorado, Utah, different parts of California, different parts of Florida. We were all over the country. That's just a sample of where we were. Right? Manhattan, we've looked everywhere. You have to be there to understand on the ground what's going on, to meet people, to talk to them, to understand what's going on. The 30-minute rule shortcuts that for you. You don't have to pack your bags. You don't have to be in a hotel. The cost of that is insane. The cost of your time, the flights, the hotel, the headache on a small scale kills the ROI. Like, you're better off just buying locally and then consider that your hedge money, right? So let's think about buying locally in Texas. So Texas has historically had this sort of peak post-COVID era that a lot of people have had to contend with of crap, is the bottom in. I actually think the bottom is in. So in Austin, Texas, for example, we have now 3 times bounced at essentially the same levels. We peaked out at about 650, and we've gotten down to 525 once, 512, 525, 525, and 518. So in other words, the median home price in Austin, Texas has already hit this support level as if you're trading in the stock market, where you just keep bouncing off the same floor, which somewhat suggests that the bottom is in. It doesn't necessarily mean we're about to, rally with a 30-year treasury at the highest level we've been at since 2007. It's a tough time for real estate, right? But it's a sign that, the substantial decline, that 20 to 25% decline we've seen in Austin, is probably behind us, which is good. That's bullish. So, what can we do? Well, there are a lot of things we could do. I think the best thing to do is you go look for a local deal. So, for example, I just quickly opened up the Reinvest app, and it took me 3 minutes to find a deal that I'm like, okay, this is interesting, doing a little bit more, research on. This is a very early beta product, so it's, I always say today is the worst it's ever going to be. It's just going to get better and better and better over time as we keep improving our software. And that's what we do. Just so you know, we're a company that owns lots of real estate. Probably if you combine our liquid assets and real estate, we're over $100 million just in assets with no bank debt, right? So that's the company. We love buying houses, but we're also developing software. So whether it's the Homes AI, we call it, or the Stock AI products, there's a lot that we do in engineering on these, and we're really excited about these. And again, they get better every day. So here's a property that I saw. This one kind of caught my attention because I'm like, the carpet looks a little funky. There's drywall peeled off on the tub over here. They didn't even close the toilet lid to go take pictures of it. It's got that old purple, the purple drapes, which, to me is usually a big red flag or green flag, I should say, for value. And then it's got this is sort of original wood laminate countertop and these foil cabinets with the old electric cooktop there, or range, I should say. All of that to me is okay, this thing has some potential. Now, the app here is suggesting you potentially have a $69,000 upside in value if you bought this. We'll play with these, but this is saying that you should spend $63,000 renovating it, buy it for $180,000, and your ARV, your after repair value, be $312,000. Well, if that's true, I would rather buy a deal like that and hedge myself by getting a good deal and just let the market do what the market's going to do. So let's go look up that property. I typed it in. I typed in Garland, Texas already over here. I typed it in for sale properties. Here's the neighborhood. Now, one thing to keep in mind is this backs up to whatever this is, this Northwest Road right here. That doesn't look like a highway. The 635 looks like a highway, okay? But it does sort of corner up to what looks like maybe a 4-lane road over here. That's better than being one of these right here that backs straight up, because you really only have this edge corner with the plants or whatever. Okay, not bad. This puppy is listed for $180,000. At first glance, just looking in the neighborhood, that is over $100,000 less expensive for 1,800 square feet, 4-bedroom, probably 2.5 bath. So I've got an extra bedroom and another 150 square feet compared to this place listed for $310 right here, which, you know, doesn't even look that fantastic. I mean, it's okay. I can't tell if those are mini blinds or 2-inch faux wood, but I still got, you know, grandma's blinds over here. And I mean, I know this is thumbnail sized imagery. I should really open it up, but it looks like a roommate situation that's going on here. It doesn't actually, I mean, look at this. Look at the flooring. It's literally like a child took a knife across that floor and scraped all this flooring. This place looks like trash. You got the funky grandma drapes over here. Some crazy design, crazy situation going on the floor. This place is asking $310. Now I realize it's just an asking price. So an asking price isn't, you know, a sold comp. Duh, we know that. But, you know, that's crazy. That's $310. And we're at $180, you know? And then I got this $315,000 one. All three of them have price cuts, by the way. So a little bit of a softening market, something to hedge. Probably because it's really hot, I'm guessing right now. What is this? This is Garland, Texas weather. Let's just do a quick little. Yeah, dude, it's 100 freaking degrees right now. So of course it's hard to sell a house right now. You know, what's the temperature right now? 934 temperature outside. I don't know. I've been inside all day. It is 84. See, that's even toasty for us right now. Okay. So here's one at $315,000. That's, I mean, the flooring's trash, but it's decently move-in ready. Let's say if you had some nice flooring, it'd be worth about $315,000. What did this say this place was worth? Oh, you gotta be kidding me. Look at that. The app told me this place is probably worth $312. That's pretty good. That's pretty dang good, right? And I actually think that's conservative because if this is worth $315 with better flooring, it's still 150 square feet smaller. We could be conservative. We got a fourth bedroom over here. So I'd say $312, $315 for this place, probably right. Maybe close to $320, something like that. Okay. Problem is we got to do some renovating on this, and we got to look at sold comps. So let's look at some sold comps to see what things are actually selling for in the hood. So I only have a 2-bedroom comp in the neighborhood, and then I have this guy, which it's weird that that's showing up as sold. Maybe it was a flip, and that was its prior. Texas is also hard with market values, so you kind of have to go in here and look at when they were pending and assume that it sold within 1% or 2. So this is about a probably 60 comp. 260 comp for what actually looks like a flipped 2-bedroom that's 700 square feet smaller, but same hood. You know, usually I don't like comparing a 2 to a 3-bedroom, but it's the same freaking hood. And it's a recent sale. So I could bracket that as a low comp, right? So I got 20 photos here on Realtor.com. It's flip grade. That's your, you know, $2.50 Lowe's flooring. Flip grade. I don't know why they rolled up the rug under the dishwasher right here. That drives me nuts. That's just like a little bit of a flip red flag to me. And I don't think that faceplate is seated appropriately against that countertop backsplash, but that's just me being really anal and critical. And they didn't do the yard, which it's 100 degrees outside, not uncommon. Okay, so 260 comp right here, let's call it. We actually, in our data, we actually get the Texas sales data in the back end, but I'm just looking at this as like a public consumer here. Here's a bigger one. So this one should beat us in sales price. So this really should be like over 3, hopefully. Sold $310. It's basically right at 3. Now that was at the end of 2025, so that was about a year ago. You know, is pricing really up from a year ago? 530 to 557, yeah. 557 divided by 530. I'm up about 5% maybe. That puts me into the 3s. That's reasonable. Because if it sold for 300, add the 5%, puts me about 315. Hey, that's literally where we're running. Now, in fairness, this one's bigger, and we have to see what the condition is. Oh, those are old or original painted cabinets, so that's not a flip grade condition. Multiple different floors. Is that it for pictures? The semi-gloss ceiling. I do have a new window, though. That's nice. Older flooring. Could be better. Oh, here we go. cheaper flip grade. That's okay. I don't like the flooring at all, though. What the heck is that? Is that a mural? It is. That's funky. Oh, yeah. Acoustic ceiling and carpet over here. So it's not even flip grade. So honestly, $315 is a fair price because that flip grade would probably go for $340. So $315 is a fair price. So my point is, you know, here's an app, or sorry, not an app. I mean, there is an app. But here's a property that took me like 5 minutes to find in Texas and to do an analysis on. $63,000 for 1,800 square feet. That's honestly probably reasonable. $63,000 in Texas for this budget. You know, we're not going to overspend on it. That's probably a reasonable $71,000 hedge. That's how to protect yourself. Buy low like that. That's what I would do. I think this is a fantastic job right here by the wedge finder, we call it. I'm actually going to put other issues. Too good! Exclamation mark. Great analysis. That's not actually how I do AI ratings. I'm sending that. That just goes to our dev team. It's more of a note in the background. But that was freaking perfect. Now, obviously, not all of the things that our AI tool does are going to be perfect. That was really good, and it just happened to align with, you know, somebody asking a question about Texas. But that's my take on this Texas person. Now, let's do this one over here. This person, Bill, he's got this property that he's in escrow on for $725,000. So I already took some time and ran the comps on this. Basically, I think that he's actually got a really good deal. The fact that he's in it for $725, I hope the seller doesn't see this video, but just for him, this is actually a good deal at $725 that he's picking this up. The reason I say it's a good deal is because this place, which is also about an acre lot, which is similar to the lot size that matters a lot in this area. A lot, pun intended. This is a much smaller house, similar lot size, older home, but flip grade, going for $680. So you're basically getting 2,000 more square feet for $45,000 more, but you have this issue of, did they sell you a property with a legal ADU that actually isn't legal? Well, honestly, they probably knew that, and that's probably why they decided to take $725,000 instead of $799, hoping that, you know, you wouldn't find out. But you did right before closing. So they almost got you. But here's the opportunity you have. What I would do is I would go back to them and I would try to get $50,000 off on this. Because I think, A, it could potentially take me 50 grand of paperwork and time and headache to get that ADU permitted. But if I actually, like, ideally I get it permitted to where nobody else has to go through that BS again in the future. But if I actually get to go through that process, that's a big W if I could do it for less than that. But I want them to pay for that, knowing that if I have to resell it, somebody's going to make me pay for that again in the future to get this sort of temporary exemption transferable to other people. So I would see, A, can I get this permitted without this stupid exemption thing? Like, I want it permanently permitted. What's it going to cost? I want the seller to pay for that. Otherwise, I'm walking away, right? That would be my negotiation stance. If I could get this for under 700 and I get this thing for under 700, I'm closing on this all day long, because honestly, you've got comps that suggest this could be an $850,000 home. This is the comp that if you time adjust, it's a 2006 build, so it's a little bit newer. It's a little bit larger on the lot size and a smidge smaller on the inside, but this is a pretty decent comp right here that sold about I want to say it was a year and a half ago or something like that. And so if I time adjust this one, yeah, okay, about a year and a month ago. If I time adjust this one, I think this one could easily justify $850. And it's a pretty decent comp for your property, which is great. That means you actually have an opportunity to put more skin on the bone for your deal, more protection for you, more of a hedge. Try to grind it down. Anything under 7 is probably a W in my opinion. If I could go 675, my ego goes 10x because, you know, I look at this comp at 680, that's 2,000 square feet smaller, similar lot size, and I'm like, bro, let's go. That's my take on this. So absolutely use this as an opportunity, Bill. I think you've got something good here. So my take on these housing questions, and as always, you're welcome to check out our Homes AI tool and use the coupon code at the website. You can go to meetreinvest.com to see the product. Cool. All right. Awesome. So what else do we have? I want to make a quick video on the Besant failure because it's pretty embarrassing. So we're going to do that. And that'll also cover what's going on with PMIs. Okay. Let me see what I got here. Was our housing piece. And then Besant. Yeah, that's really the next one. And we should do a short on Citadel also. So let's do a quick short one on Citadel. Let's see, Citadel. That was the reporting here from Reuters. We've already covered this, but let's do a quick short on this. The block trades, which they mention 80% block trades. There it is. Okay. Well, if it isn't the same company that market makes for Robinhood and was a big subject of the story in the Robinhood and GameStop drama of 2021, Ken Griffin, who acquired the situational awareness portfolio, which was that hedge fund that really went bust and got liquidated out of essentially all of their public market securities at the end of July and tanked the market with it. Citadel came in, swooped in, bought these assets at a low on July 29th, and has already liquidated over 80% of those positions, which is remarkable because if you look at a stock like SanDisk, you wonder like, hey, it's certainly up from the Leo fold day, but it's not anywhere close to where we were in terms of pricing of all-time highs. SanDisk was all the way up at $2,300, one of the example holdings, along with a lot of others in tech. And what we ended up getting was a low of just under $1,000 here on the day of the Leo fold, July 29th. Within the next 2 days, the stock was up over 20%, and within the next week, the stock was up almost 40%. And it looks like Citadel has said that is enough for us to ring the bell and take some profits and tendies. And so that has a lot of people now wondering, what does that signal for the AI trade? In my opinion, two things. Number one, it is a signal that Citadel says, even though on one hand they're like, oh, we're bullish on the economy. On the other hand, they realize the Anthropic IPO is coming up. They want to raise more money than SpaceX did. And remember what happened when SpaceX went public? SpaceX went public, sucked so much money out of the stock market that the stock market actually fell between SpaceX IPO and where we sit now. We still haven't recovered the stock market highs of around where we were of right before the SpaceX IPO. SpaceX IPO sucks money out of the economy. Google issues like $80 billion of debt, sucking money out of the economy, out of the stock market. And so where did we sit? We sat with a stock market that bled out and still hasn't returned to those highs, at least on the tech side, the NASDAQ 100. People might be thinking Anthropic will have the same impact on markets. So that could be one. Number two could be the fear that large language models are starting to cap out on their progress, which could really hurt as open weight models catch up and the profitability for companies like OpenAI and Anthropic starts to fall. In fact, looking at what we're seeing on, if we jump on over to our Alpha Wire, we can actually see OpenAI just posted a heads up that they are going to drop API pricing by 20% for the next 3 months on their ChatGPT 5.6 to compete more with the likes of Anthropic. And so maybe Citadel sees the writing on the wall that the frontier models aren't getting that much better. Open weight is catching up. The IPOs are going to show that slowing growth, maybe. And they're going to suck a lot of money out of the economy. Something to pay attention to. Maybe they know. They're the suits after all. Okay, cool. So that's that. Now we need to do the Besant piece. So that is, whoopsie. So that's Citadel. And then this is going to be PMI. Besant, we have total control over the reason. Dude, it's a joke, man. You can't listen to the stuff Donald Trump is saying for branding. He is the master of marketing. Okay, Citadel. Okay, now we must do the Besant part. Oh yeah, okay. And that's with the JP Morgan piece. So JP Morgan, the S&Ps, and the credibility for Besant. Okay. And do I have anything left to drink? Throat's getting a little dry here, folks. Ay. I'm like coughing over this bullcrap line I see here. Trump defends ballroom at the military complex? What? I have to look at that. Are you serious? Hold on. Trump defends a ballroom as military complex. Can you address the Meet Kevin Clips channel that has been playing random stuff? It looks scammy and I haven't heard you talk about it. Yeah, we're playing old videos on the Clips channel. It is us, and it's just like a splice together of old content. Some people really like it. Okay. But I know it gives those vibes of like, oh, Elon's live streaming. Go donate to, Elon's crypto project, right? Like, I get that. I had that same thought too. I'm like, oh man, those never ending like Kathy Wood and Elon live streams and they're asking for crypto donations. But every day, the president does not have access to vital security features of the military complex. Presents unacceptable risk. Are you kidding me? The Solicitor General wrote. Oh my gosh. Double down on claims its completion is required by national security. The project will provide a safe room for the president, built with integrated engineering. The project will provide, in a very large way, a safe room for the presidency and the continuity of government. Right. Yeah, we need it. We need it because it's a bomb shelter and the Iranians are trying to kill me. The National Trust for Historic Preservation, which brought the case, said the administration's rhetoric is hyperbolic bluster. Yeah, probably. Trying to overrun judicial review. Nothing prevents them from continuing to work on the bunker, securing the East Village site, or ensuring the safety of the president. Federal law gives Congress the authority. Okay. Right. Okay, so, and now we've just heard that construction can continue. That came out a couple hours ago. We talked about that already. But Supreme Court ruled that president can now, for now, move forward with it. New ballroom is estimated to cost taxpayers $300 million, despite the president saying not. Contractors' invoices say otherwise. 5 months into the demolition, president claimed the project to construct a massive ballroom would cost up to $400 million. Private donors would pay for all of it. But a detailed project summary prepared for the White House by the contractor more than 3 weeks before Trump's comments put the total construction cost at $600 million, with more than half coming from taxpayers. Why does that not surprise me? We don't know if it's true, but, that wouldn't surprise me at all. The ruling comes after months of back and forth. The nonprofit has argued that the president must get approval from Congress to build. And the ballroom is expected to be a 90,000 square foot addition. It's actually kind of incredibly huge, really. Lack of space to host events with foreign dignitaries. National security benefits, including bomb shelters, a hospital, a sniper nest, and a drone port. Oh, that's pretty sick, actually. A drone port? Dude, that sounds sick. We are going into the future. Effectively ending the case rather than obtain permission from him. Petitioner, court has not reviewed the decisions on the merit. It is clear the president... This case is over despite every court have reviewed the... Okay. Trump praised it. Court proceedings started in March. Okay, so what did they say? Supreme Court opposition. Well, I want to see the actual filing. That's the complaint. Part of the complaint. Supreme Court actual. Let me see if I can get it. I just want to see what they actually wrote. No. Well, you think it'd be easier to find. Application for stay. Can proceed now. The decision. Oh, thank goodness they got it. Today is Aug 21. Order entered. Oh, that's it? They don't even give details. Preliminary. Upon the consideration of the application, it is ordered that the preliminary injunction is hereby stayed pending further order. Wow. So they're basically like, hey, you guys could just keep going. We're not going to rule on anything. No legal commentary at all. That's actually interesting. Wow. That's worth making a little note on here. It actually be relatively short. Where is my piece? I literally I saved this document because it's the coolest piece I have. I always keep this on my desk. I think it's so funny. A little Supreme Court document. All right, let's go into it. Well, once again, the Supreme Court has sided with Donald Trump, which, according to this, is not uncommon at all. More on this in just a moment. But Donald Trump will be allowed to proceed with the building of the White House ballroom, despite the fact that Donald Trump argues that the ballroom is going to be paid for by private enterprises, whom, of course, are paying these donations towards Trump and the ballroom to win favor with, like, tariff exemptions via Apple or Nvidia or otherwise. But what's interesting is, despite the money they're raising from these private enterprises, there are reports that the total construction is going to cost as much as $600 million based on leaked contractor estimates that have been viewed by reporters. Who knows? It could all be fugazi. But if it costs $600 million and we are only raising $300 million from private enterprises, this is going to end up costing taxpayers about $300 million. But anyway, regardless of the cost, apparently this facility is now being viewed as a vital security feature for the president, and that they need this 90,000 square foot ballroom because it's not only going to include a new bomb shelter, but it's probably expected to include drone ports, a sniper nest, a hospital, and room for individuals like foreign dignitaries to be protected in the event of attacks as well. We could see that right here. Donald Trump often points to the lack of space to host events with foreign dignitaries, saying that the ballroom is also critical to national security benefits, including bomb shelters, a hospital, sniper nests, and drone port. This is pretty remarkable, and the Supreme Court, in terms of their allowing the construction to proceed, didn't really give us any color in terms of why. They simply said, hey, there was an application to stay the lower court's ruling that construction has to stop, and we are going to approve that stay. So we're basically going to say, hey, whatever the other court said about halting construction, just ignore that for now while we think about it. So the Supreme Court is essentially saying, go ahead, just keep building until we think about it. But that brings up this problem right here. So what is this problem? Well, this, according to actual voting by Supreme Court members, in Donald Trump's second term, Justice Alito, Gorsuch, Kavanaugh, Thomas, and Barrett vote in favor of Donald Trump's policies 79% of the time. Roberts, 74% of the time. Alito and Gorsuch, by the way, 95% of the time in favor of Donald Trump. When Biden was president, those conservative justices, Alito, Gorsuch, Kavanaugh, and Thomas, voted for Biden policies just 18 to 41% of the time. It goes both ways, though. Sotomayor, Kagan, and Jackson, the left-leaning justices, clearly left-leaning, vote for Donald Trump policies 0, 11, and 26% of the time. But Biden policies they vote for 77, 88, and 82% of the time. In other words, as much as we think the Supreme Court is independent and really trying to interpret the Constitution because that's what we were taught in 5th grade, it turns out it all depends on what party you're in. It's just ridiculous. It's so ridiculous. But it's kind of funny, honestly. And sad. Funny and sad. Okay, so that's that. Now let's go. Oh, yeah, the bunker has to replace Epstein Islands. Oh, that's bad. Okay, now let's do this Citadel. No, we did Citadel. We need to talk about the economy. Okay. So, this is the Bank of America piece due to, where is it? X, got it, here it is. Okay. I think it was here somewhere. Oh yeah, here it is. Okay. All right, here we go. Bank of America just released a piece that argues you should get out of risk assets if Scott Bessent's Operation Twist ends up being a failure. In fact, they literally say markets have gotten so accustomed to, quote, extraordinary monetary stimulus over the past 20 years that if this version of QE, which isn't really QE, but if this sort of Bessent failure continues, where Treasury Secretary Bessent cannot get the 30-year yield below 5%, you should end up expecting the dollar to fall more due to dollar debasement. You should short risk assets, you should short leveraged hyperscalers and private credit, and you should short cyclicals like financials going into midterms. Now, what happens after midterms might be really bullish. And so that might seem like a really messy setup for a topic, and that's because it is. I'm going to break it all down for you. Okay, so first things first. Bank of America is basically comparing what Treasury Secretary Bessent is doing to stimulus. Now, I disagree with that. I don't think they're really doing anything other than reshuffling the debt. They're not any kind of new money into the economy, but what they are doing is they are embarrassing themselves in terms of credibility. If you look at the 30-year Treasury yield, despite the fact that Treasury Secretary Bessent intervened in the market to drive yields down, you see this V-shaped right here, yields have just gone right back up, which is a slap in the face to Treasury Secretary Bessent. But not only that, yesterday morning, Bessent ended up going on CNBC for like 20 minutes to yap about, oh, we might actually do bigger policy and more intervention. We're going to get these yields down. And what happened today? The situation actually got worse. Yields went up even more. They didn't get better. They ended up going up even more. Here is the intervention. Here's Bessent talking, and then they went up even more. So, in other words, markets don't buy Bessent's intervention at all. That this is a complete failure, which Bank of America makes the argument that, oh, this is bad. This actually affects the long-term credibility of the coordination between the United States government and the Federal Reserve, which in fairness, it's not just Bank of America saying this. Take a look at this. This is a Deutsche Bank piece right here that says yesterday's rise in yields came despite U.S. Treasury Secretary Bessent's attempts to ameliorate the market situation in an interview on CNBC, suggesting that buybacks could be bigger, yet ironically yields on the 10-year and 30-year either fully reversed or mostly reversed this Band-Aid, which is exactly what I called it yesterday. Yesterday I called it a SpongeBob SquarePants bandage on a giant hole in the side of the Titanic, which now everybody's looking at the giant hole in the Titanic because they're trying to rearrange the toxic debt the United States has. And now everybody's talking about how much debt the United States has and how much of an inflation problem there is. And really what you probably have is Donald Trump yelling, going, wait, we put Kevin Warsh in the Fed to lower rates and he's not lowering rates. Scott, do something. Get rates down. Fine. I'll raise money in the short term to buy long-term debt down and rearrange some of our toxic debt, and I'll go jawbone on CNBC. And the market's just like, double middle finger, you suck, it ain't working. So it's no surprise that this Operation D-Day that we were supposed to get this week on economic pain that we're going to implement against Iran, which even J.D. Vance has come out and said, oh, well, you know, it's actually a better strategy not to bomb them. It's just better to use the economy. Yeah, that'll work better. Okay. Now they're delaying D-Day to Monday because the Treasury market has been doing exactly the opposite of what they want, especially with Jackson Hole coming up, which isn't great because there's another potential negative catalyst of nervousness that's created. NASDAQ 100 just lost 715, for example. In fact, Jackson Hole is so important that we ended up making a coupon code called J-Hole. And if you want to join that, join us over at meetkevin.com. A lot of folks say you can write this off on your taxes. You get that lifetime access. Large price increase coming after a J-Hole. And we'll be rejiggering the pricing and what's included in the membership so you really benefit from getting in before J-Hole. All 9 courses, every private live stream, every alpha report, every trade alert. We've been pretty on it in the last few days in our alpha reports. I'd love for you to be there. But anyway, let's focus more on this right here. This is very interesting because Deutsche Bank and Bank of America are basically saying if the government and the Fed together lose credibility, then your intervention fails. And that is bearish. You basically should expect the dollar debasement to continue, gold to go up, the dollar to go down, therefore, risk assets to go down, AI infrastructure down, and financials down. Now, JP Morgan then ends up coming out and says Bessent now has even more of a credibility risk with this bailout failure. Goldman Sachs comes in and says the pressure that Bessent is trying to relieve on yields will just end up showing up somewhere else. And when visible intervention fails, you could end up seeing a faster, harsher, and more non-linear collapse. Okay, that's bad. That obviously means certain parts of the economy that are more exposed could collapse, and then it could kind of drag everything down. In other words, it's bad. It's really good for the economy to feel like the Fed and the government has our back and they're going to bail us out and whatever they do is going to work. But then when we see them actually try to do stuff and it's not working, it kind of makes you feel like they're just clowns swimming naked. You know, as they say, when the tide goes out, you see who's been swimming naked. They're like literally standing up in the water with their pants off and everybody's going, "Ooh, that is a really, really little peepee." little pricing power. That's not good. So anyway, the institutions are freaking out about this. Now, should you freak out about this? Well, my opinion is I like looking at what's actually happening in the underlying economy, not what's happening with these suits. And I have to say, this morning's S&P Global Flash PMI was actually really good. Now, I'm not here to like talk a book or whatever. I just want to be frank. This was a really good services and manufacturing Flash PMI report. Let me just read it to you. The U.S. business is booming, with firms reporting the fastest output growth for 4 years so far in the third quarter as the expansion picked up further momentum in August. Okay, that sounds really good. In fact, midterms are coming up, and what's kind of crazy is right here, JP Morgan actually says that post-midterm, the S&P 500 usually goes up. RSP just hit another all-time high. RSP is an ETF that tracks the equal weight S&P 500. Really valuable when the equal weight goes up because it expands the benefit of this broadening wealth effect where more people make more money. In the stock market, at least. If you chart what JP Morgan says, which I have this in the Meet Kevin app, which you can download for free in the Apple and Android App Store. This chart is there, and you could see that in the 3 months following midterms, you are green 78% of the time starting from 1990. You are green 89% of the time starting from 1950. We're less than 3 months away from midterms. After midterms, 6 months later, 9 months later, and 12 months later, the market, whether you measure from 1950 or from 1990, has a 100% positive win rate. It is green 100% of the time. Really bullish. So in other words, historically, midterms are actually bullish once they come and go. So maybe you have some pain going into it, Jackson Hole, some nervousness. Oh, Besant can't do anything with treasuries. Not so great in the very short term, but statistically bullish afterwards. Now, let's go back to that S&P report, because what else is in there that's really critical for our underlying economy? Anything about jobs? Spoiler alert, yes. Take a look at this. Annualized growth is approaching 3% currently, up from 1.5%. That was a little depressed in the prior read. Job growth has also shown a welcomed revival in August, with employers gaining confidence as concerns fade over the negative economic impacts of tariffs and the conflict in the Middle East. However, the latter in particular remains a key area of concern for businesses, especially via the impact on supply and energy prices. So in other words, the Middle East situation, Hormuz, is still kind of an issue on what's going on with pricing. And we are seeing a little bit of a decline in pricing power, which isn't great. If you come over here, you can see that right here. Price pressures moderated, especially in terms of selling price inflation, but input cost inflation remained elevated. Okay, in English, it's still getting more expensive to make stuff, but we're not able to sell it for that much more because our PPs are shrinking, right? The company pricing power is shrinking. Nobody likes shrinkage. It's not good. But employment up and manufacturing to services, growth momentum has shifted from manufacturing to services between the second and third quarter, which is bullish because you're seeing this stock building in manufacturing moving to a broadening in the economy. Our U.S. economy is mostly services, which is hopefully contributing to jobs growth. Now, we do have another jobs catalyst coming up on Tuesday. We'll get our first full week of August weekly payrolls data from ADP, so that'll be really important. We'll be covering that. But I have to say, this is bullish. I also have to say, this JP Morgan argument about the 100% win rate, that is bullish. Treasury Secretary Besant being a knucklehead and the Bank of America bull-bear scale being at one of the highest levels ever is not that great. Those call for short-term pain. See, the Bank of America bull-bear scale has gone up to a 9.5 from 9.3, which indicates extreme bullishness in the market right now. And JP Morgan also had a piece where they were talking about retail flows re-leveraging going into the end of June, which probably helped contribute to that big sell-off we had in July. And so it's possible that leading up to midterms and after the Anthropic IPO, you have a little bit of pain. But post-midterms and in the long term, things are looking pretty decent. The big risk of everything continues to be, as even JP Morgan argues, will there be enough AI-related spending by enterprises to justify the investments we're seeing. And we'll see. The Anthropic IPO will definitely provide a lot of color on that. So this is my overall bottom line. Near term, between now and Jackson Hole, certainly, expect volatility. We have been, since 735 on the Qs, in our alpha reports calling for a 715 test. We hit the 715 test. We lost 715 now 2 days in a row. I think we could actually get as low as like 685 to 675 by Jackson Hole if this nervousness continues. We'll see. It depends on what catalysts we get between now and then, especially with this economic D-Day that they keep delaying because it's going to make things worse in the short term. Post midterms, though, Q4, so end of November, December, January, February, I'm pretty bullish. I'm having a hard time seeing red flags yet in the actual AI trades, though Anthropic's IPO could expose a lot of potential pain, especially with how much debt is being built up. As soon as that Anthropic IPO hits and we start seeing the data roll over, that's when it could all come crashing down. So it's sort of like near-term volatility, cautiously optimistic after that, and if Anthropic hits the fan, it's your signal to get the hell out. Hopefully that is as clear as we could possibly make it. Now I'm going to finish this Luigi mug of tea. It's green tea with my green watch and my green mug. And it's time for me to go. So thanks so much for being here. We'll see you all in the next one. Goodbye. And